Right, good morning, ladies and gentlemen, and a warm welcome to day 2 of the BCI Global Investment Conference. A lot of you joined online yesterday. I hope you found value from the global managers. We're streaming live today from the Maslow Hotel in Pretoria, and thank you for our live audience in joining us here today, and a big welcome to our online audience as well. We further extended invites to some of the top DFMs or moderators in the country to join us here today to moderate some of the sessions. After each theme or after each topic, you know how it works by now, we've allowed a couple of minutes for questions and answers. For our live audience here, we're going to have a couple of roving mics because this is a dual medium media event. If you do have a question, please use the mic so that the online audience can hear the question as well. And for our online audience, you also know how it works by now. The Q&A bubble in Zoom, you're more than welcome to post the questions there. That questions will feed through directly to an iPad here on stage, so the moderator can try to cover those questions as well. Just quickly, and I had to mention this, bathrooms, if to my left through the glass doors and then left again. I know some people struggled to find it this morning. But yeah, it's a bit of a maze in here. But what a lovely venue, and a little bit different to be in Pretoria for a change. From Robert Walton and the team, and Tanya and Olga and everybody here from BCI team, we want to extend our thanks for your continued support in supporting and making BCI one of the top mancos in the country at the moment. Not only work done by the BCI team, but obviously fantastic investment minds that we've got, asset managers, of which a lot of them you are going to see here today. Interesting enough, last year this time I used a quote from Benjamin Graham as part of opening that said, "Successful investing is all about making risk, not avoiding risk." And when I looked at Paul's presentation at the end of the session yesterday, I found it fascinating when he used 2 slides. The one was from his presentation deck in 2018, and he had some images on there depicting almost all the noise in the system and all the risks in the system. And he actually used that very same slide to show some of those noise and the risks in the system at the moment. And nothing changed. Absolutely nothing changed. So much has changed. But in the investment world, that is the only constant that we've got. And these are some of the issues we're going to try to deal with today. He also added the words and saying, but if you look into returns from 2018, the risk was being out of risk assets. I think key to these kind of things and scenarios like we've got now and uncertainty in the world is to find the best, well-skilled fund manager to actually mitigate a lot of these risks and navigate through uncertainty to find those best investment opportunities for your clients. We trust that you're going to find a lot of value over the next 2 days. We've got some of the top investment minds in the country to take you through some of their views, how they see the world. We're going to cover things like asset allocation and all the other different asset classes. To continue from where we left off yesterday on global equity, we've got our global equity panel on stage already. And it's my absolute pleasure to welcome Samir Singh from Glacier here to introduce the panel to you, and he will also moderate the Q&A afterwards. Samir, thank you very much for joining us.
Good morning, everyone. Thank you so much for the opportunity to host this panel on global equity views and opportunities. As Eugene mentioned, my name is Samir Singh. Today we have an esteemed panel of experts from the leading asset management firms in South Africa. Joining us are representatives from Blue Alpha Asset Management, Richard Pitt, Coronation Asset Managers Neil Padoa. We also have Sean Pesh from Randmore Funds and Andreas van der Horst from Mazi Asset Management. Our discussion, or at least their discussions, cover various topics, speaking to how they see the world and also a bit of their philosophy and process. So I think saving a bit of time for the panel discussion, I'll let you guys come up and present. Go ahead, Andreas. Thank you.
Eugene, Samir, thank you very much. Ladies and gentlemen, good morning. I am excited to be here. I'm thrilled. What an opportunity we have today to talk about building wealth for the long term, not by trading, not by luck, but by owning the best businesses in the world that grow and compound your wealth. At Mazi, we follow a highly disciplined investment process underscored by a well-grounded investment philosophy. We do 5 things. 1, we look for the best businesses in the world, and there aren't many of them, so when we find them, we pay close attention. 2, we make sure we understand those businesses. It's our job to know those companies inside out and to understand what they do and what makes them tick. 3, we strive to pay the right price. A company trading today at $400 bought at $100 is up 4x in your hands. That same business bought for $200 is only up 2x. Valuation is your runway to investment returns. Entry price matters tremendously. Number 4, we think and act like owners. We're patient. We let our businesses compound. It's the late Charlie Munger that said, the big money is not in the buying and in the selling, but in the holding. Think and act like an owner. And lastly, we are circumspect. We watch our businesses like hawks. That means we act decisively when the time comes. When the facts change, we cut. Let's just for a moment look at a hypothetical example. 2 companies, both double in share price over 5 years. Same investment outcome, 14% in dollars a year. The one is a quality investor's dream. An excellent business, robust financials, secular end markets that are growing, pricing power, conservative, robust balance sheet. The other is a trader's dream, but an investor's nightmare. Cyclical, no pricing power, no control over the end market, owes its existence to leverage, whether it's price leverage or balance sheet leverage. In the one case, you can rest assured that the business is growing and compounding irrespective of what the price does in the market. In the other case, you can really lose your money. You can permanently write off your capital. We prefer to own those businesses that consistently compound over time, always by quality. Ladies and gentlemen, it is a fact that quality businesses over time attract quality shareholders. And there's a very simple reason. The founders of those businesses stay in because the prospects remain so bright. Institutions and pension funds stay in because it earns the returns that they need for their members. These businesses produce what shareholders need to grow wealth over time. Consistent profitability, consistent growth. And that is why founders, the families of those founders, and co-owners like us choose to be quality investors. One of the things that I love the most about my job is that we can find businesses that compound and grow many, many times over. In the 5 years that we've launched the Mazi Global Equity Fund, we've found Pro Medicus up 5x in dollars. We found Arista Networks up 5x in dollars. We found Deckers, Hoka running shoes, up 3x in dollars. And then there's still a long tail of other businesses that are well known, the Metas of this world. But it is true that there is a small group of companies out there that compound wealth tremendously for the patient investor. Look at row number 1 on this table. Kansas City Southern Railways. It's a business that dates from the 1800s in the US. In its current form, it listed in 1962 and delisted again in 2021 after being taken private. Our data goes back to 1972. This business has gone up 57,600 times in dollars since 1972. Imagine you are today sitting with your teenage grandchildren and telling them, I bought and I still own a 50,000 bagger. What position would your family be in? Take number 5, Walmart, up 12,000 times. No wonder the Waltons are so rich. Further down, number 7, Microsoft, Bill Gates, up 6,600 times since 1986. A lot of sixes in there. And then surprise, surprise, row number 18, PSG, the mighty South African PSG, up 3,600 750 times in US dollars since it's been listed. Now, if you wonder why PSG is there, look no further than row 21, Capitec, up 3,186 times in US dollars and still going strong. If we can find these businesses today that become tomorrow's Kansas City Southern, Microsoft, Capitec, PSG, we're going to do very, very well for our clients. Let's take a look at an example. Hermes. If you don't know of Hermes or haven't heard of it, ask your wife, ask your girlfriend, she'll most certainly know. This business is a machine. It has moats. It embodies the moats that we look for in a business. It has brand. It has pricing power. It tells you what the price is of the handbag, not you. It has a management team that is second to none. And it really, really helps that it's got a long-term family shareholder that is backing the management team and helping them to focus on the next 50 years, not the next quarter. If you'd bought this business in 1993 when it listed, and it's been around since 1837, you would have made your money in euros 477 times over. But even so, you could have bought the business 5 and 10 years ago, and you would have still earned a very, very decent return. When we find these businesses that are as profitable and as growing as briskly, these are the businesses we love to own because we know we are going to make a lot of money and create a lot of wealth for our clients for a very, very long time. But an exceptional business must also show up in exceptional numbers. So we look at intrinsic profitability and we dig into the heart of a company and we look at what is that return on invested capital. The chart behind me is what we call our company DNA chart. It gives us that lens right into the heart of the business. It looks far more complicated than it actually is, so I'll walk you through it. The red line is the cost of capital that this business has to earn over time. That is what it has to pay its shareholders and funders as a minimum. And the green line is what it in fact earns on that capital. So how much does it really make? We want to own businesses where the gap is big, a big, big, big positive gap. If you look at the purple band, that is just this progression of all these excess profits or economic value add, as we call it, that is added over time. So we want to find business with a very, very big, stable, and widening purple band. That's what we are looking for in our companies. Now, if we just return to Hermes again, you'll see it costs them, on the right, about 8 or 9% on their capital. That's what they've got to earn as a minimum for the shareholders. But they, in fact, earn 25.9. Sounds like a rugby score. So that is what we want. Deeply, deeply profitable businesses growing persistently. Let's take a look at another example, completely on the other side of the spectrum. This is an industrial supply chain business in the US called Fastenal. They literally move nuts and bolts. They too are an exceptional business. If you'd bought them in 1987, you would have made your money 1,000 times over. Now, none of us were there. Okay, we weren't there to pull the trigger. We didn't have the investment views. Quality investing was only a thing that Warren Buffett did back then. But even if you just go back 5 years ago, you would have made 150% in dollars. That's 20% in dollars a year. This business also embodies moats. It's got an exceptional, honest, humble management. They are 100% focused on serving the industrial customer in the US, and that they've been doing since 1976, and they've been doing so profitably year after year, irrespective of what's been going on in business and economic cycles. Not a long story. Same picture as Hermes. Same high returns on invested capital. Same wide band. When we find these businesses, these are the businesses that become the big compounders with the passage of time. Let's bring it back to home. And I don't want to pick on Nedbank because the story is the same for Standard Bank and for Absa and for every other major global bank in the world. Here's the company DNA looking into the heart of Nedbank. For the most time, this business has earned less than the capital has cost them. They have literally destroyed shareholder value. They've been turning water in a bucket, destroying value as we speak. The story could not be any more different for Capitec. Look at that chart. And the only reason why it's so floppy is because they report every six months. But the green line is solidly above the red line. A completely different story, a completely different journey. And this is what happens when you have a business that is deeply profitable, growing, and is able to invest those profits at very high returns to enable tomorrow's growth and tomorrow's profits. How did it work out for shareholders? Well, Nedbank pretty much flatlined, and Capitec ended up being one of the greatest investor stories ever told, and we still continue to tell it in South Africa. Now, the trader in you may say, well, you weren't there in 2002 when they listed, or it was always illiquid, or it was always expensive, or you couldn't have bought it. But that is patently not true. If you just bought Capitec 10 years ago, you would have made 20% in rands. If you had bought it 5 years ago, you would have made 16% in rands. Those are not bad returns to compound wealth at for the long term. So even so, the key message here is find businesses that compound, try to buy them at the right price. Let's just wrap up. What is it that we do at Mazi? We use our IP, our experience, and our data analytics to find the best businesses in the world. We study those businesses. We look at the numbers, the facts, not the noise, not the fluff, not the macro. We study them. And then we follow a rigorous investment philosophy and a robust and repeatable investment process that allows us to find these businesses time and again. And we act and think like owners for the long term. And in doing so, ladies and gentlemen, we are able to build a long-term portfolio that grows wealth for our clients. We can do the same for you. Always buy quality. It's never too late to start quality investing. Thank you.
Thanks, Andreas, and good morning, everyone. Thank you for joining us today. I'm going to be talking about some of the dynamics we are seeing in the global active asset management industry, some of the crises we have been living through over the last few decades, and how Coronation has been navigating those crises. But before we dive in, I just wanted to spend some time on our global journey, on our global capabilities, because many of you may think of Coronation as primarily a South African-focused investment manager. And that's not really the case. In fact, our first internally managed global fund was launched over 25 years ago. So we've been doing this for a number of decades already. Today, our investment team comprises 52 investment professionals. That includes 3 former CIOs with, on average, 17 years of investment experience. 40% of those 52 are entirely dedicated to global developed and global emerging markets. There is no expectation for these analysts to look at a single South African stock. They are purely global focused. And in terms of AUM that is managed by this team, the global emerging markets and global developed markets franchises are collectively managing over $12.5 billion today. So this is already a substantial business within a substantial South African business. Now, if we look back over the last 25 years, there have been a number of crises we have lived through. Starting with the dot-com bust in the early 2000s, followed by the GFC in 2008 when markets more than halved, and more recently, where it feels like we are rolling from one crisis into another, almost living in a state of permanent crisis, starting with COVID, followed by the broad-based market sell-off across all asset classes in 2022. Inflation spiked, there was war, interest rates spiked, there were recession fears, and most recently, the tariff war, geopolitical risks. In every single one of those crises, the impact on markets was meaningful, declining a quarter to a third. And in times of crisis, the human brain, us, we are not hardwired to take advantage of these market crises. We have evolved over the millennia to survive physical threat. Fear is paralyzing. Our time horizons shrink to prioritize survival now. These aren't my ideas. They're explored expertly by Daniel Kahneman in his book, Thinking Fast and Slow, where he talked about your emotional or ancient brain, and in times of crises, your emotion trumps reason. Your thinking fast trumps your thinking slow. And the hard truth is, the more prices fall, the more afraid we are, and the less we want to own. Because the brain is responding to stories and anecdotes and emotion, not to low prices. Now, of course, every crisis is different. So one can't merely look at history and blindly buy. There are always good reasons to believe that more bad news is coming. Just open the newspaper, turn on the TV, scroll through your social media, and you'll be bombarded with all of the bad news. And as prices fall, every day you feel vindicated that you didn't buy at yesterday's higher prices. And no matter how low prices get, one always feels they could fall further. And in order to understand today's crisis, let's just rewind a few short months to end of December 2024. At the time, the Republicans had swept the White House, the Senate, and the House of Representatives. There was a widespread view that they were going to cut income taxes, deregulate the economy, drive economic growth. Indeed, it was the self-proclaimed golden age of America. In other words, there was positive sentiment, there was a positive narrative, and there was a massive fear of missing out, drove extreme bullish positioning. What this chart shows, it's pulled from the Bank of America Fund Manager Survey, and it shows the net percentage overweight to US equities. The overweight allocation to US equities surged 24% month on month in December to the highest on record, just as markets hit their peak. The same fund manager survey 4 months later was the most bearish fund manager survey in 25 years. Negative sentiment, negative narrative, and a fear of short-term underperformance was driving record bearish positioning to the US. Now, make no mistake, the crisis we are in today is a real crisis. This chart shows the realized volatility in the S&P 500 over time, and the only market events that have compared to the current crisis in the last 50 plus years is COVID, the GFC, and the Black Monday crash in 1987. So make no mistake, this has been an extreme market response to a real crisis. But what we have seen is that changes in the market structure are really amplifying these crises and amplifying market volatility. And what do I mean by that? Well, first is the rise of what I call non-fundamental investors. And this is probably most evident in the chart on the left with the rise of passive AUM. So the pink or the red line there shows that passively managed AUM now exceeds actively managed AUM globally. If you look beneath the surface, the impact of non-fundamental investors is actually far greater because daily volume traded is increasingly being driven by quant funds, algorithmic traders, trend followers, pod shops from hedge funds running massive amounts of leverage and extremely short time horizons. And these non-fundamental investors are making buy and sell decisions and therefore impacting market prices. And we have seen a massive increase in volatility in the short term, and we are seeing bigger dislocations between price and fair value. And we think that is the first inefficiency that we and you can exploit. The second is a shrinking time horizon. And in the second chart there, it shows the average number of years which investors have held US stocks. And in the 60s and 70s, this was 5 to 8 years. Okay? The latest data we have suggests that the average holding period of US stocks today is less than 5 months. So investors are no longer buying a business and allowing the economics of that business to compound and generate returns over time. They're merely renting their equity exposure. And even if one of your clients walks into your office tomorrow and says, I'm done, I'm retiring, I'm out, even that client has a multi-decade time horizon from the date of retirement. And the ability, the time horizon arbitrage, to extend your time horizon beyond the average market participant is the second key inefficiency we think you can exploit. Summing it up on the third, in the third bucket, the active management industry we think has been decimated over the last few decades. It is entirely hollowed out. There's an intense focus on short-term performance metrics and leading to what I mentioned earlier, the price discovery mechanism being broken. And as we see prices diverge far more meaningfully from fair value, the volatility may be unsettling, it may be stressful, but for us, it is an opportunity to take advantage of. And that brings me back to the first chart I talked about of crises. And let's look at how markets performed subsequent to these crises. In every single instance, subsequent market returns were breathtaking. So for those investors with a valuation discipline who realize lower prices typically indicate higher returns, and with a long time horizon, understanding that we might be early, buying when prices were low was the correct decision and they were vindicated. So the returns were breathtaking, markets doubling, up 70, up 90%. Now these slides were compiled a week or two ago and markets move quickly, so the answer to the result from the tariff war we all know now. Markets have fully recovered the tariff-induced sell-off. In fact, this is a shorter-term chart, but the recovery we have seen is the most consistent and strongest move in 97 years of history. Once again, crisis has created an opportunity. Our response has been entirely consistent with our investment philosophy. We remain absolutely focused on the long term. We conduct deep and proprietary research focusing on company fundamentals, which informs our views of company values. And we put pricing before timing. What that means is we don't know if a stock's going to keep selling off. We don't know when the bottom is. But if we see meaningful gaps open between a stock's price and its value, we act. Now, there are many things changing in the world. In fact, people often say we live in a time of constant change, dramatic change. But this investment philosophy, which has served us well through previous cycles, through previous crises, has not changed and will not change. We think it's an enduring competitive advantage for our firm. I'd like to just give you some specific examples of actions in our global equity fund over the last 3 months. What we show here is our buys on the left-hand side, the sells on the right-hand side, and the graphs show the performance of those stocks relative to the global equity index. So a downward sloping line shows a stock that has been underperforming, upward sloping line has been outperforming. We have been buying Thermo Fisher Scientific, a leading life sciences and diagnostic business, ASML, a monopoly lithography business in the semiconductor value chain, and of course, Amazon we all know. These are all winning businesses. Businesses on the right side of technological change, businesses with massive competitive advantages, and businesses available at meaningfully lower prices today because of the market panic. At the same time, we have been reducing or completely exiting a number of other businesses that have performed very well. Spotify, HDFC Bank, and Just Eat Takeaway. The net result of lower prices combined with these portfolio actions is that the upside to fair value in our global equity fund is meaningfully higher than average levels. We think this is a good indicator of subsequent future returns, notwithstanding market indices at very high levels. We think the composition of the portfolio today embeds meaningful return potential in future, and this gives you a bit more granularity. Okay, so if I dive into a bit more detail in the fund, we show here the key risk exposures. In fact, 10 key risk exposures account for about 75% of the portfolio. We are always looking to diversify our exposure. No matter how attractive a region, a sector, a geography is, we will not bet the portfolio on any one idea, theme, or factor. We have a broadly diversified portfolio. We have used the market volatility to not only buy cheaper stocks, but to buy better stocks. And the composition of the portfolio today is roughly 90% in what we call winning businesses. So if we combine the fact of higher than upside fair value in the portfolio, a diversified portfolio, and 90% of the portfolio in winning businesses, we think there is substantial return potential embedded in the portfolio, which makes us optimistic for future returns. Thank you.
Great. Thanks, Neil. Some excellent slides in that presentation, I must say. So, welcome and thank you to BCI for all your support and to you investors for your support over the years. I'm Sean from Ranmore, and people sometimes say, well, why is it called Ranmore? And my answer is, well, I'd be in better shape if I ran a bit more. But there's a hill near us in Cobham, and used to do a lot of cycling, and so that's why there's the tree, etc. So I want to talk about where are there opportunities in global equities. That's what I want to talk about today. And to illustrate that, I want to use a scenario. So we all understand property, or we think we understand property, bought houses, etc. Think of this situation where you've got two situations, and where would you get the best price? So the first situation is you want to buy a house, and a developer is selling the house. So the developer has bought the land and built the houses. They know the market extremely well. They've priced it to extract every last rand of value. They've advertised it at a few estate agents. They're advertising it in summer. You've got a lovely lawn here, which is beautifully manicured. There are lots of people. They've got champagne, all the rest. Okay? Are you going to get a great price if you buy that house? The second scenario is a house that is maybe part of a deceased estate. It's on auction. It's on sale in the middle of winter. It's raining. Nobody wants to go to the auction. Where would you get a better price? And we'd argue you get a better price here. And this is not there's a real life story, because when I got to London, shortly after getting to London, I met a chap in the gym. And we just sold our house in Constantia, and we couldn't even buy a garage in London. Okay, and I said, "What do you do?" And he said, "No, he's a dodgy landlord." I said, "No, what do you really do? How do you make money when interest rates and when the yield on property over here is so low?" He said, "I only buy properties on auction in winter, on Sundays, in the afternoon, after people have been to the pub, and it's raining. Because they'll go to the pub, they have a pub lunch, they'll have a beer, they know they want to go to an auction later on that day, and they think, you know what, it's cold and miserable, I'll just sit in here and have another London Pride." And so he says, "I pitch up at the auctions, there's nobody there, and I get these properties." And I said, "What yields do you get?" 30%. Gets his money back in 3 years. And so really, the answer to this question, where are there opportunities in global equities, okay, is where few people are looking. Because that is how you get the returns. If you buy right, well bought is half sold. And if you buy at the right time, you're halfway to extracting your return. And so if you look at the world index, what we have here is the country weightings in the MSCI World Index, and I've broken them down. Often you see sort of Europe and Asia, but let's go by country weightings. You've got USA at the biggest, 70% of the MSCI World Index. Then Japan is the next biggest. I mean, I so rarely look at this. I was quite surprised that Japan was the second largest country. Ireland, that might surprise people. And you go down the list, and what have you got? You've got Brazil, South Korea, actually not even in the world index, because Korea might surprise some people. In MSCI, consider it a developing country or emerging market. Okay, the FTSE World Index includes it as developed, and yet you've got leading companies like Samsung Electronics and Hyundai and Kia. So if that is the benchmark, and most investors worry about, well, how are you doing relative to the benchmark? Where is most people's attention? Where are people, what are people looking at? Are most people looking there or there? Most people are looking, in the MSCI, because they're worried about how they're doing relative to the benchmark. What's their positioning? That is so much of the question these days. Neil spoke about passive investing. I mean, that's what's driving it. Okay, so what is the result? Well, what you have here are price-earnings ratios for some of those markets. USA, 25, South Korea and Brazil down there, less than 10, around 10. Whoopsie, sorry, I don't know why that. And so that is the price that a high price-earnings ratio is what you pay, because that is the example of everybody looking at that house and the developer. It's expensive. You're not getting a great deal. Few people are buying Korean and Brazilian stocks right now. Okay? So if you look at our portfolio, what is our weighting, we don't worry about the benchmark. I think we've been saying this for a while now. Benchmarks also fall. It's all very well for performing in line with the benchmark. If the benchmark's going up, everyone wants that. But benchmarks also fall, and we've seen that in recent months. And so, that's where we are. We've got more in Hong Kong and the UK than basically we have in the US. because we're not finding value there. So we're trying to find those properties in reigning parts, where on auction that nobody wants to visit. Okay, and that means that we can get a price-earnings ratio of our fund well below the rest of the world index. And these are not inferior companies; these are great companies. They're just not they're not the focus of attention. They're not big in the index. And what one of the benefits, there's two benefits really. Our portfolio is so different from many others that means we have very low correlation with many of the popular funds. And so if they're doing well, maybe we're struggling. If we're doing well, maybe they're struggling. We're very different. And when you put that together, the client gets a blended, smoothed ride. And we all know clients love upside volatility, but they hate downside volatility. They actually just don't like volatility. So you just want a steady return. And so that's the one benefit, is that we have very low correlation. But the second is that when you're buying stocks that nobody else is focused on, like this year, okay, when everybody tries to get out the gate, picture a whole lot of sheep trying to get out of a Welsh field, okay, people get trampled. We're not in that field, we're in another field. So A, you don't get trampled, and B, sometimes those sheep come to your field, and so that's what we've had. So we weren't as hurt by the tariffs and the sell-off in the US because we didn't have exposure, as much exposure in the US. And also meant some of those investors, and this is what's going on, I don't know whether it's happening here, but certainly the wealth managers I speak to in the UK, they are all looking to diversify out of the US because they've seen, and it's only just starting to take place. They've been having committee meetings, the big sovereign wealth funds and family offices. The things have changed. Maybe we don't need to just focus on US companies. Maybe we need to look elsewhere. And so that has also benefited us. But one point that people often ask us about is volatility. And volatility we don't think is risk, because you can steadily lose 1% every month. Consistently, you've got low volatility. Who wants that outcome? No one wants that outcome, okay? So there's another method, which is upside and downside capture. And you can get this data off Morningstar, certainly on Morningstar Direct. And really, what is upside capture? Upside capture is how well does the fund perform during up months, and downside capture is how well do you perform in down months. Now, we all know, if you've been managing money for a while, you know that sometimes the month, if the month ended a day later or a day earlier, it's a different result. If the month ended in the middle of or early April, people would have been looking at a massive drawdown. So you need to take some of these numbers, especially the short-term numbers, with a pinch of salt. But when you look at an upside capture and a downside capture, because you relative to the benchmark, the MSCI upside capture is 100 and the downside capture is 100. Okay. And so our upside capture is 113 over the last 3 years, and our downside capture is 65. That means we've managed to outperform in the up months, and we haven't lost as much in the down months. Now, that's a very short-term period, okay? So you want to look over longer periods, and we'd say we don't expect to capture all the upside in up months. How well has the IA Global done? So our peer index, which is nearly 600 funds in the UK, which are all the global funds, they've captured 89% of the upside, but 103% of the downside. Okay, so that's the problem. Whereas on a 5-year, we think is probably more relevant, 96. We don't capture all the upside, but we want to capture less of the downside. And our peers capture 90% of the upside and 102% of the downside. And if you can consistently capture just a little bit less of the upside, okay, but much less of the downside, and compound that through time, we think you're onto a winning formula, and that's what we've managed to do. And what we've got here, I'm not going to dwell on this, but we've got percentiles, not quartiles. But the point that Neil made is very relevant. You look at this crisis, you go back, even since we've been going in 2008, you've had the global financial crisis, you've had the European financial crisis, Fukushima, pandemic, tariff wars, etc. But if you hold the course and you're buying decent companies at the right time, timing is very, very important. You can compound, and so that's what we've managed to do. Okay, and we've managed to, you can see in the last couple of years, outperform when the market months outperform when the market's been weak. So that's the point I'd like to leave you with, is that the key thing is there's always a crisis. We try and find the opportunities in the crisis. A great example I wrote about in our fact sheet last month was EasyJet. You know, this company was selling off because the whole of Europe was, the whole world was selling off, economic war, tariffs, all the rest. And you go, well, hang on a second, but the oil price is lower, and what is the biggest cost for low-cost airlines? It's fuel. So, you know, they've hedged in the short term, but they've got some capacity to hedge. And so what we like to look for are the innocent bystanders, the ones that are caught up in the whirlwind, that are not really in the eye of the storm. And, you know, our European investors, there's a lot less European travel to the States, so they're going to spend more time in Europe. That's good for EasyJet. And so here you have a situation where their costs are going to go down, their revenue could actually go up. It's selling at 6 times earnings. They've got net cash on the balance sheet, but it's getting sold off in the crisis because it just happens to be a company that's listed in the stock market at a time when everyone's worried. And if you can do that at the right time, you know, then, and you compound, you can do okay. So that's really my story. Right. Rich.
Good morning, everyone. So as I started seeing Sean's presentation, it became apparently clear to me why I was made to talk just after him, and it'll be revealed as I get going. So I'm not talking about specific investment ideas. I want to talk about a concept, very simple concept. Good concepts, I think, always remain in fashion, remain in style. And the idea is that cheap is not value. So maybe a little bit different to Sean, perhaps linking a little bit closer to what Andreas was saying. And a disclaimer, Sean and I are old friends. We worked together for many years together. And he's certainly one of the most talented people that I've worked with. But we disagreed on a lot of things. So let's jump into it. Sorry, the one thing I did notice with Sean's presentation, I don't know if you noticed it, but he spoke about correlation of his fund, which is correct. It's quite nicely uncorrelated with other funds. But your slide correlation was despicable. I don't know who's doing the slides. So if I start rambling on and it makes no sense what you see on the slide, then you know my correlations also got out of touch. So cheap versus value. I'm sure you've all seen the Monty Python sketch where John Cleese buys a parrot, and he then returns to the store and says to the storekeeper, "This parrot's dead." It was quite good value, by the way. It was quite cheap. And the storekeeper says, "No, it wasn't. Not dead. Not dead. This parrot is resting." And so they have this farcical comic parody. And in my experience, I have over the years bought many cheap stocks. They appeared to be value stocks. And it turned out they were resting, and eventually they died. So cheap and value. I mean, cheap is, you know, if we talk about cheap, we're often thinking about price. There's a lot of focus on price, whether it's price to sales, price to earnings, price to cash flow, whatever the case may be. A point in time, optical view of a company. Very, very simple. Often lack of deeper analysis, clearly a potential for value traps if the business is in fact dying. And I think potentially short-term orientated because you're not explicitly saying this is a good business. You're just saying it's cheap. And what you are hoping for is that someone will buy it off you at a higher price. Now, if you buy a good business, then by definition you are more long-term orientated because you want to actually achieve the returns that the business itself is delivering. And so this issue of value investing, I mean, ultimately we want to buy things less than their intrinsic value. That's kind of self-evident. But in the marketplace, it becomes very difficult. I often say to people, it would be so much easier to understand this if you had a shop. If you invested 100,000 Rand and the shop generated 30,000 Rand of cash, say after 12 months, you would know that you had a good business. It's quite simple. If it generated 5,000, it would not be a good business. And this is cash. Forget about accounting earnings. So value, when we think about value, we think that the quality component is essential. And of course, the quote, price is what you pay, and value is actually what you get. So this was the disclaimer part about Sean's presentation. I'm going to jump into some residential property. And the reason I'm doing this is because I think when we think about price and value, it's much easier to understand it in a material sense. So we've taken two properties. One is in Helicon Park, which is in the vicinity of Randfontein. They are identical properties in terms of utility. One is in Camps Bay. I'm from Cape Town, so kind of visuals look very nice. And clearly, the prices are going to be very different. The price is on a simplistic basis per square meter. And remember, when we look at companies, we say, well, this is the P of this company, and this is the P of this company, as if that reference point is absolute and true. So in this case, Camps Bay is, call it 16 times more expensive than Helicon Park. I don't think anyone here would strongly argue with me that Helicon Park is really good value. Might be wrong. So I think in terms of utility value and even investment value, what you might make from the property over the next 10 years, Camps Bay would be the place to be. And so too with cars, and apologies to anyone who drives a Ford Cougar, which is an interesting name for a car. So we're looking at two 2014 models, the Ford versus a Porsche Macan. Different cars, clearly different prices. Price per unit of horsepower, about double for the Porsche. But I think many people could quite conceivably say, well, that's fine, they'll pay up for the Porsche because it's actually better value. So, cheap is easy, value is hard. How do we think about value? I mean, really, we've got to think about cash flows. We use a lot of HALT in our methodology, and when you unpack the HALT pricing model, you want to discount real cash flows going forward. You have to think about things like the cash flow return on invested capital, the growth that the business might have, the asset base, and then you must fade its returns through time. And that leads to operating margins, asset turns, revenue growth, and a whole bunch of forecasts that you have to make. And so here, the person who wants to buy cheap might say, well, hang on, we can't forecast all these things. This is impossible. And I have a lot of sympathy with that point of view. And so let's rather just buy cheap. We buy cheap and we hope for the best. If it were that easy, we would just line up all the stocks in the investable universe, by PE multiple, buy the bottom PE stocks, and that would be the end of the day. But we know, of course, life doesn't work like that. But I have some good news, and the good news relates to this idea of quality. And when we talk about quality, we're talking explicitly about the return on invested capital that a business generates. Think back to the example of the small business owner who invested 100,000 Rand and who generates either 30,000 a year or 5,000. So what this table shows is just the persistence of returns in underlying businesses. And we've shown this kind of chart many times simply because it stays continuously relevant. There are many versions of this sort of research done by HALT, done by McKinsey. This one is done by a company called Counterpoint. And essentially what it shows is that high return businesses, on average, tend to remain high return businesses. And equally, businesses with low returns, those returns tend to persist. And in fact, the companies that manage to transition from low to high or high to low, 90% of those businesses through time tend to be like super cyclical companies. So you might say, well, that's all very well, but I mean, people know what the good businesses are. We can see them. They have high returns, so it's all in the price. And one of the most successful investors that I'm sure a few of you have ever heard of, a guy called Robert Wilson. He inherited $15,000, and over the course of 35 years odd, he turned it into $800 million. And he said the only way to make money in the market is when there's a change in perception of a company, when the market's perception of a company changes. And I think it's certainly not the only way to make money. Markets have changed a lot, but it's an important way to make money. So how does that work? I mean, if we know that these companies are good, where's the change in perception? And I think the opportunity is that investors underestimate this persistence through time. And because they underestimate it, they underestimate the future earnings. And bear in mind, it is, after all, future earnings that drive share prices. So, just a few practical examples of this idea of cheap and expensive. We've got two financial companies, Citigroup, MasterCard, and what these charts are showing, the top chart is showing the cash flow return on invested capital. In the case of Citigroup, it's the cash flow return on equity, and the green line is showing the cost of capital. So, Citigroup, I guess, is, I don't know, what is it, 0.7 book or something. MasterCard is many multiples of its book value, but very, very different businesses. And clearly you can see there was a time where Citigroup beat its cost of capital quite well. And then after the financial crisis, leverage out of the system, more regulation, it hasn't been a good business. I would be very hesitant to buy a company like Citigroup just because it's cheap, because the multiple's low or because the price to book is low. And the green line on the bottom is just showing the relative performance of both Citigroup and MasterCard versus the S&P. And you can see wildly different performance. The next we can call good company, bad company. United Airlines versus Alphabet. Alphabet is obviously going through lots of issues at the moment. But if you look at the company and think about how the market's valuing it, basically the implied future returns that the market is expecting from Alphabet, cash flow return on invested capital, is just over 10%. So that's the red dotted line, which is vastly below what it's achieved in the last 20 years. And then if we look at United Airlines, which will be a very low multiple business for sure, it hardly ever beats its cost of capital. Tough, competitive business, highly regulated. And the big clue, of course, with a bad business is they have those gaps. So that gap on the bottom left chart shows when United Airlines went bankrupt in 2002. They blamed September 11, but you can see, in fact, it wasn't beating its cost of capital for quite some time prior to that. And then we have a lot of investments in the US. And the US has been spoken about. So thinking about expensive versus cheap or old versus new in the context of Europe, Rheinmetall versus ASML. Neil touched on ASML, the manufacturer of the photolithographic machinery used to make microchips. So an essentially important business going forward. Versus Rheinmetall, which has exploded. That's the armaments business in Europe, basically because of Trump and, Trump saying that they're not going to support NATO and that kind of stuff. But if you look at the long-term returns, I would say Rheinmetall is quite a dangerous business to be invested in for too long. And you could replace ASML with something like Novo Nordisk. Both these companies are half the simple valuation of Rheinmetall. I'm about to finish. Really cheap, Hertz. Hertz is a business which has become topical recently. Also a company that went bankrupt. Another great sign for a business. Bill Ackman got involved in it recently through Pershing. People are getting very excited about it. We look at the company and we say, historically, the business doesn't beat its cost of capital. Not a good business to invest in. Final slide. This is the performance of our global fund, which we've been managing for 10.5 years. And here we just track the performance versus the peer group. The two lines are slightly, the green and the orange line is slightly different. The one is all the funds that have the same length of track record as us, and the other one is the actual, it includes new funds as they came into the category average. So I think we can say that our approach works. It's delivered good excess returns versus the peer group. We've got some medals along the way, like any good general. And my parting point is be very careful to take safety from price or from apparent cheapness. It's not as safe as you think. Be very careful that you don't land up with stocks that happen to be sitting in Helicon Park. And in fact, you want your stocks to be in Camps Bay. Thank you.
Ladies and gentlemen, thank you, Richard.
Houses.
Ladies and gentlemen, if I may, please keep your hands going for those very insightful and thought-provoking presentations from our panelists. Thank you, gentlemen. As I just get my notes going, we'll be discussing for our panel today. Really, the focus is going to be on some of the key attributes around investment philosophy and process that these asset managers offer, while also being mindful of the current volatile market environment and also the uncertainty that's baked in. We want to keep it as interactive as possible, so for our in-person audience, please raise your hand, feel free to do so, and a roaming mic will make its way towards you if you have any questions. And for our online audience, please pop through your questions, and if you have to specify, or if you'd like to specify a particular panelist, just make that clear in your question. So without further ado, before we jump into our questions, I'll share an interesting stat I heard this morning. Would you believe it that as of yesterday, the NASDAQ is now in bull market territory? We really live in interesting times, and that's 20% from the recent trough through April. So on that note, I'd like to start off by asking our panelists to briefly share their initial thoughts on the current state of global equity markets. Andres, happy to start with you.
Thank you, Samir. Very briefly, we remain long-term bullish. It's our job to do that and to grow wealth for our clients. We continue to find excellent opportunities because of our data analytical capability and our very well-grounded philosophy. So we continue to see things in the quarter. We bought two businesses, Pandura Duo and Nubank, both in emerging market business. And so we are always seeing opportunities despite whatever macro themes, views of how expensive you think the market may be.
I mean, I'd distinguish the market from the portfolio. The market has got many thousands of stocks, and I think most people here will own 40 or 50 stocks. And in a global universe that wide, there is always opportunity. And I think some of the dislocations we've spoken about has created an amplified opportunity, whether it's outside of the US, whether it's in stocks people aren't willing to do the work on, whether it's in smaller stocks. We have a philosophy which allows us to value them on the long-term earnings power, and you can own an airline and a growth stock like ASML. And there are really opportunities across the spectrum, in the 42 stocks that we own across the portfolio. I think that was probably best highlighted by the upside to fair value that we see, which is right now well above average, despite markets having fully recovered.
Yeah, I think we bottom-up investors, so we're not top-down investors, and we will find opportunities wherever there's a crisis. We've had a bounce back. What's going to happen in 90 days? What's going to happen when the real effects of this disruption that we've had start flowing through to company results, etc. It's going to cause more disruption. So we should, it's like flying in an aircraft. You must expect turbulence. Don't climb on an aircraft if you're not going to expect turbulence, but expect the pilot to navigate through the turbulence and around the storms. And so I think there's long-term good.
Yeah. In 2018, Stanley Druckenmiller, towards the end of 2018, last quarter of 2018, global markets were not in a good place. And Stanley Druckenmiller, who used to work with Soros, highly rated person, very successful, lots of opinions, said that the markets represented the worst risk-reward trade-off he'd ever seen. 2018, okay. So I think the problem is, when it's Black Friday for shopping, we all charge off to the shops. It's unplayable. When it's Black Friday in the markets, we all close our eyes and we don't want to be invested in stocks anymore. We want to be in cash or bonds or something. Maybe not US bonds. And that's kind of a psychological, inherent fear that we have about money. And we don't see the opportunity for bargains when prices come down in the markets. And we have to kind of keep reminding ourselves that that's what they are. As for the macro factors, there's been lots of big macro news in the last, 20 years. There's a huge amount of uncertainty going forward, as there always is. And I think the task for all of us here is just to look for the right kind of businesses that can navigate their way through a very uncertain environment.
Thank you, Richard. Yeah, that's a point well made. about keeping a steady head while there's a lot of volatility around us. I think the question I have in mind here was directed at Neil. So Neil, thinking about the month that we've gone through in April, it was brutal. The market was down 12% over the 4 days prior to the 9th of April. And the stat here is that it was the largest 4-day decline on record. If you wouldn't mind sharing with us, how do you maintain and direct your team's focus during volatility in the market as it is? And how do you make sure that you stay focused on those opportunity set that actually starts to emerge?
Yeah, I mean, we haven't many decades of history at Coronation, so we have lived through a number of crises, like my fellow panelists. This isn't the first crisis you live through, and the investment philosophy is absolutely core to everything we do. Okay, so you have to divorce yourself from what is happening in the market, because that volatility is creating opportunity. You then have to keep an open mind and factor in new information as it comes in, because we were very disappointed and surprised by the tariff outcome. It was obviously a far worse outcome than everybody expected, and hence there were businesses that were fundamentally impaired. And you can't be romantic about these things and wish them away. You live in the environment that we live in, and so you have to be realistic and pragmatic and factor in new information as it comes to light, update your analysis. And in the sort of early part of April, we went through the entire portfolio, our entire coverage list, and within 3 days had remodeled every single business, factoring in a mild recession and a range of scenarios on the tariff income. We could rank order the impact on these businesses from no to medium to meaningful impact, and then compare, bringing it back to our philosophy, where they are now trading relative to where they what we think those businesses are worth in a real-time, sort of valuation update. And oftentimes you have stocks just because they're listed in the US, but they happen to be a Southeast Asian business, like Grab, which is down more than the market and has got zero impact from tariffs. This is obviously an opportunity. And there are other businesses which are in the crosshairs of what's going on in macro, and it may simply be too hard to come to a definitive conclusion because the range of outcomes is too wide, right? We are quite happy to move on. So it's just a rational response, using our investment philosophy and updating for new information where market prices are. And I guess the big thing is we have the philosophy, which is consistent, unchanged, and long tenured, but we have the culture at the firm which gives us the air cover to make those difficult decisions, because it is often very hard. We're often early. You often may look silly in the near term, but that culture gives you sort of the air cover and the protection to do the right thing.
Thanks, Neil. Yeah, something that stands out from what you're saying is discipline, being disciplined in how you stick to your process and philosophy, and maybe sticking with that and trying to keep a golden thread here. Andreas, a question for you. I think it came out quite clearly in your presentation that you guys are quality investors. I'd like to understand, and I think it'd be quite useful for our audience here, what does that practically mean for Mazi? And if you wouldn't mind touching on something that's a bit more tangible in trying to understand, I've often heard the statement related to quality investing is, you intend to become an owner or part owner of a business. What does that practically mean for Mazi? And if you wouldn't mind touching on something that's more tangible, which is your average holding period of a company.
Thank you. Maybe just to get sort of one thing out of the way. The term quality is quite a broad church today, so that's the first thing you should park. The second thing is that in terms of what we do and what we know generates wealth for our clients and for our investors is buying profitable businesses that can compound and reinvest those profits in more profitable growth down the line. So that's the group of quality businesses that we want to own, and we have to be part owners for the long term to realize that compound in year 4, 5, 6, 7, 8, 9, 10, because we're very hard at thinking what happens beyond the horizon in terms of compounding. So maybe the proof is in the eating. So in the year that we launched our fund, we had zero portfolio turnover. 21, we had zero. 22 at 11.9%, 23 8.5%, and then last year 11.8%, and this year to date 2.7%. So that equates to about 4 stocks being changed a year out of a portfolio of 39 stocks. So really low portfolio turnover and effectively 7, 8, 9, 10-year holding period as a minimum.
Thanks, Andreas. I'm going to shift over to Richard. Richard, something that stands out for me from your presentation, and I know there was a big focus on growing cash flows and understanding those cash flows. Those are central to your investment philosophy and process. Growth in cash flow is also a consideration for quality investors. Would you mind contrasting for us your philosophy to quality investing contrast your philosophy to quality investing and highlight how this defines the typical companies that you would favor? And if I could extend that, could you sort of just indulge us a little bit in how do you avoid value traps?
Well, we don't have value traps because we don't invest in value companies, but we do sometimes have quality traps. Look, I think, the answer would be quite similar to what Andreas has just said. And let me go back to the simple example of the shop that generates 30,000 Rand on the 100,000 Rand. That's a good business. You make 30,000 every year. If you can open another shop, if there's space for another shop on another corner and another corner and another corner, so you can expand your business, suddenly potentially you have a great business. So the growth vector is important. A lot of, there it gets down to definitions. I mean, quality, some people think about quality businesses as very steady, high cash flow generators, certainly, but not necessarily big growth companies. For us, the growth component is important, and the problem with that is when you want high quality and growth, then you start having a valuation issue. Those companies are not cheap. So that's what you have to try and moderate. But the growth is important specifically because, high quality growth business is not cheap. But remember, the company is reinvesting at its book value. It's not reinvesting at market value. Speaks to Andreas's point. So if those things are aligned, and if the company can indeed grow and reinvest in its own business and generate those high returns, then often the valuation is not as high as it appears, sort of optically, superficially. So I think that's the key differentiator. We're looking for companies that, yes, generate high returns, but also have a growth vector. And how do we manage, how do we moderate that? How do we observe that? We rely a lot on consensus forecasts. A lot of the companies that we invest in are big, well-researched businesses. So we're not standing up here waving the flag saying that we have a huge information advantage over other people. I think that's a tough flag to wave these days. Unless, of course, you go into very dark jungles, but you must be prepared to what you might find there in terms of people with guns and snakes and things. So, we're relying on consensus forecasts. We want to make sure that on the margin things are getting better, not worse, and that the wind is, shall we say, in the sails of the companies.
Thanks, Richard. I'm mindful of time. Sean, I hope you don't think I'm picking on you with this question, but this is the last one that I have. So, audience, if you do have any questions, please keep that in mind and raise your hand. Sean, it's not easy to live and invest through periods where I think you highlighted that the benchmark can go up and it can go down as well. And we fully understand that you are unashamedly a contrarian investor. When you live through these periods where potentially your fund is underperforming or the benchmark keeps rising relative to your fund performance, we think about a period as 2020 to 2022. What would you cite as your greatest learnings through that period? And if I could extend that question to maybe help us understand, what are some of the pitfalls and hazards involved in contrarian investing, and how do you navigate these?
So a couple of points. I mean, I think the most important thing is you only want to be contrarian when it makes sense to be contrarian. You don't want to be contrarian for the sake of being contrarian. I'm rather relieved to tell you we don't have any of those bad companies that Rich highlighted in his presentation, because for the same reasons. I mean, I looked at Hertz after I saw the Ackman news, and I thought it was way too much debt here. Who knows what's going to happen to car prices with tariffs and all the rest. There's just too much risk. So you only want to be contrarian when it makes sense to be contrarian. And what we always like to do is say, why is this company mispriced? In fact, might interest, if you have a look at our latest top 10, Alphabet's in the top 10. Now, that's the first time Alphabet's been in the top 10 since 2017. So we all want growing companies, we all want quality companies, but you want to buy them at the right time. And the nice thing about being, focusing on the price is that so what are the big concerns with Alphabet? Well, the big concerns is that AI is going to steal search as lunch. Well, but Alphabet's not only in search. You know, they've got YouTube and they've got Waymo, etc. They've got lots of strings in their bow. So if you buy it and AI doesn't, I mean, I'm sure AI is going to have an impact, but maybe not to the same extent. Okay, so if you buy it when that's in the price and that fear doesn't manifest, you've got an unbelievable deal. Okay, because you know, if people, but if you buy it and it does manifest, well, it was in the price. So you've kind of got a limited downside, but you're exposed to the upside. So, and we're quite happy. I mean, our turnover's high. You know, my people ask me what's my average holding period. I said, I'd say what my favorite holding period is 1 day. Because I want to buy it today, and I want private equity to unlock the value tomorrow, or the company to be taken private. And then I can take that capital, and we'll compound it. I'm not handing it over to management. So that's the thing. So I think if you're contrarian at the right time, it is risky. We've got to worry about those snakes and those guys with guns in the jungle. And we know, but you've got to say, why is this company mispriced? What are the concerns, and are they right or are they not? Now, the best ones are they mispriced because no one's looking there. No one's looking at Korea. People are worried about martial law in Korea and not, and what about Taiwan and who knows? You know, well, okay, that's... But arguably, Samsung Electronics, which is a holding in the portfolio, is a great hedge against China taking over Taiwan because they're going to have to get their chips from somewhere, and it's going to be the Koreans. So you see what I mean? So it's trying to find out, why is this company mispriced? Does it make sense? Is it priced in? And can we extract a decent return from this point? And if we're wrong, we'll walk away. We have no problem. We're not going to get everything right. We know that. We tell clients that. You know, fund managers don't like to talk about the ones we got wrong. We're going to get 35, 40% wrong. We just don't want to lose too much when we get wrong. That's the key thing.
Thank you, Sean. Audience, thanks so much for your attention. Are there any questions from the floor? Could we have a roaming mic here, please?
Good morning to all four of you, and Samir, thank you very much. I am not standing, Sean. I'll leave you to do that. Very, very simple. Obviously, after everything that's been going on in the US and a lot of pushback towards the US, if it's their summer travel numbers that are 15 to 20% down, Canadians not wanting to visit, people not wanting to buy American products globally, Tesla products in the EU, I think their sales are down 40%. What are each one of your, say, forecasts? So for those US corporate earnings, as they start coming through later in the year, what is your view on their earnings forecast for the rest of the year as they start coming through? Thank you.
Thank you. Andres.
Very quickly, our experience has been, and it's borne out by the numbers, that the portfolio of businesses that we own tend to surprise. So they surprise on those analyst forecasts from a year and 2 years ago. Generally, as an observation, we own service businesses rather than people that sell things. And so those service revenues continue to grow. So we remain bullish on the US. The one point I would make is that people talk about US exceptionalism, and it is indeed true. We'll show you the data afterwards if you'd like to see. The US is the one place that pays people to be shareholders. It generates wealth for shareholders. It's unlike any other territory in the world. So we would not be surprised if everyone is surprised in a year from now when US earnings are indeed up. It doesn't mean we're mega bulls, but just as that kind of comment, that is the type of place in the entrepreneurial culture that it is.
Thanks, Andres. I'll add, I saw this morning as well that I think forecasts for the S&P earnings are up over the next 12 months.
I didn't see that.
I just updated yesterday. Yeah. Neil.
We don't forecast the market, so I've got no insight really on market earnings. Maybe consensus is the best thing. Our portfolio positioning at the moment is 40% in the US. That's roughly 26 or 30% underweight. That is not driven by top-down concerns on earnings. It's driven by the relative opportunity set and attractiveness we see across the world. Some of those businesses will have sensitivity to the US macro. In that instance, we have revisited our assumptions over the last 2 months to factor in a mild recession. I think that was a reasonable base case. So this is partly a judgment call. If analysts were forecasting growth for a consumer discretionary business now, there might be a slight downturn. That seems reasonable, and that filters through into our estimate of the fair value. In most instances, these short-term hits have much less impact on the long-term value of a business than their short-term earnings. And this is what creates opportunities. There are companies like Skechers where obviously the earnings in the short term will be down 20 to 40%. Nobody quite knew, because they import a lot of goods from China into the US, and at tariffs of 145%, their earnings will be decimated. Well, guess what? The stock was down 45%. And guess what? 2 weeks later, the management buy it out. So, there is, I think, this disconnect which can happen. But we factor in macro sensitivities to the extent it's relevant for the individual companies we own, but not all of them are macro sensitive.
Yeah, I think that's absolutely right. We don't forecast market earnings. There are just too many variables. And so we'll focus on the bottom up. But if you just think about broadly, currency is a big issue for many large US companies that have got exposure offshore. Things like pharmaceuticals and healthcare. Look what's going on with the pharmaceutical pricing. So there's lots of unknown variables, and I think it's unknowable at this point. And so the bottom line is the future's unforecastable. Don't pay too much for it.
Yeah, I would say that there's obviously lots of reasons to be concerned. And I mean, if you think about it at the coalface, if you're running a business, going through the last 3 or 4 months, and you've seen it with companies in terms of, companies always give their projections looking forward. A lot of companies have almost withdrawn projections altogether and spoken about this high degree of uncertainty, and that must feed through into business decisions. So, yes, I think the consensus and common opinion would be that things are not going to be that great. Is that in the price or not? No one knows. But the opportunity for surprise is probably on the upside. So it sounds a bit counterintuitive.
Richard, thank you. Andreas, Neil, and Sean, thank you guys so much for your time. And audience, thank you for your attention.
Thank you.
Eugene?
Many thanks, Samir, for making for interesting conversation. Great to have you with us here today. And to our panelists, if you leave the room and you go to the right towards the pool area, there's a triage unit treating stab wounds. Right, maybe that will help. Right, coming to the front now on our next session on multi-asset funds and the views of the managers. Chantal Baptiste from Fairtree coming up. Arno Lawrence from Sasfin, and Rory Sparrenberg from Vunani. Also joining them on stage, here to moderate the session, is Nadine van Taak, Head of Multi-Management at Analytics. Thank you all.
Good morning, ladies and gentlemen. Our session this morning is on multi-asset views and positioning, but with a slight tweak. We've got a panel of experts with us today, but all on very specific asset classes. So Chantal will give us some insight on SA equities, Rafi will share with us on local fixed income, and Rory, I'm not exactly sure about the order, but anyway, Rory, you'll share some insights with us on global equities. So each of them plays a very specific role in any multi-asset portfolio. So hopefully at the end, we'll be able to pull all of that together. We're looking forward to your insights. Thanks.
Great. Morning, everyone. I'm going to be mentioning, if I just go back, the Fairtree BCI Select Cautious Fund, which is quite a defensive fund. So you can see the bulk of it is made up of fixed income, so a nice defensive optionality, and then augmented with about 35% local equity, and then just a touch of property. Fantastic fund, great track record, been walking a very long journey with BCI. So thank you so much to the team for having us. Eugene, Olga, Tanya, Sean, Rocco, Robert, probably forgot to mention a few, but thanks for having Fairtree today. I'm not a fixed income investor. I'm an equity portfolio manager. My name is Chantal Baptiste. I'm from Fairtree. So this is the only part of the whole presentation that I'm going to mention fixed income. Looking at equities now, this is the exciting part. So looking at local equities. And what I mean by this, play the macro, not the man. I love Peter Steff. He's one of my, I love all the rugby players, but he's definitely one of my favorites. But the point of this is just don't get lost in the noise at the moment, because there's going to be so much noise, because the man in the US is going to keep making a lot of noise, okay? You can see over the weekend when we came to the Geneva announcement, and now the market reprieves. Gold sells off, everyone's happy, we go back into a risk-on environment, because we're so fortunate that we rolled back the tariffs in totality. No, the tariff still exists. I don't know if you read that the guys who started Eskom's Push, remember that app that we use for load shedding? They've actually been hired by Donald Trump as advisors. And the reason behind that is that he monitored the psychology that they put out for you and I. So in 2023, when load shedding was really bad, I don't know if you remember, stage 6 load shedding, they'd announce it, you get the notification in your app, and you'd be so upset. And then they'd go, actually, it's downgraded to stage 4, and you get so excited, you'd actually celebrate it. And then towards the end, they'd say, no load shedding. So you've been in the dark for an hour, and suddenly you get that extra hour, and you actually feel really good about yourself. So those guys are currently advising Trump on how to manage the tariff discussion, because right now the world is feeling really satisfied that we've rolled back tariffs. Where have we gone to? In essence, there's still technically a 30% tariff on China at the end of the day. And that happened because pre-Trump 1.0, do you know what the tariff against China was on average? It was about 2.5%, 3%. Then it moved up to 19% under Trump 1.0. Biden did nothing about it, and now we're going to slap on another 10%. So on average, the current tariff is actually 30% against China. So the tariffs haven't completely rolled back. They're still there. And remember, this is just a 90-day negotiating. Let's see how it goes. But the point is, don't sit there and try to calculate, if the tariff is 2.4%, what does it mean? Play the game, okay? Play the equities. So there's 3 things that I know for sure. I don't know, okay? I don't know how it's going to pan out. I don't know if it's get a lot more volatile from here. I don't know. I don't know if the US goes into recession. I don't know if we start World War III. I don't know if there's a ceasefire in Russia and Ukraine. I don't know any of that, okay? I'm not smart enough to know that. But I know that there's going to be a lot of volatility, and I get excited about that. Another thing I know is that we're going to make mistakes. So liquidity and diversification is paramount for me. One of the gentlemen just mentioned now, he wants to sell things in a day. When I buy a stock at the moment, the first thing I'm asking is, can I sell it? Is there enough liquidity in this? Because if I've got it wrong, because suddenly the news changes and I want to get out of it, this is not flip-flopping, okay? This is the ability to change your mind. And I play in the liquid part of the market. And then the third thing I know is, perversely, as an equity portfolio manager, we get very excited in these volatile environments, because the value of a company dislocates from the share price. So I see a heck of a lot of opportunity coming up. Going through the macro, a few things, if you just step back and maybe you zoom out and you look at the world from space, we have to appreciate that there has been a little bit of change in guard. Not saying fully, I'm not saying China's going to take over. This is taken from Ray Dalio's book. But it's just something you can percolate on, to think that the US has been the hegemon of the world for some time. They took that sweet spot after the Second World War, where the Eurozone was in tatters, the UK was torn up, they had a lot of debt, and they came in with the Bretton Woods system. And they became the reserve currency of the world. So the US has been in power for a long period of time. All of a sudden, that power struggle has been challenged by the East. It's been happening for a few years now. It hasn't just happened under Trump. And the US knows this. So expect a lot of volatility going forward. We haven't seen this in a long period of time. Some of you are super young, so you would never have even seen this in your lifetime. You can't remember the world wars. I'm not calling for a world war, but what I'm saying is, often when you go through these big shifts and changes, there's a lot of volatility. That's why gold's doing well. Obviously, it's rolled over a little bit the last few days, because suddenly we're excited that there's a bit of a peace deal between the US and China. But gold is a sentiment metal at the end of the day. And it's gone up because there's higher inflation, interest rates have been higher, and the world doesn't know. When the world doesn't know what's going to happen tomorrow, they're always going to gravitate to safe havens. And gold fills that. Also, central banks across the world have been buying up gold. Why is that? When Russia invaded Ukraine, Russia got cancelled from the global monetary system. So they couldn't access dollars and they couldn't trade with their trade partners. So suddenly they said, we need to diversify our balance sheet. We need to buy up gold. I'm talking about the physical gold here, not the equities. China looked at this. India looked at this and they said, we need to do the same. Shucks, what if we step out of line and the US cancels us? So this has been a key support. Will it go on and on and on forever? No, but there has been a shift away from depending too much on the dollar. I just wanted to remind you, because people look at the price of gold and our human brains often work in absolute terms and not relative terms. And we say, wow, gold's gone from 2,000 to 3,500. That's a gigantic move. It's the highest in absolute terms gold has ever reached. It's the end of the cycle. This is it. That red line there is where we are in a relative view. So I've pointed out previous gold rallies. And commodity rallies can last a lot longer. I'm not saying gold goes to 6,000. Gold can reverse. But I'm just trying to remind you in relative terms, gold actually still has a relatively long way to go. Can gold completely replace the rest of the safe havens? So sit back and think about it. And this was like something we really scratched our heads about. It was probably about 3 weeks ago, where we saw negative news come out, and on one day, the dollar weakened, the S&P rolled over, and what did yields do? They went up. They didn't go down. That means people were selling them. For the first time in our memory, we saw the US become a source of capital and not a destination of capital. So what normally happens is when we're uncertain, we put all of our money into the US, we go into the dollar, we go into bonds, and then we go into gold. There's not enough gold in the world to replace the dollar. So what you could start thinking about, apply your minds, is what's another alternative safe haven source? Is it property? Is it silver? Is it copper? Is it another commodity? Alternative assets could perform very well in that environment. Can we ignore China? No, we can't. Now, Trump comes out and says that China's stolen manufacturing from them. They gave it away. The world gave manufacturing to China because nobody could compete, because the US and the Western mindset is bottom line. You need to make as much profitability as possible, and if that means moving all of our production to China, that's what's going to happen. Right now, China accounts for over 30% of everything we use in the world. Right now, where you're sitting, this gentleman at the front here, the pen you're writing with, that was probably made in China. Those stress balls on your table, China. The plastic that you're drinking, the water out the plastic bottle, China. Your shoes, maybe Italy, maybe China. But my point is, we cannot cancel the world, okay? I mean, the world cannot cancel China. And the complexity that we don't appreciate is how integrated supply systems are right now. What's the biggest single import that the US has? And where does it come from? Obviously China, but what do you think it is? The Apple iPhone. Okay. They imported last year $40 billion worth of Apple iPhone. Did China make the whole iPhone itself? No. Made one or two components of it. Lots of it came from Japan, Korea, Taiwan. China just took all of that and they put it together. So we're going to tariff the guys that are just working in a factory, actually. They're not the high-value additions. We're not tariffing Taiwan or Japan or Korea. We are tariffing the factory workers. So all I'm trying to point out is the tariffs are actually nonsensical, and they're going to bring back a hell of a lot of inflation into the system. I'm going to skip on to South Africa quickly, because I've only got 2 minutes. And importantly, from a South African perspective, I think that what happened at the beginning of this year was a good thing. I think it's good that naively, we obviously went into the GNU thinking it's all going to be sunshine and roses, okay? Think of anyone that you might know that went into a forced marriage. I don't know a lot of them. I've got one friend that went into a forced marriage. I come from Natal, so it's quite prevalent in obviously older Indian culture, but I have one friend that went into a forced marriage. Initially, it's bloody hard. The person doesn't really want to. It's met with resistance. You don't want to be married to this person. That's what the GNU is. It's a forced marriage, okay? It's parties coming together and they don't really like each other, but their parents are telling them, this is what you're going to do and we're going to make money off of it. That's what the GNU is at the end of the day. Is it working? Yes, it is working. It's working. Have they broken up? No, they haven't got divorced. Obviously, they're going to fight. It's public fighting. You should expect that. You can't expect two people to come together that don't want to be together and everything's hunky-dory. I think that the VAT negotiation was very important because suddenly, if you look at this, so this is a survey done by Brenthurst, and what it's saying in the black line there is if a national election was held today, who would you vote for? I like the Brenthurst survey because it's a bit broader than the others, the IR and the likes. But you can see the movement. The ANC is better off than the last national election, and the DA moves from 22% to 27%. You know what that big step up was? They accessed a part of the market or the population that they historically haven't been able to, because suddenly they look like Robin Hood. They're like, we will not tax you more on VAT. And the lower income bracket said, this is amazing, we're going to celebrate this. So it's going to be interesting politics. Is it going to be rocky? Yes, like any arranged marriage, it will be rocky. Do I think they get divorced? No, I don't. I think there's enough money backing them. Positive. We can demonstrate a little bit of stability, a little bit more accountability, and I'm saying a little bit. I'm not saying a lot, I'm saying a little bit. You start to move in a better direction. And we've forgotten what it feels to grow in South Africa. So the 5 years to 2008, I appreciate it coincides with a Chinese super cycle. I'm not calling for that. But we grew as a country on average at 4.5% GDP. We cannot remember what that feels like. Look what the banks returned in that period of time, 27% per annum. You know how powerful that is. It's a lot of dry powder. They can pay you dividends as shareholders. They can pay down debt. It's very, very powerful. We've gotten used to that last bit there, the 6 years to 2024, where we have stood still and actually gone backwards in real terms. But we've gotten used to that. When I bandy around, we might grow 2% this year. You're like, jeepers, that's amazing. It's that Eskom se push mentality, where I say it's going to be half a percent, now it's going to be 1%, now it's going to be 2%. We can get back there. And I think that we could get back there if we just continue on a slow and steady path, better and not worse.
Morning, everyone. First of all, thank you so much to BCI for the opportunity to participate this morning. I know I was introduced as Arno Lorenz, and I'm sure those of you looking at me would, despite the white hair, I am a little bit younger than Arno. My name is Rafi. I'm a senior portfolio manager at Sasfin Asset Managers, and a lot of the presentation, Arno and me discuss and talk regularly and often, and a lot of the ideas that I'll be sharing with you. First of all, thank you, Chantel, because looking at the clock ticking down, I don't have to cover all of the slides because you did it so expertly, but so much of it is the macro thematic thinking and scenario-driven risk management philosophy and approach that we have to investing that colors so much of the thinking in the slides that I'll share with you, and some of the ideas I'll share with you today. Chantel already covered this, the changing of the world order, the shift maybe from the US to China and the conflict that we go with, and the response immediately of the US to implement tariffs. And I want to maybe just focus on three main themes through the talk. Number one, what will those consequences or unintended consequences be as a result of this new tariff regime and the new policies that we see coming out of the United States? Secondly, how does one then position their portfolio, and what would the role of anti-fragile assets be in a multi-asset fund? And finally, which is maybe more my focus in terms of where I sit in Sasfin Asset Managers, what would then the role of bonds and fixed income be in your multi-asset mix and portfolios? And the first thing that maybe I just want to mention, I'm not going to go through all of this, is that everyone's talking about the uncertainty that we face, but even more than uncertainty, I want to maybe use the word unpredictability. Every single morning we wake up to another headline, another news piece, a new policy, a reversal of a policy, and it's absolutely impossible under these circumstances to be able to forecast what is going to be both economically, fundamentally, across any almost asset class. And in that kind of environment, as Nassim Nicholas Taleb introduced with his book Black Swan and subsequently Anti-Fragile, that there is a class of asset, just to maybe picture it and summarize it, there are those things that exist in our life that are fragile. A teacup, a saucer, a glass, that when we expose those things to a stress or to an unexpected force, typically they completely break and are destroyed. You then have those types of items that we come across that are somewhat resilient. There's going to be an earthquake, there's going to be a hurricane, and even in that, they somehow remain unaffected, more or less the same as they were previously, maybe a slight difference, but they more or less remain the same as they were. And then there's that unique category of items that we would call anti-fragile, as Taleb coins, where when you expose them to stresses and volatility and randomness, they actually then thrive and come out of their shell, and that then offers you the ultimate diversification when going through a period of extreme uncertainty and unpredictability. One of those, as Chantal mentioned already, is gold. This I've just used over here, gold adjusted for inflation. And as you can see, going all the way back more or less to about 1900, I think this chart shows, that in periods of extreme crisis, uncertainty, and unpredictability, that is the time when gold really thrives. And so if we're going into a period where there may be hyperinflation, where there may be a slowdown in economic growth, where the dollar is no longer the choice safe haven asset and US treasuries are no longer that safe haven asset, then where do you put your money? Gold then becomes an automatic and obvious allocation in any multi-asset portfolio to be able to harvest at least and protect against some of those risks. Now, it's not to say that gold doesn't reverse and you don't have massive corrections as well, but in this kind of environment, you almost think that gold remains a safe haven asset that is worthwhile, at least some allocation in a multi-asset fund. The second, just in a multi-asset fund for a long-term investor, is that every single investor wants to retire in 30, 40 years' time, knowing that their money can at least has the same purchasing power as it does today, which means that we have to try and generate inflation-beating real returns on behalf of our clients. And so inflation-linked bonds in South Africa, certainly if you're holding it to maturity, and I'm going to discount over here the volatility that maybe you'll experience along that journey, but if you look at our yield curve, I don't remember when this chart is from, maybe about a week or so ago, but your inflation linkers are offering you a 5% yield above inflation, guaranteed for the next 30 years. Nothing's guaranteed because maybe South Africa defaults at some point, but assuming we don't have a sovereign default, that means that you will be able to achieve a real return of over 5% in 30 years' time. How many asset classes can you predict with that level of certainty will give you that level of return in another 30 years? And so inflation linkers should also then be somewhat, it also has some anti-fragile properties as well, but certainly should be an obvious allocation in a multi-asset fund. And finally, I'm just going to go back a little bit to nominal bonds. In a South African context, currently the 10-year yield is approximately 10%. I think the real yield on the Albi at the moment is around 10%. And if you then take that and look at that through time, what that basically tells you is that at the beginning of every single year, you know that you are going to receive interest and income from the bonds that you hold of 10%. And unless there's going to be a 10% correction in prices and a loss in value of the underlying bond at the end of that year, you're guaranteed to come out with a positive return. And you can see on this chart where I've plotted and charted the income component of bonds every single year, together with the capital or price appreciation or depreciation during that period, and then the yellow dot showing you what your total return was at the end of that period. There are very few periods at all, irrespective of what the crisis was that we went through, that there was a negative return out of this asset class. And on that point, if you're going to look at bonds then, currently yielding 10.5%, and inflation in South Africa sitting at 3% and probably somewhat immune to the tariffs or the impact of tariffs in South Africa, at least according to current forecasts, that means that you're currently getting out of bonds with much less volatility than equity, a real return of 7% in your portfolio. And then just looking at a few broad asset classes, you land up, if you would go back, at least I've just done this to 2015 because it coincides with our flexible income fund. If you would just look at different asset classes, if you had invested 100 Rand, I've done all of this in local currency, so if you would invest 100 Rand in any of these asset classes, which is local equities, bonds, inflation linkers, gold, and US equities, you can see that US equities have far outperformed any other asset class. And so certainly you have to have some component, and that a lot of it is because of the depreciation in the currency, as well as because of US exceptionalism and the growth that you typically get out of equities in normal environments where equities do grow. And if that's the case, you certainly have to have a strong allocation to a growth asset like equities. And maybe then where do you find that growth? Will it be in South Africa as the GNU unlocks value? Please God. But otherwise, you maybe have to look for that value overseas, where you also then have the hedge of being protected by rand depreciation as it has come through over the last while. Gold as well, over this period, as you can see, is a relatively close second, especially because of the fact that we've gone through COVID and inflation crisis, post-COVID, and now the current crisis X, or whatever it is that we're experiencing now. And at the bottom there in the yellow and blue, right at the bottom is your inflation linkers, which is just a stable, small allocation, as we mentioned. But then the yellow and blue line, that's what I want to focus on, is that your local equities over the last 10 years have barely outperformed bonds. And they've done that with a lot more volatility. And if that's the case, then when you're then thinking of where to put your money, I would argue that in a South African context, is there maybe a consideration that should we be looking, at least in the short term, until we have some certainty around that unlock in value as to where equities as a broad general passive allocation is going, that will be able to unlock that value in equities? Should bonds maybe be a more reliable, safer bet, where anyway you're getting that 7% real return? And do you really need to take on that additional equity risk in this environment? We have two flagship income funds at SASFIN, our SASFIN BCI Flexible Income Fund and our High Yield Fund, the Flexible Income Fund, where we try and target bond-like returns with lower volatility. Our High Yield Fund is basically an enhanced cash fund where we try and outperform cash on a consistent basis with low volatility. And just showing you the relative performance of those two funds, the darker blue line at the top is our High Yield Fund with a very smooth, constant return other than a small blip during COVID, which has consistently given you, as money market or cash investors, a significantly higher return consistently through the cycle above other regular market, money market type funds, and as well has given you an almost 4% real return as well over that period. Our Flexible Income Fund, one of the previous speakers spoke about that Morningstar capture profile of the Albee, and one of the things that we've managed to do through time is that this chart just shows when the All Bond loses 3% in value or gains 3% in value, how much of that downside do we absorb in our Flexible Income Fund is just about 10% of that downside, and on the upside we're able to capture about 80% of that return. And as a result of that, what's happened since the inception of our Flexible Income Fund is that we've managed to achieve a return of almost 10% per year since inception. And the other graphs over here that are underneath, don't know if you can see them so well in the slide over here, but that pink line, which is that reddish line, the pinkish reddish line, which is the second line, is how has domestic equities performed over that same period. So the fund, through its active duration management and the way that we have followed that same consistent philosophy through time, has been able to achieve consistently inflation-beating returns throughout the cycle, at least over the last 10 years during, I guess part of it was the 10 lean years and the challenges we're going through now as we transition into a new type of government and economy. But typically what we've managed to do with far less volatility is not only outperform bonds and cash, we've outperformed equities, and doing so we've given you an almost 5% real return during that time. And almost it then begs the question, and certainly something that should be at the forefront of someone's mind, when I look back at the multi-asset categories, this fund also happens to have outperformed over the last 7 years, and since inception, which is almost 10 years, has managed to outperform the multi-asset high equity average return, the medium equity average return, and the low equity average return. And maybe then, does such a fund like our Flexible Income Fund, should that maybe be an alternative in a low equity space at least, to be a real consideration? Why bother with asset allocation in some regard when you're able to get 5% real returns out of a bond fund in a South African context? Thank you.
Good morning. Thanks to BCI for the invitation and to Nadine for hosting our panel and to my fellow panelists. There's no shortage of career risk in having to submit a topic for your discussion today 2 months ahead of the actual event. So here I am standing up to own this topic that we chose, active management in uncertain times, and the slightly provocative suggestion that the index is no longer your friend. What we've seen over the course of the last, really post the global financial crisis, is rising index concentration. And towards the back end of last year and arguably the early stages of this year, increasing risk embedded in indices from that concentration, which greatly undermines the traditional benefits from diversification and index investing, low-cost diversification. So I'm going to try and support that argument with some evidence. First, just to set some context, Nadine mentioned that there were a few multi-asset investors on the multi-asset panel. I do feel like somewhat of an imposter. So I am head of global equity at Vinani Fund Managers, and I run a global equity fund, but we also run a global multi-asset flexible fund, which is admittedly equity-centric in its approach and has approaching a 12-year track record in terms of the GIPS composite, and that we've been doing this since May 2013, and so just shy of 12 years. And over that time, the GIPS composite, gross of fees admittedly, has matched the equity market return, significantly beaten its composite benchmark, and more importantly, given you a substantial premium over what I would consider an appropriate hurdle rate, inflation plus 5. These returns are all in dollars, by the way, over that time frame, which is something that investors actually experience. And at the same time, achieved that with significantly less volatility, drawdown, and therefore enhanced Sharpe ratio, risk-adjusted returns. And it was mentioned in the previous panel, volatility is not risk. That's correct. Drawdowns are not risk. Loss of capital is risk. But we have to be cognizant of the fact that volatility and drawdowns are what our investors respond to. And time again, we see them making very damaging decisions about their asset allocation or their overall investments at exactly the wrong point in the time, because this is what they respond to, volatility and drawdowns. And in a product such as this, a multi-asset flexible fund, which has the ability to participate in equity market returns, but without the nasty side effects, the drawdowns and the volatility, or at least dampening those, the argument would be that a fund with this risk-adjusted return profile keeps investors on board so that they can stay invested for the inevitable recovery. So back to my topic, rising index concentration and the risks embedded in the benchmark. So over the long term, the fund over 1, 3, and 5 years has done a relatively good job of matching the equity market returns, but that's become more and more challenging as a narrow group of companies has driven the market return. And you can see the impact over the last 2 years and a bit of the rise of the Magnificent Seven and the distorting effect that has had on index returns. And you can see in the 1-year number, which can be a little random, that up until quite recently, we were underperforming the benchmark, the MSCI World, that is, by close on 10%. And then you see the snapback through the course of December and the first part of this year as indices rolled over. At the same time, on your right-hand side, the same return profile expressed as alpha in real terms to inflation plus 5. And there the returns are quite steady, certainly over the long term. 2022 is an interesting period, and we'll come back to that when we talk about correlation, because that, for a multi-asset investor, is clearly also a large part of the puzzle. So just to set the context, we're very familiar now with the very impressive returns that the Magnificent Seven have delivered, and NVIDIA in particular, sort of the poster child for this group. But remember where they came from. In 2022, we had an inflation shock in January, interest rates spiked, and global markets, both equities and bonds, were undermined because they had been conditioned to expect low interest rates for perpetually, and that dislocation in early 2022 led to a drawdown in global markets, which bottomed in September of that year. And the impact on returns for these high-quality growth companies, long-duration companies, that were particularly sensitive to interest rates, because the terminal value, or the value that they that was represented in their sort of earnings, was very far in the future. Nvidia fell 50% in that year. The Magnificent Seven, on average, it's an equally weighted index, fell 46%, and we've seen not the same extent, but a similar dynamic, peak to trough. From early February, Nvidia, in fact, initially peaked late in November and then rallied and subsequently fallen again. So these companies, while we agree that they are in large part exceptional businesses, have come to represent a lot of concentrated risk in indices, and one needs to account for that. Both the risk, but also the measurement problem that it introduces, because we tend to think of indices as relatively benign, but the rising concentration in these indices, I think, needs to be understood. And in addition to that, what it might mean for risk-adjusted returns. So we know that the Magnificent Seven contribution to the overall MSCI World weighting has risen from 13%, the fourth quarter of 2022, to close on a quarter, I think 23.8% in the fourth quarter of last year. So that relative performance is clearly quite stark, reflected here in Nvidia's share price, the diamonds on the right-hand axis. Nvidia's share price increased ninefold, but its contribution to benchmark volatility sevenfold. And then if you apply any kind of tracking error measure to your managers and you have a constraint, fund managers themselves would have had the additional constraint of meeting tracking error targets, which in our case, for example, Nvidia went from representing less than 1% of our tracking error, the difference to the benchmark, in the fourth quarter of 2022, to almost 20% in the fourth quarter of last year. So 1/5 of our total benchmark risk was represented by one company. And one can fall into the trap late in the cycle of capitulating to those kind of pressures. And that is something that I think as financial advisors, investors, I think you need to have both an understanding and arguably some sympathy for fund managers who are managing both risk and return. So the rise, not just of the Magnificent Seven, but the move into passive fund management and the sort of lost decade for us active managers needs also to be understood in terms of thematic investing and, again, late cycle phenomenon, which we observe here. iShares, I was just casting around because I think we're all quite familiar with the proliferation of index funds, the greater concentration in index products, as well as the leverage that has been brought into some of these names. iShares launched in late October, 2 ETFs, the top 20 US stocks ETF and the top 30 NASDAQ ETF, concentrated index products, very late in the cycle. In fact, almost at the peak. We're very familiar with the FANGs. Netflix fell out of the bus, Tesla got included, and so did Nvidia, but sort of the same story. This theme has been prevalent for a while now. And generally, once something receives an acronym, it's time to be cautious. I found this comment from the head of digital assets at Standard Chartered. They want to drop Tesla out of the equation and add Bitcoin, and soon there'll probably be an ETF for that too. So be very aware of product proliferation and promoters trying to sell you increasingly concentrated exchange-traded funds or any kind of financial product. Often this passes for innovation, which can be a bit of a swear word in our industry. And then the real point here is about misallocation of capital. We're very familiar with the rise of ESG that has now become relatively unpopular again. The iShares ESG Aware US ETF launched with $7 million in December 2016. That rose to $25 billion 5 years later. And you can see the reversal of that theme to December 2024. It's down to 13 billion. There was an article in Financial Times late in April, data from EPFR, which track mutual fund flows. They highlighted that for the 9th quarter in a row, US ESG funds lost money, net outflows. But more interestingly, European sustainability-related fund strategies lost AUM for the first quarter ever. There's $2.2 trillion remaining in sustainability funds, of which Europe represents 80%. So that outflow is just beginning. So be aware. So I said we have a measurement problem, and that's true not just in equities, but also in bonds and in commodities. Bond ETFs are constructed in a slightly perverse way. The more you borrow, the greater your indebtedness, the higher your weight in the index. There's a perverse incentive there. Commodity indices, similar. There's a pro-cyclical element to this. Gold and silver now make up almost a quarter of the Bloomberg Commodity Index, which is one of the most widely quoted. That doesn't bear much relevance to their economic use. So buyer beware. Imperfect indices. Concentration is also not a new phenomenon. We saw concentration in the US, if you just look on the left-hand side, now rivals more or less where we were in the 60s. It's also not just the US. Switzerland is the most concentrated market, and the most often cited example is Taiwan, where Taiwan Semiconductor makes up almost a quarter of the Taiwanese index. We have a measurement problem. And so I'm saying all of this because for 10 years or more, active managers have really had a very tough time against indices that have been driven by some of these dynamics. And what is clear, work from Michael Mabusin, is that markets tend to generate higher than average returns as concentration increases. And as concentration decreases and the returns are dispersed, returns generally are lower, but active managers tend to be much better because the opportunity set and the broader nature of returns tends to play in their favor. So I would argue that we're at a point in the cycle where active management now needs to step up and earn its keep, having had all these headwinds against it over the last 10 years. So then very quickly, a multi-asset framework to please Nadine. We run a multi-asset flexible fund, so how do we approach it? If measurement is a problem, then think about the ultimate objective. You want to retain the purchasing power or enhance the purchasing power of your clients' assets, so inflation has to be a key part of your thinking. This is various asset classes relative to inflation. There's a clear cycle there. I've cut the noise out by looking just at equities and bonds. Equities have given you over the long run, I think this goes back to the late 90s, but it's quite consistent over time. There's a great consistency here. 5.5% real. Had you bought equities in October, you were buying them at a point, October 2024, when that excess real return was close on 24%. And we've seen a correction, and today we're back at 12-month rolling return. Inflation has a gravitational pull on returns. Bonds, similarly. Bonds are pretty much now, have given you their long-run average return, real return of 1%. That's the Bloomberg Global Aggregate Index. So inflation has a wonderful gravitational pull. Areas of the market that are still earning excess returns relative to inflation, commodities, high yield. Even investment-grade credit is back at the sort of constant. So inflation is very informative, returns relative to inflation, very informative of long-run real returns. So in a multi-asset context, diversification obviously only pays if it affords diversification benefits. asset classes must be, or assets in your portfolio must be uncorrelated. And one of the challenges with multi-asset investors is that assets have been very highly correlated. You see here the one-year numbers I've shaded out because those are quite noisy. It can be quite random. But equity and bond correlations, just looking at the US, over 12, 36, and 60 months have been high and have sustained those very high positive correlations. The red dot represents the 12-month correlation when I submitted the slides, so late April. Correlations are beginning to drop, but what you see underneath is also a big shift in correlations. So the correlation to short-dated bonds, equities to bonds, has dropped and is negative, but the correlation to 30-year treasury is still actually quite positive. The correlation of equities to credit, investment-grade credit, is still very, very high. Diversification benefits are not obvious. And then interestingly, gold, as a diversifier, the equity gold correlations are still quite high. And some of the, I think Chantel touched on it, the performance of gold has generally been, has, in my opinion, been driven more by diversification of strategic reserves than its safe haven status. Certainly hasn't necessarily performed that way. So, sorry, my time is up, but this is my last slide. Given all the uncertainty, the complexity of global assets class decision making that one has to bring to bear, and then also the bottom-up work that we do, we are resolutely bottom-up. How do we actually make the decision? So this is our this is a illustration. It's real. The blue line represents the probability-weighted intrinsic value discount of our global equity buy list. We have 100 companies, each with a proprietary intrinsic value estimate. We scenario weight those. We have a bull and a bear case around the base case. And what that shows is the attractiveness, bottom-up, of the opportunity set. So the dark blue line refers to the left-hand axis. The average underlying intrinsic value discount is about 10%. We were underweight in equities in December as we were being guided by this tool. And through the course of the first quarter of this year, our buy list became a lot cheaper. And as of today, we are overweight equities for the first time in 3 years. As the blue line crossed the top standard deviation line, that was the 2nd of April, a week before global markets bottomed, and we took advantage of that. If I had to show you this chart today, that line is probably back at the top end of the bands, but still representing a 16% probability-weighted underlying intrinsic value discount. That correlates very well to subsequent market returns. The grey line is coincident for a three-month rolling return from the buy list, and you can see had you bought in December, you would have earned negative returns. Buying today is consistent with, or buying at the end of that blue line is consistent with a 15% rolling return. And I've overlaid there the hurdle rate, US T-bills plus a premium of 5%, and that gels very nicely with the long-run average. So this informs how we approach risk tolerance and equity allocation within our global multi-asset fund. Thank you very much.
Thank you, everybody. Chantal, I'm going to start with you. You and Ravi both spoke a lot about gold. I think there is a difference between having gold stocks in a portfolio and actual gold ETF. Maybe share with us your views on using, which one would you use in a typical multi-asset portfolio alongside another equity allocation?
So obviously I don't wear a multi-asset hat, I wear equity hat, but in our flagship balance fund, we obviously do hold the equities, and I think that you can, even in an equity fund, you can hold the ETF and almost arbitrage. So when you're going into a crash, so going into March 2020, We knew that the market was going to pull back. We didn't know by how much, but you start to go into defense mode there. So you load up on the gold equities. But the fact of the matter is, when there's a market correction, everything pulls back, except for US Treasuries, probably the dollar, but even gold pulls back. The equities pull back, but they don't pull back as much as everything else. And then just to augment an additional overlay of defense, we went into the gold ETFs. Now, we have a preference for gold equities because we equity investors, but also because they give you a dividend in theory. Okay. You look at the cash flow of a gold company, and in theory, they're always going to be paying you this phenomenal dividend because they're generating so much damn cash. And then you realize it's humans running these companies, and they always make these big, long-term capex decisions right at the top of the cycle, and you never actually get your cash back. There's always that risk that you run. So you have to be gold equities you trade. Okay, you've got to get in and out of them. You don't hold a gold equity over the fullness of time. You'll lose a lot of money. So we like it because it's leveraged. We like it because in theory you're going to get a dividend, and they are quite cash flow generative at a point in time. But you've got to be nimble. And where I'd have a part of my portfolio in the actual gold, the physical gold, the ETF, is just to augment my thinking on gold and then to shift between the two. So as gold pulls back the metal 5%, the equity is going to pull back 20% and then rotate into the other one, if that makes sense.
More
so
tactical
quite tactical,
than
very tactical.
And while I'm with you, you mentioned at one point given different asset classes out there, breakdown of correlations in the shorter term, it's time to look at alternative assets. What are those?
Property, I'd say. Properties are a great alternative asset. And I'm not just talking about the REITs. I'm talking about physical, investing in property. The problem is that the value of property is only recognized when you actually sell the property, okay? In theory, there's a value to property until you go and sell your actual property and you see what you're going to get. But I like it because it's physical, it's a great inflation hedge, and you can always get an annuity stream off of it. Also, I like to invest stuff I understand. I understand property. It's a building, it's a warehouse, it's residential, whatever it may be, and I can lease it out. Other alternatives, obviously, with the whole green energy drive, you're getting a lot of those infrastructure type of investments you could go into. And then also maybe alternative commodities, like I mentioned, silver. Silver hasn't responded like it normally does with gold. Platinum's another option. Copper would be another option. But unfortunately, copper is more of an industrial metal than a precious metal.
And unfortunately, some of them are not easy accessible. No. You talk about infrastructure, the accessibility of those is a challenge.
And the liquidity is a consideration also.
And we need to understand that. Rafi, I'm going to move over to you. You almost convinced me to go back to the office and move all my low equity funds into your income fund. But I want to ask you, what is the downside risk of bonds? You explained the real return from ILBs over time. We know there's a lot of volatility in the asset class. Bonds you're very bullish on, but what's the downside that any investor needs to be cognizant of? And then just link to that, if you've got not your income fund, if you're in a low equity fund as an example, would you change your duration play or to keep it where it is currently?
So yeah, it's a very good question. I guess one of probably the primary risk when investing in bonds is default risk, is depending on what you're invested in, whether it's credit or something else, that you'll end up just losing all of your capital. But other than that, as long as you buy a bond at whatever yield it may be, and that bond then reaches maturity and the company pays you back the capital that you had, then you receive 100% of what you lent to that company, as well as the income stream throughout. So really the main risk in the longer term is just your default risk. In the shorter term, obviously, especially in markets and when there is volatility, things like liquidity risk is very important. Short-term performance could be impacted as well. And that's where we maybe would be very active in terms of our duration approach and how we actively manage the duration in our fund to make sure that we are targeting specific maturity buckets and bonds and opportunities where we do feel that there's a more likely chance of achieving and outperforming the index. With regards to a low equity fund, if you're a long-term investor and you plan to hold to maturity, then I would just say buy yield. Because ultimately, again, as long as you're buying a safe, secure asset with minimal default risk, then the return that you're going to receive in the long term is the yield that you purchase it at. So if you can buy a long-dated bond at 12%, then why would you buy a short-dated bond at 8%? Because maybe in the short term it will outperform by a few basis points.
Yeah, and I assume that's just accepting the capital volatility of the longer yields that you do buy.
Yeah.
Rory, we don't have much time, but I want to pose a question to you. If we look at global equity markets, and a lot of the panelists this morning also spoke about the increase in passives, exactly what you spoke about. From a fundamental point of view, do you think we view global equity managers differently? In other words, shortened holding period of stocks, more passives, more volatility. Do we expect to see more lumpy alpha cycle? I know you all agree that it's opportunities, but is it a more lumpy alpha cycle? Is it a higher turnover in a fund? Or how do you think that will sort of like correspond in any global equity fund out there, and obviously yours as well?
I think the answer to that is that it depends on the manager. I think what we heard, certainly in the first panel, and something that I have a lot of sympathy with, is staying true to label. And one of the only things you actually have in your favor is a grounded philosophy, and whether you are a high turnover manager or you're not, I think trying to adapt your approach, or rather change your approach to market circumstances, will arguably lead you to make more mistakes. So the first thing I would say is stick to your knitting, understand where you are in your own performance cycle, and make sure that your investors understand that. But in terms of a sort of a generic expectation, I would be cautious of that.
Would you use protection instead of getting out of the equity market? I know you used your valuation metric.
In our flexible fund, it's something we've started looking at. We haven't in the past. To me, it's a layer of complexity, adding a layer of complexity to what is already a relatively complex exercise. So we may do that in future, but it's certainly a lot more cost effective, and for that reason we would consider it, yes.
Okay. Any questions from the audience? I see we are running out of time. There's one question over there.
Thank you very much for the opportunity. I'm Michael Mkwaba from ABSA. Great presentation from the presenters. My question to Chantel and Ralph, I think they put a very strong case for gold, quite passionate about it. So Chantel, maybe what is the best approach to get a good exposure into gold? Is it through maybe mining stock or using gold? And if I'm a medium to short to long-term investors, is it better maybe to have both exposure using both equities and physical gold through the ETF? And if that's the case, what would be the ideal allocation between the two? Thank you.
So I would say if you're not actively looking at the markets, and this is for your PA or you guys are obviously assessing your clients the whole time to see where they are in their life cycle and how much risk appetite they have, I would definitely buy the ETF if you have a low risk, long-term holding view, because you're going to sleep well at night. It will be there tomorrow. It might pull back. You can always put hedges in place to make sure that it doesn't go below a certain level. But if you want to make a lot of money and a lot of return, then you buy the equities. That said, you can lose so much. When it comes to resources, they're so cyclical, you're never ever going to imagine how high they go, and you're never ever going to be able to fear how low they can drop. So if you don't have the stomach for it, definitely do the ETFs and not the equities.
Thank you. I think we're done now. And then, yes, over to you, Jean. Thank you, guys.
Thanks, Nadine. Good. Many thanks, Nadine, for making for interesting conversation, and apologies, Rafi, for that, but we got it. And I have to ask Rory, what do you think about Swatch? No, it's just a stab. Right, our session just before we break for lunch on local property. Evan Yankelevich from Sesvekile. Evan, thank you so much for joining us. The floor is yours.
Thank you very much. I was told to run up on stage quickly because the slot before lunch, I don't want to give you an opportunity to leave. I'd also ask you not to look at your phones, not because I think you'll lose concentration, it's just because things change so quickly these days that my presentation could be relatively speaking irrelevant. But what I'm going to speak about now is from struggle to strength, the SA-listed property story. And when I say from struggle to strength, we've had a torrid time in the last 10 or so years out of property, but last year we did 30%. We did a little bit more than that, but nonetheless, we did 30% the sector. But you've got to understand it. Everyone says, has it done too much? Now, the strength relative to all assets, we outperformed, but there were two aspects to that. Firstly, there was a lot of catch-up to be had. If you can see the graph to the left, we came off our highs. There were many different catalysts to that, we'll call it fallout of the bottom, including COVID, including the potential scandals from the hedge funds and the likes. But our 30%, and this is capital values, brings us to a level that is still 45% lower than the peak that we saw in 2017. And also, if you take that into account, when we saw the ups and the downs, we still had that blue line, that blue bar on the right-hand side, which is our earnings yield. That cash flow still came through. We got paid to wait for the bounces. Yes, we're nowhere near where we should be or where we could be, but again, the 30% of last year was not everything. And that's why we're saying is that not only did we see a bounce back from the drastic pull down we've seen in the years gone by, but we're also seeing the fundamentals strengthen as well. So when I say from laggards to leaders, I'm speaking about the underlying assets as well. We're in a much better scenario than we have been in the last 5-7 years. If you look at the performances of last year, of that 30%, something to take out of this is that the laggards, the real laggards, were actually the offshore stocks, whether it's Sirius, Lighthouse, Nepi, even Nepi, they were holding up the bottom of the performers. The best performers were the South African stocks, the South African focused stocks. So with all kind of the headaches that we might have had through the years about SA actually came to their party and they really delivered well. The top three stocks, Attack, Hyprop, and Fortress, did circa 60%, an amazing year they had. So what I want to show you down, I'm going to break down the three main sectors, and I'm going to start with retail. And what I've got there, it's a very kind of different graph I've got here. That's the current shopping centers completed in square meterage. So what you saw now, what you saw there is during the good years, during the Becky years when the economy was on the front foot, you saw a lot of new build coming through. And you know that movie with, I forgot who it was, but nonetheless, if you build it, they will come. We built it and they came. The foreigners came through, they built a lot, Kevin Costner, but Zara, H&M, Cotton On, Forever 21, Hamleys, Mango, they all came and they wanted space. And when they wanted space, they built even more and more. However, they all came at the wrong time. We built it, and then the market saw a bit of a recession, quite a bit of a recession, into 2008. We obviously had a change of guard with regards to our presidency, and the economy took a bit of a south-moving direction. However, there was a lot of commitment from the big shopping centres. New centres were built, and the likes of Fourways, Gateways, Sandton, Canal Walk, Menlyn, all expanded. They expanded to, in excess of 100,000 square meters. In a normalized scenario, South Africa does not have enough tenants to fill that space. But they, built on the dream of all the foreigners. And a lot of those foreigners left. Mango, Forever 21 have left South Africa. The others slowed down their rollout. Cotton On was probably the biggest success. And not only that, we saw a lot of the local retailers struggling as well. So some of them went bust. Dion Wyatt, Studdiford's, they all kind of left the scenario. And Edgar's obviously came under a lot of pressure as well. Ster-Kinekor, we just had the results out of Redefine yesterday. Of their six centers that had Ster-Kinekor, 4 of them have left. They are downsizing. Hopefully they'll be more efficient. They haven't gone bust, but they are downsizing quite aggressively. What I wanted to say is that there was a lot of building and the tenants weren't, commensurately as strong. So we had a bad portion in retail here. There were definitely laggards through 2010 or 2008 to 2010. We had a little bit of a pullback. Things started to get better. However, and why did they get better is because this point doesn't work too well, but you can see from 2010 and all around about 2017, there was very little new supply. 2017-18, we saw that was Mall of Africa, but we saw very little supply, so guys were starting to get stronger. However, we had the advent of online retailing and then COVID, and that really put us on the back foot. But as soon as COVID kind of ended, we saw that, call it revenge spending. People came to the party. They wanted to be, we are social animals. They wanted to spend, and the benefits as well is that during all of this time, what we saw here is we saw, you saw growth in government grants continue steadily, and that supported retail. And over and above that, you saw a lower interest rate environment. There was more discretionary spend to support retail. So we saw a very, very negative period, call it 2008 to 2011, 12, and it's come back really strong. We do believe the momentum in that will slow down a little bit, but we are seeing positive reversions. As I said, retail, we saw Redefine results come out yesterday. Today was Octodec. Both of them are showing positive growth in retail. Sorry, I forgot to. I don't want to neglect this side of the hall. So we are seeing strength coming through in the market. Not only that, is that what you're seeing, and this is my favorite, the main driver of retail, you're seeing the effort ratio is getting stronger. Your effort ratio is your actual rental as a percentage of total spend. So that means that what part of what you're earning do you have to pay in rental. So you can see our levels are in line with 2011. It's quite low now. So it's a combination of spend is growing and rentals haven't been growing to the same degree. So we are seeing that never mind the consumer, but the actual retailer is in a much stronger position. And with that, you can see on the left-hand side is that your vacancies have pushed even lower. We are sitting as a sector, not as a sector, sorry, as in South Africa, your vacancies are around about 2%. In the actual listed space, they are sub 2%. That is really, really low. So you can see that positive tension, growth coming through in retails, from laggard to leader. In the office space, it's a bit of a different story. We always say it's still a bit of a bulldog, but a little bit of lipstick on now, so it's looking slightly better. Not great, but slightly better. But if you look at the left-hand chart at the bottom left, you can see is that rentals from 2008 until 2024-25 have grown, this is your average, from around about 100 Rand a square meter nominal to around about 140. That is about, call it, if you annualize it, 2% growth nominally for the last 15, 16 years. That is below inflation. So they've actually gone backwards. The affordability now is much stronger than it's been before. So it is actually in a much better position as you've seen before. Office is definitely following the trend of the economy. So obviously our economy or our GDP growth hasn't been strong enough to push strong rental growth. But it should have seen something, at least in line with inflation, because as the lady before said, no, property is an inflation hedge. Your rentals should grow at least in line with inflation. So there has been no supply coming through. You can see office supply on the right-hand side. As a percentage of existing stock, it is below 1%. In the last, call it 5 or so years. On the longer side, since the turn of the century, it's around about 4%. There has been, relatively speaking, no new supply. Very little new demand, mind you, but no new supply. So what we're starting to see now is people coming back to the office. Corporate culture doesn't last working from home. It just doesn't work like that. And you started to see some normalization, and we actually starting to see rentals increase again. So we are seeing positive tailwinds coming through, but again, still somewhat of a bulldog. It is the weaker sector in the sector, but it is looking a lot better than it has in previous years. The next one, we look at the fundamentals of logistics. Logistics and warehousing, it was a laggard. Why is that? Because ultimately it's a box. It is more technical than that, but generally speaking, it's quite a simple asset class. Historically, it was very, very easy to replicate, so therefore guys couldn't push rentals to the same degree, otherwise there'd be a lot more competition. However, subsequent to that, you started to see a lot more development, online logistics, online retailing. You started to see just in time kind of methods to deliver product to just in case, because of all the tariff wars, because of all the geopolitical tensions. So there's a larger, much stronger demand for logistics space. So what we saw now, well, historically, I know in 2008, when pre-listing, when we were speaking to Equitas, they were so proud of a big deal they did with a national retailer at 38 Rand a square meter at a 12% yield. It had to be a 12% interest rate, or higher back then. However, now for a similar type product, obviously it's not similar. It's a much more unique, call it advanced product, much more modern facility. So that's kind of a 2008 product, and that's on the bottom is a 2025 type product with solar, bigger docking bays and the likes. But now, if you want to build that, you need rentals to justify at an 8% yield. You need 85 rand a square meter. So you can see from laggard, 38 rand a square meter, and in no time, it's actually, I'm seeing guys are letting now at 100 rand a square meter, and it is a much stronger, subsector of the property market. So what I'm saying is that not only is there a listed sector from laggard to leader, but it's each of the underlying subclasses. We are starting to see, not the green shoots, we're starting to see growth beyond green shoots. Obviously, and I think you should always be very circumspect if everyone wants to speak to you about revenue without costs. Costs have already been a thorn in our side. You can see here your gross cost to income and your net cost to income has been growing exponentially from 2017 to where we are now. A lot of that has been electricity, but not only electricity, municipal costs as well. Unfortunately, the municipalities used to get a big margin out of electricity. They got to scratch around for other revenue streams, and they are approaching a lot of the property owners. It's an easy out for them. However, in the last, 12, 18 months, because Eskom's been behaving, we can utilize a lot of these grid-tied solar solutions. So not only are we not using a lot more diesel, and that's still to come in the numbers going forward, we're actually getting cheaper electricity because approximately 14% of all the usage out of the listed sector is from renewables, and over and above that, that's expected to double or so in the next 18 or so months. So it is really a great advent. Very seldom do you see the benefits of Eskom's load shedding. It's pushed us into action, and costs, as you can see in the last, 6 or so months, are starting to come lower as a percentage of cost to income ratio. And another sign that things are getting slightly better as well is you can see total equity raised. During the heydays, 2016, 15, 17, you saw about 40 or so billion rands of new equity raises a year. That's a significant number. New listings coming through, but mostly guys actually coming through raising more equity for the existing companies. What you saw subsequent to 2017, you saw that fall off quite drastically for two reasons. But the one reason is the lack of trust. But the other reason is that these stocks were trading so cheap at such discounts to NAV that they didn't want your money at that kind of discount. They'd rather forego the growth of the asset base and retain earnings stability. But what we've seen now, coming through into 2024, and we're expecting the same in 2025, that's starting to push towards 20 billion again. And that's showing confidence. Firstly, the opportunities for acquisitional growth. And not only that, is that they're not just taking it out of drips, which are dividends paid in specie. They're actually coming for book builds. They got the confidence that the market wants their paper. So the equity, foreigners are supporting it. So we're seeing the local equity players, not just property specialists like myself. So we're starting to see that coming through, and we're starting to see a great application of that money. Not just, as we saw in, call it 2020 in COVID, to secure their balance sheets, but to grow, to buy well, to buy accretive assets and growth assets. So it is a much better scenario than we've seen since, call it 2017. And then I always come to my same valuation charts. One day I won't show it to you when it's expensive, but it's not expensive now. I'm showing you on the left-hand side, that is your property yield versus your bond yield. You're still sitting slightly around the average, let's call it, slightly above average, meaning that you're getting a decent cash flow out of it relative to where the bond markets are. We still believe there's strength in the bond markets. Obviously, there's volatility with the tariff wars and the likes, but we believe that noise will fade away, as it always does, and our bonds are cheaper. So as bonds strengthen, so will property and a valuation or relative valuation. And then if you don't believe if you're not just happy with the cash flow, I forgot the lady's name who was speaking, but you're speaking about touching and feeling properties. You've got to do the numbers as well, but nonetheless, is that if you want to sell them in the market, they are trading at 30% discount to NAV. And that NAV is, when I say that, that is what they're trading at. In the last, call it 3 or 4 years, we've seen about, call it 30 billion rands worth of transactions sold at NAV, at around NAV there and thereabouts. So we believe in our NAV. And it's trading at that kind of discount. We believe property still offers value. Maybe you won't get 30% like you did last year. Unfortunately, I have to say, definitely you're not going to get 30% as you did last year. At the beginning of this year, we said we'll get around about 13.5% to 14%. I think it still holds true. we're still very pro-property in that the income yield that's on an 80% payout ratio, still robust at 8.5%. We are seeing growth coming back. From laggards to leaders, we are pushing through. And it's not only the local stocks, the offshore stocks that we have exposure to are also growing. And the one variable to focus on there is where that exit bond finishes. We've got it at 10.7. We're seeing a lot of leading economists saying it's lower. We want to be cautious. But with that, from where we stand now, we still believe the sector can give you, call it 13 to 14%. We've got a track record of beating that after fees by 2% over the last, call it 14 years. And we believe, call it 15 to 16% is definitely at least neutral in your portfolio. Thank you very much.
But before we break for lunch, want to check if anybody's got a question for Evan. Right. Ed, let's just get a mic through to you quickly. And anybody else while we get a mic there? Not yet.
Well, thank you again. Evan, definitely not your first rodeo here, so welcome back.
Thank you.
Ed from Edge in Port Elizabeth. Just a very simple question. I stayed at Radisson Sandton on Sunday night, and I've noticed that there's a lot of vacant space in a lot of the buildings around there, including the Radisson. There's all of those townhouse developments around there that they're now starting to demolish again to do new commercial, primarily office, from what I've heard, A to AAA rated office. And that is very concerning when there's already a lot of existing space, and now they're going to be adding a lot more in that area, and it looks like a lot. Now, my question really would be, so you've got your older school generation, your growth points and what have you, that are doing the majority of these developments, the retail developments there, as opposed to you take your Midrand and the amount of warehousing and smaller retail space that is going in there, which is not your growth points. It's a little bit more of your newer generation type property companies. Now, which would, if you're looking at longer term, which are the ones that you are in favor of, and why? Are you more in favor of your growth point, or maybe some of your newer generation, your tax and what have you?
Okay, it's obviously a very detailed question on that front, but Growth Point is as cheap as it's ever been. There's no doubt about it. We liked it for the first time in the last 7 years. We actually went overweight Growth Point at the beginning of this year, and it paid off. It rallied 10%, and we started to neutralize some of that. But the truth of the matter is it's very cheap. Do I like the underlying assets? Not really. The local assets, besides the waterfront, they do struggle. They've got too much A-grade office. The prime grade office, Sandton's a very difficult node to operate. If you look at the vacancies in Rosebank and Bryanston, if you look through in the Western Cape, much, much lower. Historically, there's been an oversupply in Sandton, but if you look at the vacancies, generally speaking, it's a lot of that black brick B-grade asset. The prime stuff, if you look at the vacancies in prime, they've gone from about 12.5 to about 7. So it's looking a lot better in that space. Obviously, Sandton's not faring as well as the other call it regions, because of the excess supply. I'm not sure exactly what they're building. I know it's definitely not a listed player. The last listed player to develop office has been Attack in their Waterfall precinct, and they generally don't do it on spec. And if they do it on spec, it's very little kind of niches that they'll do on spec, and they've done quite well out of that. But if you ask me personally, if I had to pick asset class, so not on a valuation, I do like specialist asset classes, and I would, at this stage of the game, I would prefer, call it convenience retail, or I would prefer bigger logistics. So office, unfortunately, is not my kind of point of call. However, in the Western Cape, there is a great potential for that to increase in value. But office, generally speaking, unless you get GDP growth, you're not going to see excess demand, and you're not going to see a tightening of the slack on rentals to push it.
One more very quick question, if you don't mind. Where do you see the risk in specifically the retail space, and I'm saying your smaller retailer space, or retailers that specifically have possibly gyms, takes up a lot of space, high risk, very competitive area, as well as your retailers that have your cinemas in. Would you see that as being primarily some of your higher risk within that retail space?
I'm not seeing at the moment significantly high level risk in the retail space. Obviously, EdCon was a big issue when it came through because they had a huge footprint. And it was very difficult to fill those deep boxes. We saw Pick and Pay, but Pick and Pay wasn't in a business rescue scenario, and I think what they did with the capital raise was very prudent. Yes, we are seeing struggling tenants. There's no doubt Ster-Kinekor is giving back a lot of space, but funny enough, there's quite a lot of interesting alternatives. So, for example, redefining Centurion Mall is expanding the exclusive books into, I think, about a third of the space, and that will cover the entire rental that we're getting from Ster-Kinekor. Remember, Ster-Kinekor has pretty much given you nothing. Over and above that, they're going to use the balance of it for more entertainment. It's one of these kind of ninja for kids and for adults. But nonetheless, it's a little bit of my punt for them. But they're also building them there. So guys are coming up with ideas to fill the space. I don't have an issue on the tenant side. My concerns maybe further down the line is that I did point to government grants. How sustainable is that into the medium to long term? I don't think it's a short-term issue. And that would be a concern, more of a systemic risk for South Africa. But retail, that would be the biggest concern. But really, at this moment in time, I don't see any glaring issues in the retail space. It's just maybe calming down because we've seen a lot of growth coming through on the rental side and more of an inflation-linked growth that we see going forward.
Evan, last question, answer in 30 seconds is from me. In a flexible portfolio where you have control over onshore and offshore, we're familiar with your SA property fund, you've got a global property fund. How would you position that in a flexible portfolio? More local, more global?
That's a great question. So we do run a flexible property fund where our mandate is, the benchmark is 60 SA, 40 offshore, developed market offshore. At the moment, and funny enough, from the beginning of the year, we've been overweight SA, and rightly so in that regard. So again, what we find is that, yes, we have issues, but the world has issues, and we mustn't get bogged down. We're looking at the opportunities, and we actually are still overweight in our in our balanced portfolio. We're sitting about 63% in South Africa, and we're sitting, obviously, the balance 37% offshore.
Thanks a lot, Evan. Enjoy. See you all back here 12:15. Thank you. Thanks, Evan. Right, thank you all for coming back in. I really hope you enjoyed lunch. For the online audience, you can maybe send us your recipes, what you had for lunch, and we can try to incorporate that next time. Thank you so much. We're going to continue with fixed income views, and we've heard some comments earlier in the morning how fixed income is really very, very attractive at this stage, and it may very well stay there. But I'm not going to steal the thunder. We've got the experts on stage, but here to introduce the panel, our moderator, Yunel Mattia Ferreira. Yunel, thank you so much for joining us. Head at Multi-Management and Investments at Cogence. Yunel, thank you so much.
And I'm very glad that they kept the most interesting panel for after lunch. I know you're going to be entertained. We know that bonds over the last 1 year, 3 year, 5 years, double-digit returns. I know there were some of the previous panels and they asked, why don't we move all our money and allocation to fixed income? So very glad to be chairing this panel. Just quickly introducing the panelists to you. Sydney McKinnon from Cadiz, JP du Plessis, Methodical, Jonathan Myerson, Vijo, and Bruce Pizzle-White from Oakhaven. I know when we started this year, our view indeed was it's going to be an interesting year, it's going to be a volatile year, and you'll have to be nimble, granular, and tactical allocation is what you will need to do to add value. I don't think anyone expected the volatility we've seen. Then there's tariffs, then there's not. I don't think Trump has woken up, so we'll see what he changes today on China, Mexico, Vietnam. There was some news yesterday. And even locally, usually locally we're sometimes a bit protected, but from the government of national unity to having VAT, not having VAT, and we know that that has got a huge influence on fixed interest opportunities. as well. And volatility, uncertainty, it's definitely not easy to navigate through. That's why I'm very glad that I'm an asset allocator and I've got people on the stage that allocate that money. But we also know with the uncertainty and volatility, there's some great opportunities. So Sydney, I'll hand over to you to just take us through some interesting insights on how your portfolio is positioned.
Thank you. Thanks, Janelle, and thank you, BCI, for having us. I really appreciate it. It's always good to be here. Right. I'm here to talk on fixed income and our views on fixed income and the opportunities in the fixed income market. And I promise I will. But as you've all by now seen in the last couple of months, we've had all this volatility in the markets and all of these sentiment-driven issues that have been driving markets. So I've entitled my presentation, Fear and Greed. And I think I'm going to focus on the fear because I think we've been feeling quite fearful in the last couple of months. As Morgan Housel puts it, he says investing is not just about the money. Investing is about our relationship with greed and fear. And I think one of my colleagues from Coronation this morning was mentioning fear. This whole fear thing came up over and over again. And most certainly it's been proliferated through our markets, not only the fixed income markets, but generally through all the asset classes. But let me focus on the fixed income side of things. You know, I thought, okay, how do I quantify this fear? Because everybody's saying, we're worried, we're fearful about things. And the closest I could get was to an index from CNN. We can look it up on the net, it's quite easy. And they use about 7 factors, input factors such as market momentum, market volatility, and junk bond demand. And they put this into a system. And last month when I submitted these slides, that was sort of around about the 3rd or 4th week of April, we were firmly in extreme fear territory because of these indicators. I must say things changed very, very quickly. When I looked at this index last night, we were in greed territory again. So I've quite a few of the speakers this morning explained how quickly things can turn around and change. But to quantify it, and I was thinking, why are we feeling so fearful? Why are we feeling so fearful? And I was not short of issues to make us feel fearful. We've had the Trump administration, we've had geopolitical uncertainty, policy changes, interest rate changes, and of course the tariff wars, everybody's talking about it this morning. And then bringing it home, we had our own budget bungle. I call it the budget bungle. We're hopefully going to have one now on the 21st of May, and it will be the final one. And of course, we've had a VAT roller coaster, not to mention the government of national unity, which and the shenanigans around that, as was explained earlier this morning to us. So what I did was, and I said to myself, look, fear and risk is very closely related. And I went back to the World Economic Forum Global Risk Perception Survey in 2024. And at the beginning of last year, we were more worried about the weather than really about geopolitical events. And then the beginning of 2025, suddenly this changed and state-based armed conflict became a lot more prevalent on our radar in terms of the risk perceptions. But we were still worried about the weather. Geo-economic confrontation only made about 8% of the survey at the beginning, and that's the beginning of this year. If we break that down in terms of the survey that they did over the next 2 years, geo-economic confrontation, which is what we've been experiencing in the last month or two in extreme sense, only makes number 8 on the list. This wasn't too long ago. This was earlier on this year when the survey was done. We're still worried about the weather, and we're worried about the weather for the next 10 years as well. So let me look. I thought let's just calm down and let's look at the fundamentals, because a lot of the market at the moment is being driven by sentiment, and it's not being driven by the hard data. And in our fixed income market, I think it's very, very important to understand that hard data and the way in which it's driving our fixed income market. I always say that our fixed income market is driven by a myriad of factors. It's not just one factor. There can be a hot button or a hot event that happens at any one particular point in time that will move things for the short term, but ultimately it's the hard data that shines through. So from a global perspective, I'm just going to look at 3 factors, and in the local perspective, I'll look at a few more and then tie it together. But we've seen global growth moderate, and it's expected to moderate as well, as we heard this morning from a few of the other speakers as well. But of course, the trade barriers that have been put in place, the uncertainty of policy surrounding investment demand is creating a bit of tension in the growth space. But in essence, ultimately, that's keeping a lid on growth. And of course, this word of heightened uncertainty comes up over and over again. And if we experience further trade fragmentation, which could be very real, up until yesterday, we had a lot of tension between China and the US, and that seems to have settled to a degree. But with global growth being as subdued as it is, it could keep a lid on the yields that we do see. The International Monetary Fund also does growth projections. And in 2024, they said global growth in 2025 is going to be about 3.2%. Beginning of this year, they downgraded that to, I think it was 2.8%. So most certainly there is a lot of muted growth expectations, but also there's divergence in those expectations as well, especially between developed economies and also emerging economies. And even within the developed economies and the emerging economies, we're seeing policy gaps. Trade measures that are quite uncertain, and weakening sentiment across the board as well. The other economic fundamental I want to have a look at that's driving our fixed income market is obviously inflation, and the projections that we're seeing from headline inflation, and this is taken from the OECD report, interim economic report that was done in March this year. They were saying that inflation paths are a little bit higher than previously expected for a reason, because we are seeing trade costs potentially going up. I mean, I think it was explained this morning, Trump went in very, very hard, but it's still 30% to China and it's 10% on the other side. So it's not gone away completely, and we only got a 90-day pause in which there will be negotiation. What happens after that, I think, is quite important as well. So potential for inflation, even though it's trending down from high base effects, to be a little bit stickier than anticipated. And so you have these two opposing forces. You have global growth that's maybe keeping yields down, and you have inflation potentially could be sticky, that will potentially push yields a little bit up. The third fundamental that I'd like to talk about very briefly is monetary policy, because I think this is quite important, and it's very closely related to inflationary pressures, but we do see quite a bit of divergence once again between developed markets and emerging markets, where the expectation is for rates to remain stable or to come down. For example, in developed markets, we saw the FOMC hold rates steady with the last meeting, but there's great expectation now that we'll see, especially after yesterday and last week's events, we'll see a 25 basis point cut in September and again in December in the US. But of course, there is disparity between emerging markets and within the developed markets. I think of Japan and countries like Brazil and Mexico, where you have perhaps a lot more other factors at play that could drive rates either way. So monetary policy is quite important, because that's going to dictate how rates are going to be, at least in the short term. From a global perspective, we are seeing monetary policy being applied to a degree that might hold rates down a little bit. Then bringing it home from a local perspective, our growth is fairly subdued as well. Even though we have seen a bit of a rebound in agriculture and consumption, household consumption picking up, and we've seen Eskom keeping the lights on, so we have increased production and consumption of electricity, our economy is still pretty fragile. We know this. We know the fact that we've got high unemployment, we've got high or low business confidence, and consumer confidence is quite low. So theoretically, our growth, global growth, our growth should keep a lid on yields as well. Our inflation, it's coming off a very high base at this point in time, but it's fairly muted at this point in time as well. And the reason why I mention inflation, because within yields, especially yields like bond yields, expected inflation is embedded in those yields. And we've seen inflation being fairly benign at this point in time. We're losing the high base effects, so that might not always be the case. But of course, inflationary pressures, if it does rear its ugly head abroad, and as a result of the tariff wars that's going, or tariff tension, then we could see a bit of inflationary effect on our side. There's one component of inflation that is quite stubborn locally, and that's food inflation. I've got the little picture up there that shows which prices of food have gone up. I think we just got to watch that component quite closely. But overall, looking at the hard numbers, it's also keeping a lid on yields at this point in time. Our monetary policy, from a local perspective, and our MPC have said at their last meeting that there's upside risk and downside risk to inflation. I just think it's a way of saying we're not quite sure where we are at this point in time. But and they've lowered their GDP forecast as well. So low and stable inflation, benign inflation, is going to also dictate the path of our monetary policy. So I think it's quite possible or very probable that we will see a rate cut at the next MPC, which happens at the end of the month, as opposed to the Fed, who's taking a more sort of wait and see, let's see if the dust settles. I mean, that we've seen being said by the governors and alike. In terms of our fixed income environment, it's always driven by another factor, our currency, and plenty of events have evolved around our currency over time. We've seen our currency strengthen lately, but we're not immune to the shocks around the world, whether that is the introduction of tariffs, whether it is our GNU not deciding on certain issues, whether it is our budget bungle, whether it is a VAT hike or not. We see our currency being susceptible to that, and then alongside that, it tends to feed through to the volatility of our yields. A small word on credit spreads, because that all affects our fixed income market. I'm just trying to fit in all the factors that influence our market at this point in time. The credit environment, the yields are still fairly, very low at this point in time and compressed at this point in time. Supply or demand is outstripping supply at this point in time. I think funds are selling their soul for yield. Everybody's searching for yield, and it's very, very difficult to find it in the standard place as far as credit is concerned. So I think an environment we've got to just be very careful of, but not careful, but also not careful, but also need to keep an eye on how that develops going forward, because credit spreads are exactly that. It spreads above a base rate such as JIBAR, for example. I think once we see those credit spreads start to widen, but it will also take an event for that to happen. Yield curve is something that we all look at as good bond fund managers. Is there value in the yield curve? If you ask a bond manager, he's going to tell you, yes, I do think there is opportunity in the bond market. We heard this morning, I'm not going to repeat any presentations, but we heard this morning there's potential for very good returns to come from the bond market, especially if we do see bull steepening as a result of interest rate cuts and the like. So, what does that mean in terms of us at Cadiz? I can speak to you a whole day about all these economic fundamentals and monetary policy and liquidity and valuations, but we have to make it real. So what we do is we pull this into our investment process, and this chart on the screen is really just the output of it, or the consequence of it. Bars above the line indicate that we have a little bit of we have a bullish tendency, and bars below the line indicate that we have a negative tendency. So at this point in time, yes, we were quite bullish last year. The beginning of this year, a lot of those event risk issues started creeping into our process, but we're starting to work through that. We're seeing through that, and we are actually starting to see a little bit of bullishness return to our process and to the way in which we position our portfolios. That you can see in our funds, such as our Enhanced Income Fund. I will not dwell on it. Our Absolute Yield Fund, you can go and have a look at it, and all our thinking is embodied in those funds and portfolios. So all that's left for me to say is thank you, Nzakenza in Tsonga, and because they are celebrating 100 years, baie dankie. Thank you.
Okay, good afternoon, everybody. I'm going to talk to you a bit today about asset allocation. I was going to focus very much on how I added value through asset allocation in my funds. But I went to a conference last week, and sitting in a chair like yours, I thought it was a great opportunity to really think about the bigger picture and think about what are the factors that are going to be driving where you want to be allocated over the longer run. And some of these big pictures. So what is the big picture? Health warning, this is not a death by PowerPoint slide. This is the only PowerPoint you're going to see, so look at me. So what are the big picture things that really are going to affect us over the next 10, 20, 30 years? Now, 10, 20, 30 years is a long time, but I think we are at a point where we're seeing significant changes in our investment landscape. I guess people always say that, but this time I think it is different. So the three things I'm going to talk to you about today are demographics, deglobalization / tariffs, and AI. So I went to a conference last week, and 60% of the presentations were about AI. I don't think that's the case here today, but at least one of them has some AI. So let's talk about demographics. Now, demographics is generally not a great investment case. It's generally, it's been used as the argument for investing in Africa for the last 20, 30 years on the basis that we have the so-called demographic dividend. But there are some very, very key demographic changes which are happening in the world. At the moment, there are 1.4 billion people in China. By 2100, we're going to have somewhere between 500 and 550 million less Chinese. Just think about that. That's an incredible shift in the space of the next 75 years in the population. If we go to the kind of developed world, US, Europe, we're seeing the baby boomers. Who are the baby boomers? The baby boomers turned 60 last year. The last of the baby boomers turned 60 last year. It's the sort of bulge in the demographics of the developed world. $83 trillion is what the baby boomers are going to be handing down to the next generation. At this stage, you're probably thinking, I wish my parents had done better. $83 trillion is going to be handed to the next generation. Interestingly, and I hadn't thought about this when I was doing the research, is that actually it goes sideways first. So it actually gets handed to the wife first. So I'm sorry, the guys in the room, unfortunately we don't live as long, and therefore the wives will inherit that 83 trillion before it gets passed down to the children. And what effect does that have? So remember, the baby boomers are now 60 plus, they're in retirement, their outlook to investments is changing. You have to look at the distribution of those investments, because obviously if you're extremely wealthy, you're thinking about legacy. If you're not that wealthy, you're starting to de-risk your portfolios into more kind of fixed income type assets. And when that money gets passed down, the majority, in that process of passing it to the wives, we end up with the majority of developed world investors being women, and women are going to have a different attitude towards investments and risk. And then when it gets passed down to the kids, they're going to blow it all. No, well, they will blow some of it. They're going to be consuming. Their view on investments is different to their parents. They're looking at things like ESG. They're looking at things like cryptos, all those type of things. So it has very real effects on those economies. Remember that in the US, 70% of US GDP is the US consumer. So it has a significant effect on consumption and investments. And if we think about South Africa, we have I guess the demographic curve that you'd like to see, but you've got to think about what that demographics looks like. You need to have the flexibility, the skills to take advantage of that demographic dividend. We also have an interesting savings pool here, where a lot of the savings is becoming older, and we've got similar issues to what's going on in the US in terms of how that's going to translate to the next generation. So that's. Oh, sorry. I wasn't going to show you another slide. I forgot about that. So the next thing is deglobalization. So obviously, everybody has to, every presentation has to talk about Trump. But actually, deglobalization has been happening for a bit longer than Trump's inauguration. What we saw in the early 90s is that China wanted to export T-shirts and hats and all, lots of stuff to the rest of the world. They depressed the value of their currency, and they ended up being the manufacturing base for the whole world. What's happening now with the changes in China? Obviously, they got wealthier. The population got wealthier, and they looked to change the nature of just being a producer of T-shirts and caps and things for Amazon, and going up that curve. So that already started that process, and then along came COVID. So COVID exacerbated accelerated this a little bit, because suddenly global supply chains were an issue. Suddenly you couldn't just import the parts that you needed from China and make them in America or around the world. An interesting fact is that 50% of global trade is done intra-company. So it's done within Amazon, within Apple. 50% of global trade is done within companies. What that means is that potentially, those changes can happen quite quickly. You've got a relatively small number of decision makers who are thinking about optimizing their profits for their shareholders. Tariffs obviously have come along and are probably going to accelerate this process of deglobalization. And what that means is that a lot of the dividend that we got from globalization over the last 30 years, which was cheap cost of capital, because remember, the Asian economies, principally China, were growing incredibly fast. And they were growing fast with very large saving rates. So we're taking those savings and placing them in US Treasuries and depressing the cost of capital. The other thing that happened is globalization reduced inflation. It was disinflationary. Because if you think about it, in a world, if you go back 500 years, if there was a drought in your area, the cost of food went up. Now, if there's a drought in your area, you import the food from somewhere else. It comes from Brazil, or it comes from somewhere, another country. And that process of globalization reduced the costs. There's also this concept of comparative advantage, and that's going to go into reverse. So deglobalization is disinflationary. Deglobalization is inflationary, but it doesn't necessarily happen all in a straight line. And there's some other factors which will be potentially driving that. But what we will likely see is greater volatility in inflation. So we're going to see bouts of inflation being higher than we wanted, and inflation being lower than we wanted. And then the last point is AI. AI is going to change all of our lives. I don't know how many people in this room use AI on a regular basis. Anybody? A few hands. But it's going to become ubiquitous. How many people use Excel? Much more. Okay. So AI is going to be at the very least a type of Excel. It's going to increase productivity. If you think about what you can do today versus what you could do 20, 30 years ago, it's going to improve productivity. It's going to improve processing power. So I'm talking about all the good things first, and then I'll talk about the bad things. It's increased process ability and of people to do tasks and productivity, and so that's great. It's also going to have significant impact on medicine and improving longevity in people's lives. The research on medicine, all of those things are great. The problem with AI is that the increase in productivity means you need less people. And so people are going to be made redundant. Now, the positive spin on that is that pretty much like, the example is always given of the ATM, the automatic teller machine. And there was always this thing, well, where are all these tellers that were sitting in banks going to be going? And in fact, there are now more people who work in banks than there were before the automatic teller machine came around. So the point there is that you need to find other things to do, and we will find other things to do. The problem is that the pace of change is so quick, is so fast, that there is going to be a significant friction, as it's called, so unemployment in that process. And that's going to have political implications, obviously, for, for when you have unemployment. We talk about things like universal basic income grants. But, people want to feel like they're contributing. So I don't think just living off a grant is the way that the people want to live their lives. What AI also means for South Africa in particular, if we kind of compare South Africa to the developed market, is that the risk is that we become even less competitive. Because if the developed world embraces AI, embraces the efficiency, the productivity that we see that can be achieved through AI, then we're going to fall behind. I mean, I was unlucky enough to be in a police station. Don't worry, I wasn't arrested for anything a few weeks ago, and there wasn't a laptop in sight. Okay, so they didn't even use computers. Everything was handwritten out on a piece of paper. Well, when you're competing as an economy against economies that are using AI and generative AI, it's going to be tough to compete in that environment, and that's what we're going to be competing against. And remember, asset allocation is about taking investments and putting them into productive economies and productive companies to grow the economy in general. So think about that in the context of what we're doing out there. So that was the 50,000-foot view of the world and asset allocation. Thank you.
Thanks, JP. Thanks very much. Thanks, JP. That's great. It was a great introduction into my presentation. I'll be talking about unlocking income, and really what I've taken out of JP's presentation is really what you need in the current environment. And going forward is you need to be adaptable, you need to be flexible, you have to be able to move with the times. And what I'm going to try and kind of suggest to you that for the purpose of unlocking income, the old traditional income fund, which is floating rate notes plus credit, is not an optimal solution anymore. It hasn't been for a few years now. The second leg to that is that index investing or passive investing in South African bonds or fixed income is not a good idea. And kind of following out from that, obviously, is the fact that you want a solution, if you can call it that, which is unconstrained, it gives you the flexibility and doesn't put you in any specific block that ends up being inappropriate for your income objectives. And what I've done here is I've just put a summary of the different asset class performances and ASISA categories. And you wouldn't be surprised the ranking is pretty much what you already expect. Equities do well over time. This is since 2013, I think, on an annualized basis. And what I want to kind of turn your attention to is the income producing assets within this asset class kind of breakdown. And to demonstrate that the kind of dark blue bar, which is the BCI Unconstrained Fixed Income Fund, has been able to generate the type of returns from income that you would expect from other asset classes, and do that at a low volatility. So, this is kind of a prelude into what I'm going to be discussing and broadening on. But there's another one little angle here, is that actually when you look at this ranking, you're starting to realize that you want more of this type of fund in your South African balance fund. But that's just a kind of a by-the-way takeaway that you would like to, I think you should consider going forward. And how did we get that bar to be where it is essentially an active management of income, of the different income components. So really, at times, and I think going forward, 100%, to the point of you need to be able to change these asset allocations on the basis of where you are in the cycle, A, and B, what are the structural changes that are taking place that JP spoke about that you need to, to adapt to. And you need to do that in an environment where you've got the liquidity, you're relatively nimble, and you've got a long-term kind of objective and you know what that objective is. So this is just a demonstration of the unconstrained Visio BCI unconstrained fund and how it's kind of navigated the different sub-asset classes. So how do you do this? Is like this fixed income risk spectrum chart shows you the different ASISA categories that you can invest in. And obviously, you'd be familiar with the risk-return kind of chart. And the point to be made is that the ones on the right, the nominal bonds and the inflation-linked funds, are actually type of funds that you can invest in passively. You get the all-bond index, you get the CELI, or what's called the CELI, which is the inflation-linked index, and you can essentially match that by buying an ETF on that or the index. As you go further to the left, you can't replicate an income fund passively, and you can't replicate an enhanced cash or a money market fund. Even though there is a money market index, it's not replicable. So to the right, you can replicate, but you lose out on that kind of opportunities that come from the left side of the opportunity set. And really what you want to do is you want to look at the full income generating asset opportunities to get those kind of objective returns that you're looking at. And the first set of income generating assets are what we term the vanilla ones. And just to make the point around fixed income, very much as opposed, it won't be new to anyone as opposed to equities, there's more complexity. There's a much bigger set of opportunities in the fixed income market. That is because this set of vanilla instrument that I'm showing you, which is fixed income, so fixed rate bonds, floating rate bonds, inflation linked, and the money market instruments are issued by a whole lot of different companies, governments, SOEs, and on top of that, they are getting issued on an ongoing basis. So there's a list of well over 1,000 different bonds that are listed on the South African, on the JSE. So the set of opportunity is huge, and that already gives you an indication is that you can't cover that in an index. Okay, so that's the first point to kind of focus on. I just wanted to also draw the attention to the fact that in this traditional income fund that I spoke about, which is this floating rate plus credit, the floating rate bond or the floating rate note is the most popular. And the reason for that is that it's kind of gives you a relatively stable income flow and with relatively low interest rate volatility. So you get that really nice smooth line and the drawdowns are very limited and so on. But if you were to invest passively to the extent that you can in these different instruments, or invest in your old school, I'll call it that, income fund, you'd lose out on a whole set of non-vanilla opportunities. And I don't want to kind of get too technical here, but essentially these non-vanilla instruments, if it's derivatives, if it's certain structured products that do use also derivatives, they allow you to essentially modify and structure your future cash flows that will meet your performance objective. So you can take anything from the left, put it on the right, and change the kind of, or you can tailor it towards your requirements for your fund. Now, one of the problems with investing passively is the fact that the underlying index that you invested in can change. And what this chart shows you here is what we call the modified duration of the all bond index back to the early 2000s. Can't see, I think it's, the early 2000s. And if you were to invest passive over that period, your interest rate sensitivity would have changed dramatically. In the early 2000s, for every 1% move in interest rates, your capital value change would have changed by about 4 and a bit %. In 2017, it was almost double. So you're thinking that you passively invested in an asset that you'd hope to give you some kind of return characteristic, but in fact, that's not the case. The second part of it is the fact that there's been a material change in the makeup of the South African bond market, and government bonds have been dominating for the last 10, 11, no, probably as long as 15 years. And basically what you can see here, that in 2000 and, I think it was about 2007, 48% of the investable universe that you would be interested in as an income investor in those funds was, of the whole market, was in that type of asset. Today, it's gone down to 28%. So 28% of the market is now made out of that asset class that you would have wanted to buy previously. And what it meant is that the supply, that's that blue line at the bottom, of that credit that feeds your traditional income fund, has been relatively flat because government has basically crowded out the private sector, and credit and non-government bond is like there's a shortage of it. And demand that comes from the multi-asset income category, which is a very, very popular category for good reason, has increased materially. So typical great kind of Ecos 101, demand strong, supply is kind of limited. The price that you pay for that bond is higher. And if the price you're paying for the bond is higher, you're getting a lower spread to reach your objective over that credit. So what you can see what's happened, and we took the kind of senior unsecured bonds from banks, 5-year maturity, and seen how they've kind of performed over the last 12 years or so. And you can see that in the early days you could get it at Java plus 175, now you're down to 105. So you're already getting a significantly less kind of compensation for holding this type of asset class that is the bread and butter of your traditional income fund. What's more is that over that period, the equivalent spread on government bonds on a floating basis, which from a credit perspective is the best you can get in the rand-denominated currency, is actually higher. So you should have adapted the approach from being focused on credit and moving on to a broader set of opportunities. Now, so kind of the key takeaway is really that market dynamics change, and they will continue changing, and you need to have adaptive thinking. You can't be stuck in one of those buckets in the income component. Meeting return objectives, you do need non-vanilla assets that you can't get in the kind of passive environment. You need liquidity, so you can't buy too many of one type of asset, and you want to make sure that you always have sufficient liquidity in your funds to generate that targeted return that you want in the changing environment. And there's no credit index in South Africa, and we can go to, and there's a long reason for that. So, what does it mean for us as a unconstrained fixed income manager, and what is kind of succeeding in this objective of kind of providing that targeted return, is that what we want to do is we want to be sure that when the market does well, and for this you certainly need the adaptability and the liquidity that the fund should offer you, you want to, you can accept not doing as well as the bond market does in bull markets, when the market is particularly strong, but you want to ensure that during the weaker components, particularly for an income fund, you don't participate too much in the downside, and on average you do better than that. So you give your targeted return with essentially what it means with materially lower volatility. And I'll leave it at that, and I'm happy to pass on to the next speaker.
Good afternoon, everyone. I'm Bruce from Oakhaven. We're just a boutique fixed income house. And my presentation today is about, can you get fixed income returns that beat inflation? So I think the main thing to realize is back in 2000, the Reserve Bank adopted inflation targeting, which is actually probably one of the things that brought a lot of stability into South Africa's fixed income. Most of our data sets, we look from 2003 because that's when they actually defined the 3 to 6% range. and that achieved lower volatility. Now, the main thing I want you to take out of this presentation here is that a low base year forms a high base year into the next year, because what happens is you deduct the previous month on month and you add the new month on month. And so what transpires from that is you actually get higher inflation the following year, just based off that. Now, inflation obviously is a very important consideration for yourselves because it erodes purchasing power, and you need to maintain real growth and real wealth. So the main inflation drivers are really there's a volatile and a stable component, and you'll see that there are three bars there. There's the yellow bar and sort of the light blue bar. Those are your volatile ones, which is really your food and oil, i.e. food and transportation. The rand obviously does come into that a little bit as well, and then you've got a large impact which is more stable, which is your housing and your administrative prices, which is your dark blue line, and you'll see that's pretty consistent through the years. So you've heard a lot today about lower growth and higher inflation, stagflation. If stagflation does play out, what it does mean is you don't get a portfolio effect between bonds and equities, because what happens is you lose on both. So income funds actually will generate a better return if that scenario does play out. So one of the things we need to understand when we're talking about how do we perform against CPI is how does the Reserve Bank set its base rate, and that's the repo rate. Now, the important thing here is that CPI is what they obviously want to target, and the main thing that they're trying to target out of CPI is a real rate of return, which they call R star. Now, at the moment, they're somewhere between 2.25% and 2.75%. I've just used 2.5% here. But that's more or less the real rate of return that they would like you to return, that you would receive over and above the repo rate, call it your call rate at the end of the day. So historically, if you take repo minus CPI, inflation's averaged 5.3% and your repo rate has actually averaged 6.8%. So historically, your R star has actually been 1.5%, which actually would make sense. Because in a low growth environment, what you need to do is try and stimulate a little bit of economic growth. And so to try and have an R star of 2.5% is actually very, very high. Now, one of the things that we currently have, and if you're invested in an income fund at the moment, you're doing really, really well out of it, because obviously you're getting 4.8% because your repo rate is at 7.5% and your inflation's at 2.7%. So what you got there is you got this anomaly at the very end of at the back end there, where at the moment we have this 4.8% real rate that you're able to achieve over and above a call rate, over and above CPI. Mean reversion tells me that won't last. At the end of the day, what we're going to have at some point in time is rates are going to come down, inflation's going to come up, and if the Reserve Bank's able to get that back to 2.5%, I think that's still on the high side. So one of the things we need to bear in mind is when we're looking at income funds, generally what they benchmark themselves to is a STEFI return or an inflation plus return. Now, it's very important to understand that the STEFI is sort of a composite of instruments out to 1 year, and your income fund should outstrip a STEFI return, because ultimately they can invest further out than 1 year. They can invest out to 5 years. The only constraint really is that they've got to have a weighted average duration interest rate risk of less than 2 years. So from that perspective, when we're looking at an income fund, we should say, well, the curves are generally always upward sloping. When you're looking at interest rates and liquidity, you're able to extract more value further out on the curve, and so they should achieve a return greater than CPI. So what you see on the graph there is you see a CPI index return from 2003. You see if I use 1.5% above CPI, and then if I use the STEFI. One of the things you'll notice is obviously a little bit of a hockey stick that's coming in at the end of the STEFI at the moment, and I think that comes back to the fact that we've moved away from vanilla products and we've moved more into products that are more dynamic and can enhance your returns ultimately down the line. So I think the important thing there is that not all income funds are the same, and therefore, as you know, you get a top quartile and a bottom quartile of funds as per any collective investment scheme. So what I've taken here is I've taken the average, which is your 50th percentile, And what you'll see from that 50th percentile is that over the last 20 years, the CISA income funds have outperformed inflation by 2.2% per annum. And what they've done is outperform the STEFI by 0.5%. The 5.3% is what we're looking at this year, which is this traded opportunity that you can get at the moment. So this traded opportunity at the moment is you can either go and you can trade it now and you can go buy a JIBAR-linked paper or whatever the case is, and you'll make some money. But what we're advocating is that you actually look out to go further out into the horizon. And one of the things that we're looking at is inflation-linked bonds, because what you're able to achieve here is you can go buy a 5-year bond at CPI plus 5%. So I'm not just going to buy this opportunity for 1 year. I'm actually going to buy this opportunity for 5 years. And that opportunity over 5 years will therefore derive a much better return than the vanilla income funds that are now generating a return off a base of JIBAR at the end of the day. So it's just to understand inflation-linked bonds, they trade at a yield to maturity like most bonds. So the important thing here to realize is back when when we started inflation targeting, you'll notice our yield to maturities were around the 4% range. Then in the mid-2015s, you'll see that they came all the way down to 2%. And then where we're trading at the moment, we're trading up at 5%. So if you look at that worm, you'll see that the worm has a really good high increase when yields are high, and obviously when the yields are low, that little worm is a bit flatter. And then at the end again, when the yields are nice and high and juicy, you're actually getting a good compounded return again. So from our perspective, what we really like is that what this does do is it gives you a great capital hedge because it's linked to CPI. It obviously it diversifies your protection because most of the income funds are linked to vanilla inflation JIBAR-linked paper. And it's a very relatively low risk. Now, there is a lot of duration to these bonds that we do buy, but at the end of the day, they're linked to an index which changes every month. So from that perspective, you will be able to, it will reprice every month based on what inflation is doing month on month. So the key here is obviously entry level, and the entry level at 5% we believe is a really good point. I think if you look at your most aggressive funds out there, and this is including equity funds, your most aggressive funds will like to benchmark themselves to CPI plus 5%. So in an income fund at the moment, you can actually get CPI plus 5% without having to go into an equity fund. So from that perspective, you are able to outperform the CISA category returns, which are currently around 2.5%. So just bearing in mind what I referred to earlier when I spoke about the low yields in the middle, what you're seeing here is you're seeing the inflation-linked returns year on year since 2003. You're seeing the interest component, and then you're seeing the mark-to-market component. Now, the mark-to-market component is when I go and buy an inflation linker at 2% and it moves to 5%, I'm going to lose on that trade. So that's why you're looking in the mid-2015s there, you're looking at negative mark-to-markets, which obviously impacts your return in the fund. That's why we at the moment are saying, well, this is a good time to enter into these CPI, these inflation-linked bonds, up at 5%, because over 5%, your chances of a mark-to-market loss are that much less. So the reason why there's this arbitrage at the moment, there's twice as much inflation linkers out there as there was in 2016. They make up 21% of South Africa's national debt. And nominal bonds are obviously under the same pressure from an issuance perspective, but the amount of interest rate risk that you buy with a nominal bond is that much more because they are fixed to maturity. They are not linked to an index. And lastly, one of the good things about these bonds are if we ever do get to a scenario where we become in Turkey or an Argentina type scenario, what generally happens is your inflation goes, you get hyperinflation up to 70%, your overnight rates only go to about 50% of that. So in that scenario, your overnight rates only go to 35%. So what you do get is you're getting double the amount of return out of this kind of a product versus a product that's linked to a repo base rate. So just if I look at our core income fund, we've been able to outstrip inflation by 4.1% since we started. One of the things about our fund as well, if you look at the volatility, it's a really low volatile. In actual fact, you can compare our fund to the Albi fund, which, as has been pointed out, is the nominal bond fund, which will have a lot of volatility. We've been able to produce the same type of returns as that. There what you'll see is the inflation and what the STEFI has returned. And just lastly, a couple of awards that our fund has actually got over the last couple of years. That's all. Thanks very much.
Thank you very much. Yeah, I think we know inflation reached the lowest level in quite a few years at 2.7%, but we all know when we go to the shops, we don't really see and feel it. So maybe, Bruce, just a quick question to you. Do you really think the lower inflation target over a longer term period is possible? Because we are quite reliable on a volatile currency, oil prices globally. What level do you think is realistic between the 3 to 6% target we've got?
So the Reserve Bank will tell you they're targeting 4.5%. So they want inflation to get back to 4.5%. So what the Reserve Bank will do is they will drop interest rates to the scenario that they to the situation that they get to 4.5%. That's what they want. Now we know that they're looking at reducing the inflation target from 4.5% to maybe 4%, maybe 3.5% or something like that, so that we're closer to our trading partners, which target 2%. But at the moment, and this is what they tell you, is that they want 4.5%. So we are of the view that inflation gets back to 4.5%, and therefore, to get back to that, we think that they'll be cutting the repo rate.
Thanks. Jonathan, maybe of all the different opportunities you've got to invest in, which of those, duration, credit, is the most attractive to you at the moment?
So I think it's a combination. So first, I quite like the inflation-linked bond in the short end of the yield curve, because it does give you attractive real returns with relatively low volatility. I wouldn't really endeavor much longer than kind of 5 years in these type of funds, given the interest rate volatility that comes with it. I also think there are great opportunities to be taken from the steepness of the South African yield curve. It's steepened for good reason, and you can benefit from essentially structuring kind of a more flat interest rate environment in an instrument to benefit from that over longer term. So those would be duration. Yeah, we're actually quite neutral. We think bond yields at these levels are kind of fair. But just one comment about the inflation and currency. The Reserve Bank will argue, as it does right now, with its adamant. He's been adamant of cutting the target to 3%, is that the weakness in the currency is not the cause of inflation. It's a higher inflation target that causes inflation to be, the currency to be more volatile. So he'll argue that if you lower the inflation target to 3% and you meet that, then your currency will be much less volatile, and that will feed through into the rest of the economy.
JP, maybe just we've seen a small bit of inflows to our bond market over the last while, but not really significant. We know that it seems that we should, touch wood, go off the grey listing maybe this year. What does it take for foreigners to buy more into our market? We've just seen from all your presentations the great opportunities, the great yields that we currently have. Will they ever come back?
What they need is they need us to be, they need a more efficiently run, flexible economy. That's really what they need. And that can manifest itself through structural reform. Foreigners, I don't think, have seen the kind of structural reform that they would like to see to make our economy, to improve the state of our economy. We are very highly taxed and fairly inefficient, I'm being nice, government. And they'd like to see improvements in that. It's very sentiment driven. I think Jonathan showed the chart of, or you can look, if you look at the volatility that you experience in nominal bonds, it's very, very volatile, and that's driven by the fact that there's still a great deal of uncertainty as to what the path looks like going forward.
Sydney, maybe if you had a total flexible portfolio, where's the biggest opportunity, locally or globally, with all the uncertainty?
Yeah, it's the one question I was hoping you're not going to ask me. But yeah, I think that there is opportunity both locally and globally as well. It's going to depend, I think, on certain fundamental developments, and I think the one big development is, or event, or issue is monetary policy. So, if I had a total flexible portfolio, I'll be looking very keenly at the monetary policy that's being employed worldwide. And as I said in my presentation earlier on, we're seeing divergence of monetary policy being applied. So it depends where you are sitting. If you're sitting in the US and you're looking at the Fed potentially cutting in September, again in December, there's opportunity there for yields to decline. If you're sitting locally, there's opportunity because we potentially will see a rate cut as well. But if you are sitting globally and you need to pick across the world, you're going to have to be very careful and understand the divergence that's happening across, whether it's Mexico or Japan, and then choose your strategy based on that. So monetary policy plays the big role here,
Any questions from the audience before we finish? Already? Maybe just the laws. There's one there.
Yeah, my name is Malungelo from Mazi. I just want to challenge this lower inflation target, Jonathan. If you have a low inflation target, it means that with high administered prices, inflation will be higher, and therefore you have to keep interest rates very high. So, obviously high interest rate will, lead to a stronger rand, if you like. But with the problem that we have in the administered prices environment, how do you bring down that lower inflation target?
Yeah. So I think the first point to make is that it's the governor who's adamant about 3% being a good idea. It's not me. And you're right. One of the problems is that actually we did some numbers, and to achieve a inflation at 3%, which is what the part of the inflation basket that the Reserve Bank can control by interest rates, call it, you'd probably need to have inflation, actually, the non-administrative prices inflation, at 2.7%. So the target's even harder. So that kind of really restrains things. The other thing is that there's what we call the sacrifice ratio. So how much economic growth are you sacrificing to get to that 3%? Now, 2 weeks ago, I was lucky enough to be at the Reserve Bank's conference. Every 2 years they have a conference. And that, unfortunately, I was quite disappointed, and maybe that's just because the governor was trying to sell his point very strongly. There was very little focus on that sacrifice ratio and what will it mean if you move from 4.5 to 3 for the economy as a whole. So I totally agree that, and also just by the way, the front row at the conference was National Treasury, and I don't think the governor was able to convince them, who supposedly give him the mandate. But the one thing I have to say, and regardless of if it's 3 or 4.5, the governor is hawkish at 4.5. He's a 4.5 hawk, but I think it's come to the point now that inflation has surprised sufficiently to the downside. Growth is weak enough. The currency is kind of relatively well behaved, partly because of some commodity price benefit, and he will now be forced to soften his hawkishness and cut interest rates. And I would agree that we can see 1 in May to be followed by 2 or 3 after that.
Just maybe a point from my side. I think you're 100% right with the question that if you look at where our inflation has been, everybody's sort of amazing how short memories are. But if you look at how our inflation has been at the higher end of that target, it's been the high 5s since we did inflation targeting. So yes, we've had a period now where we've had lower inflation, but I don't think we should get ahead of ourselves in terms of thinking that it's a beaten animal. It's still potentially there. And it's a lot of those inefficiencies that I talked about, and flexibility in the economy and all those things which are required. There have been a number of countries in the world that have reduced their inflation targeting, but at the same time, there have been real structural reforms, real changes in the labor market, etc., that have allowed for that.
Yes.
Yeah. JP, you mentioned specifically that foreign sentiment is so negative towards South Africa. And yet the most pessimistic people normally in these rooms are the local asset managers. Okay? They tend to be extremely bearish on the potential of South Africa. And the question I have is, I mean, many people think about the idea that the structural drivers is our government or our inefficiency in government that's causing the pessimism and the crime and everything. But one thing we don't ever mention is it's the commodity cycle that determines the success of our economy more than anything else. It explains almost 90% of the moves of our currency and our economy. So why the hell aren't we talking about the commodity cycle? You're talking about shit about Julius Lehmann, government that's atrocious, but the point is the commodity cycle drives our returns.
The commodity cycle is not under the control of government policy.
Correct.
And therefore, that's something that you can't bank on as a constant source of revenue. And therefore, debt to GDP is the problem, despite the cycle in commodities. And
but when the cycle turns in our favor, it's easy to pay down debt, as we proved between 03 and 08, we paid down debt with the same ANC atrocious government.
And look what happened to Eskom.
Because commodities rallied. The Eskom, I mean, the platinum price has gone down 70% from its high, and no one's mentioning that. That was our biggest export in 08. Why don't we emphasize that more? What happens if the platinum price doubles?
Well, I mean, I think, so firstly, foreigners are a very good barometer because they are agnostic, really, when they look at. I agree with you that we sit here and we get frustrated with inefficiencies and things that are happening in the economy, and maybe that leads to a bias. But foreigners don't have those. They're sitting in London, they're sitting in New York, wherever they're sitting, and they look at it purely from the economics and what's happening in the debt picture. The reality is, yes, we are driven largely by the commodity cycle, but we've also had mining production go down year on year pretty consistently. So we're not doing, and the ability to get it to ports is also been under difficulty. So yes, if we had a doubling in the platinum price, would it be good news for us? Yes, but in some cases it sort of papers over the issues that we have.
Thank you very much. I know we can carry on for another hour or two, but I think it's also just good to have some positive news. We're expecting rate cuts, inflation is under control, great opportunities from fixed income, so a positive note to end the panel on.
Thank you. Thanks.
Right, many thanks, Yanel, for running that panel for us. It was very great to have you here. And thank you to Sydney, JP, Jonathan, and Bruce for all of you coming through. Coming to the front now to moderate the next session on SA equity. And Tian, maybe you can ask some questions there on the commodity cycle as well. Shane Watkins from All Weather Capital, Warren Riley from Battalier Capital, and Marco Barbieri from North Star Asset Management. Joining us to moderate the session is Pierre de Klerk. And maybe just on that commodity super cycle, I mean, maybe that's something Pierre can ask the equity panel. We're going to struggle to export cars, and one of these days we might even struggle to export rocks. Who see?
So, thanks, Eugene, for the introduction, and thanks for the opportunity again. I think it's the third or the fourth year that I introduced the SA Equity Panel or hosted. And I remember in previous years, I kind of tried to, ons het mekaar 'n bietjie opgepraat, moed ingepraat oor SA Equity. And I remember the one year, the conference was kind of around the time of King Charles's, when he became king, and I tried to link the themes, and I said SA Equity is supposed to be the king of asset classes. And so we kind of bumbled along and looked at the US equity market and kind of, wished we were there. But for the year past, to 30 April, the JSE 203 have given you 25%, and it almost happened kind of by stealth that we got decent returns from SA equities. The mid-cap, or mid and small-cap group gave you about 21%, and that's maybe more reflective of SA incorporated companies. And then when we turn to the funds, the average SA equity fund in the new SA sector gave 21%, but interesting enough, the best fund would have given you or gave you 38% over the past 12 months to 30 April, and the worst fund 8.5% versus cash of 8.2. So the worst fund gave you pretty much cash, the best fund gave you 38. And then obviously there's a bit of kind of starting point bias, but if you look at the 5-year, now remember 5 year back, we were kind of in the middle of the start of COVID and markets was low, but over 5 years, the market has given you 17% point to point per annum, and the average fund 16, and the dispersion was the best of 26, and the worst fund giving you 9 versus cash of 3. So I think that was just my introduction, but also the introduction to the manager. So it's that dispersion of returns of, let's say, over 5 years, 26% per annum versus 9% per annum, which one can really ponder about. I don't want to make, kind of go into a discussion about active versus passive, or active and passive. We support both approaches. There's a place for both in portfolios. But clearly, if you can pick a good active manager, they can do very well for you. And our business, Apex Investment Consulting, certainly believe in boutiques as being smaller businesses where you have the best alignment with the manager to deliver very good returns for our investors. And the managers that will be presenting, All-Weather, Battelier, and North Star, are very good examples of that group of active managers. So thank you for joining us, gentlemen. We're going to start with Shane. You go one after the other, and we'll take some questions at the end.
Great, Pierre. Thank you for that introduction. The 38% he mentioned was us, and so it's great to be able to stand up and talk about that. I also realized as I was about to present that I did my CA part-time, and I used to lecture at Damlin. I used to lecture finance. And I realized often I only understood the concepts while I was actually lecturing to the students. And that's a bit like presenting, you know. I actually only realize now what I want to say, now that I'm on the stage. And so I'm going to go through the slides a little bit quickly and not stick to them. But the fund I wanted to talk to you about is, and you can see how our funds are positioned on the continuum. We have 7 unit trusts. I consider unit trusts to be a great structure, and thank you to BCI, because they're the on-ramps onto the highway, right? It doesn't matter how good your fund is if there's not an easy on-ramp. And so top right, it's the All-Weather Capital Best Ideas Fund. We did 38% last year, and that's the fund that I wanted to talk to you about. I'm just going to skip a little bit forward, because as I said to you, I have a better idea what I want to say now that I'm up here. And I guess the question is, you know, what is the intersection between top-down and bottom-up? Because when I started up my career in 1995, 80% of the equity return related to things in that equity. Now 80% of the way equity prices move relate to macro events. And so the world has changed, and the way that we do bottom-up analysis has to change. It doesn't matter what share you invested in or were invested in on the 2nd of April. You know, when Trump announced his tariffs, the whole market was down 5 to 7%, and the same thing the next day. So, you know, doing bottom-up analysis in a world where we have these top-down events is only half of the work. And so we have a bottom-up investment process, but we have a macro-political overlay, which is very important. And that is done for us by Nick van Rensburg. Nick was one of my partners at Peregrine Capital. We worked together for nearly 10 years at Peregrine, and he now does geopolitical strategy for me. So if I could just go back. So he prepares these dashboards for us. And what the dashboards attempt to do is they attempt to identify every event that is relevant or germane to the outcome. So in this instance, say load shedding or earnings or consumer spending or interest rates or regulatory changes and so on. What I want to show you is that if you look at the top table, you can see that from left to right, it becomes slightly less red. So from 2023 onwards, we kind of move from a red area, and I'm talking about SA equity now, into kind of an amber area. And then if you go to the bottom, which is 2024 and 2025, we're kind of moving out of an amber area into a green area. And that basically means for us that things in South Africa are looking a lot better. And so what is the reason for that? And there are two reasons. One is kind of a geopolitical, technical reason. 65% of the total value of market cap is in the United States. Now, for various reasons, that has gone up from 40% in 2010 to 65% now. We believe that over time that will start to reverse. But what it means is that the 65 has got to go into the 35. And so it's kind of like, if you can imagine, you know, a huge number of people in a massive crowded nightclub now trying to crowd into a much smaller nightclub. And there's going to be congestion at the door and a lot of price impact. So we think that that's a very positive development. The thing is that while the US is 65% of global market cap, emerging markets are only 10% of global market cap, and of that 10, South Africa is only 3. So we're a fraction of a percent. If money comes here, it can have a big impact. We think that the macro outlook is very good. I listened to the fixed income presentations. You heard that inflation is 2.7%. I saw a report this morning that food inflation is now around 1%, right? Now, in 30 years, I've never seen food inflation at 1%. The soybean price is back below where it was in 2022. The wheat price is down 20% year on year. Maize, the maize price peaked well above 5,000 rand a ton. It's now about 4,000. We know that the oil price was kind of 75, 80, and it's now 60. And one of the biggest inputs into agriculture is diesel because of production and distribution. So there are hugely positive reasons why we could see a cut in interest rates. So lower inflation, lower interest rates, a relatively strong ZAR. I mean, I concede that some of it that is dollar weakness, but a strong ZAR. And then we think that the GNU will hold. All of these are overlapping positions that I think could see a very positive outcome in our market. Now, what shares do you want to buy in those circumstances? We think that the discretionary retailers are the place to be. Food retailers like food inflation, right? I mean, Pick n Pay buys maize meal at 10, they keep it a little bit longer than what they should, and they sell it for 11, and that was just inflation helping them. The discretionary retailers are the opposite. The money that doesn't get spent on food gets spent on discretionary items. So, you know, this would be, in our market, largely apparel, but also businesses like, say, motors. So I think the thing that we really like in our market is apparel retailers, and probably our top picks would, well, actually, I don't think it's going to make a huge difference. Truist is the cheapest on a P of like 8.5. You can buy Foschini on a P of 12 or 13. You can buy Motus on a P of 6, which I think is like crazy cheap. And so I think there are really good opportunities in our market at the moment. The All-Weather Capital Best Ideas Fund isn't a small cap fund or a mid cap fund. Actually, mostly we're in large shares. And I'm going to show you a little bit. Let's go skip through these slides. I'll show you how actively we manage this fund. The fund is like around 100 million rand, and we trade it all the time. There's a share I'm going to talk to you about shortly called Renette. It was our biggest position a month ago. We sold everything. We bought it at 440, at 480 we were out. And the benefit of this market volatility is it does give you opportunities. And what I say to my team is that if you don't trade the volatility, then volatility becomes a stressful thing rather than your friend. So what we're trying to do in our business is turn volatility into money. Oh, Nick van Rensburg said that the All-Weather Capital Best Ideas Fund is not for everyone. He said, I must say this. He said it's only for people that like money. That's Nick's joke. Anyway, you can see how actively we've traded this fund. It changes all the time. It's got a very high turnover ratio. But at the moment, the fund is dominated by the apparel retailers. And then we have another sector which I think is kind of unusual for us, but that is the PGM companies. So, you know, I think our bet from here on for the balance of 2025 is the apparel retailers and the platinum companies. We like the platinum companies for the reason that they're very under-owned. Okay? Most guys don't have them, most guys don't like them, and up until now for pretty good reason. But we think from here the metals can do quite well. Trump announced last night that he's killing the $7,500 EV subsidy in the United States. The Europeans have rolled back their environmental legislation on internal combustion engine cars. The Chinese have been found guilty of thrifting on loadings in autocats in China. So we think that traditional internal combustion engines can make a comeback off a very low base. And we think that platinum jewelry can also make a comeback. In the last 3 months, China has consumed more platinum for platinum jewelry than they ever have in history. In the case of palladium, which is the other PGM metal that everyone looks at, there's about a 2.4 million ounce short position in that share. So we only need a little bit of good news to get these companies going. The other thing is that Anglo American is going to unbundle Amplats, and that is going to take the weighting of the platinum sector up by about 20%. Now, gold and platinum are sectors that generally fund managers, especially stock pickers, don't play. They just ignore them because mostly miners are companies that dig giant holes in the ground and don't earn their cost of capital. And that's true. But in this instance, those two sectors are going to be 14% of the SWIX. It's going to be very hard to be zero in something that might be 14% if it's going up. So we think that PGMs are a good place to be. But as I said, we trade this very actively, and our bet for the year are the apparel retailers, the furniture retailers, maybe motors as well, and then the PGMs. I wanted to give you an idea about how we go about doing our primary research. So we have 14 analysts based in Johannesburg. At the beginning of this year, we got everyone back in the first week of January, and we all know that at the end of January, the retailers give you trading updates. So what we decided to do is we'd spend 3 days out of the office, everyone would go to a retailer and find out how trade had been. Well, everyone had to go to a shopping center and go and see 10 or 15 retailers. We did almost 400 site visits over the 3 days, okay? And we came back and we kind of got the trading updates early, because the store managers just tell you what they're going to tell head office, and head office will put it in a spreadsheet and they'll put it on Sends a month later. But by then it's too late. So we realized that trade over December wasn't great. Black Friday was good. December wasn't great. And we sold all our retail positions. And I think you can see that the retailers even now are down maybe 10, 20% for the year. So that's how we go about doing primary research, and it's that kind of feedback that goes directly into the Best Ideas Fund. Corporate activity. Now, I want to say, with the caveat that this is despite the best efforts of the Competition Commission, there's occasionally corporate activity in South Africa. When I joined the market in 1995, it was a hugely exciting place. There were mergers and takeovers and IPOs, and we've somehow killed off all of that energy that used to happen. There are some corporate events happening. There's still some things that we think are possibilities. I think Lewis is potentially a takeout target. It's a great company with what I would characterize as ordinary guys doing smart stuff. Maybe Sanlam takes out Santam. There are a couple of other opportunities, but I do say that corporate activity is harder with the regulatory environment that we have at present. Just top right, we've got MultiChoice and Barlows. Those are both subject to an offer. MultiChoice by Vivendi and Barlows by Consortium. I would guess both of those trades will go ahead, but I will caution you that if the MultiChoice trade doesn't go ahead, there's at least 50% downside. And I would say there's a non-trivial risk that that company has to have a rights issue if things don't improve. Barlows, I also think the deal will go ahead, but the share's 108, 109, the offer's 120, so I think the easy money's been made there. I'll briefly talk about Renet. So Renet is a company, their main assets were Pension Corp, which is a company that's taking advantage of the conversion from defined benefit to defined contribution funds in the United Kingdom. They basically do this process for you, and they feel that they've got like another 10-year runway in this process as guys convert from DB to DC. They sold their British American Tobacco shares, and now half the NAV is cash. In the crisis early on in April, the share got obliterated like all other companies on the JSE. You know, in a crisis, things tend to go to everything goes to a delta of 1, unfortunately. And that's where the opportunity lies, because it's insane that cash should fall by 50%. So anyway, we took a big position at 440, 480, as I said, we're out of that already. Yeah, why do you invest with All Weather? Well, I guess in the Best Ideas Fund, the main reason is that I've got 20 million of my own money in the fund, and I focus on it like a hawk, right? Show me the incentive and I'll show you the behavior is what we always tell our staff. But I think the main thing is that we're passionate about financial markets. I sometimes find that passion lacking in young people in this industry. You know, I say to the guys at work, if you go to sleep before watching the US market close, or if the first thing you do when you wake up isn't look at how Asia's trading, then you probably shouldn't be in financial markets. And for us, financial markets are irrelevant of what we get paid. Of course, we like to make money, but that we would do this in any event. It's the most amazing, stimulating exercise you can do with your life. So if I had to give you a reason why you should invest with All Weather, it's really that we're passionate about what we do. We don't do it just to make money. We love it. And then, of course, we have a grad program where we train young people. And I think it's so important that we bring young people into our industry. There are many talented people, and the reason they can't get in is because they have no experience. It's kind of the chicken and the egg. And so we give them a year's experience, and we send them out into the world, and they go and work for other people, and that's fine. But often the difference between having a job and not having a job for someone straight out of university is just a complete lack of experience. So I thank you for your time. Jade has asked me to tell you that if you reach under your desk, she's press-sticked, not chewing gum, one of her business cards. And she's only put 40 business cards there, and she'll give you a free gift of some sort if you grab that card and take it to her. So thank you very much for your time. I appreciate it.
Okay, thank you, everyone. I'm also going to talk a bit to the prospects of South Africa, where Shane's focused on the short-term cyclical uplift in the economy. I want to speak a bit more about the structural issues, which are both issues and where we're seeing opportunities in South Africa. So Stan Druckenmiller has been quoted a couple of times today, but he's really well known, and he has quite a famous saying that the only good economist he has found is the stock market. So with that in mind, I was thinking about what is the markets telling us about the prospects for South Africa in 2025. And I think if you look at it year to date, the market has not been liking South Africa's prospects. So the rand has been one of the worst performing currencies versus emerging market peers in what has been quite a weak dollar environment. South Africa's country risk, seen as its CDS spread, in the middle of that chart, that's now higher than it was before the GNU, indicating country risk has increased. And lastly, foreigners, their purchases of domestic-facing equities is now, they've turned to net sellers after being quite optimistic last year after the GNU. So the question then comes to why have we seen this year to date? And I think there's a couple of things, but first and foremost is that growth, in our view, is disappointing. The companies we talked to and have met with recently are saying that they're not seeing much of this euphoria and positive optimism translating into anything on the ground and increased activity. And why is growth so important for a country like South Africa? We've now gone through a period of almost 12 years of stagnant growth, but I think more concerning is that gross debt to GDP in the middle charts has climbed from over 30% to now closer to 76%. In quite a short space of time. If you look at National Treasury's estimates, they expect debt to peak this year and then begin to decline. But they have pretty rosy expectations of the growth South Africa will put out the next 3 years. If you look at the IMF report that came out only a month ago, they expect South Africa to only grow 1% this year. And in that scenario, our debt continues to climb. And I think the big thing for the South African economy and markets is that with this high level of debt, the cost of funding is now climbing. And the last chart shows that debt servicing as a percentage of revenues is now over 20%. So for every rand the South African government brings in, 20 cents goes to pay unproductive interest on our debt pile. We've got very high costs of debt. The previous panel and the fixed income panel pointed to high real rates in South Africa. And as an equity investor, that's a very high benchmark to attempt to overcome. So that high cost of debt and climbing debt burden means that equity valuations have a lid on them. And until we get our growth going in the right direction, that will continue to be the case. Now, there was a credible plan for growth. It was presented by the DA around this VAT story. That's really a sideshow. So the VAT story really was around raising additional 12 billion rand a year, 1 billion rand a month. If you grow our economy by 1% faster, you grow it by 75 billion. So the numbers make no sense that you would almost collapse the GNU over the matter of VAT. And in this DA document, and we've met with the DA numerous times and the Deputy Finance Minister Asher Sarupan, and he's taken us through their thinking on how you grow this economy. And it's relatively straightforward, and it also boggles the mind that this is something that ANC can't come to agreement with. Pillar 1, accelerates the implementation of economic reform. Pillar 2, a comprehensive review of government spending. And Pillar 3, reduction of regulation. Those were the three things set out in the document that the DA presented. So if you look at implementation of economic reform, Transnet is now the single most important entity to get correct in South Africa and to fix. Volumes have fallen by over 30% since 2019. That's across rail and freight. Our recent meetings with the mining companies indicate, though, that there's deep structural issues with the rail lines, and the neglect that's occurred means it's going to take up to 2 or 3 more years to fix this. So Kumba Iron Ore, African Rainbow Minerals all expect volumes to only pick up by 2027. So we have our doubts around the targets that Transnet have in place to reach those red dots. They seem quite a long way away. But importantly, the impact on the economy, and there was in the prior panel talk of how important resources are for the South African economy. And there's an estimate for you that the last 3 years, the shortfall from Transnet has cost almost 15% of GDP, over 1 trillion rand, really around lost exports of commodities that should be leaving the country and which haven't. A comprehensive review of government spending. So the US has Elon Musk and his Doge attempting to shrink government and also in the process finding a lot of corrupt payments and practices. And I got the help of AI here. So when you ask, do you use AI in your investment process? That's John Steenhuisen as our head of Doge. And I think as comical as it looks, I think the most important thing is that the numbers are they're quite breathtaking when you look at the amount of wasteful expenditure and support that's gone to non-productive SOEs. So since 2014, 1.2 trillion rand has been lost to wasteful expenditure and to support poorly run SOEs. And the last 3 years alone, that's added up just to under 150 billion a year. If you had purely cut out that wasteful expenditure and you were running those SOEs efficiently, the debt to GDP in South Africa would have been 57% rather than the 76%. I think more importantly, that capital that's gone into theft and wasteful expenditure could have been put to productive use again and growing in the economy. And then lastly, that administrative impact on business and regulatory view on South Africa. The OECD came out with their PMR score recently. That's a measure of the regulatory barriers to firm entry and competition. And South Africa, unfortunately, came right at the top of the table. And in this instance, being at the top of the table is a very bad outcome. And it's really around our rigorous labor laws and then our competition barriers. And if you think about Remgro attempting to sell a portion of its massive business to Vodacom, there was a 10 billion investment announced 3 years ago in 2021. They only got regulatory answer 3 years later in late 2024, and that deal was rejected. But it's a good indication of what's going on in the background here and how when the president says we need investment in the country and it can't occur because there's regulatory burden overseeing that. And The IMF on the right-hand side captured that quite well. If you reduce half the regulatory burden in South Africa, the economy within 5 years will be up to 9% bigger. So if you take those three elements of the DA plan and you look at where South Africa has been the last few years, so I've just brought up here emerging markets as well as the larger peers, you can see how low the growth has been in the economy. And it's been the case for an extended period of time. If you implement all these measures, we think South Africa should be growing at above 3% in line with other emerging markets. So the possibility is there to grow this economy. It's around the ANC choosing growth over patronage. And that's a hard decision quite clearly. Turning to the markets, this is a basket on the left-hand side of SA shares, purely SA shares that are domestic facing. It's banks, discretionary retailers, and hospital groups, etc. And you can see on the red chart how post-June there was a significant re-rating. And then as growth came in and expectations started coming down, you've seen a significant de-rating. And with that, the prices of these equities again have become cheap again on the right-hand side. So there was a significant re-rating and now a de-rating. And so once again, we're finding good opportunities in the SA equity space for stock picking. Let's maybe talk about two opportunities. So PPC, it's a well-known cement business in South Africa. It's been a dreadful investment over a long period of time. It's down 80% still from its 2014 peak. Management there had the wrong strategy. They went into the rest of Africa, a very expensive expansion. They took debt up. At one point in time, PPC was paying over 700 million rand a year in interest cost. What's happened subsequently is they've reversed that. They've brought in a new management team. They've got a very experienced management team who know how to run a cement business. And they've got a plan to turn PPC around. And then by 2028, aim to achieve EBITDA margins excess of 20%. And that's without any assistance from the economy. So we see PPC as a turnaround business with optionality on SA growth improving. And on our numbers, without any improvement in the economy, PPC is trading on a mid-teen free cash flow yield, which we think still quite attractive, despite the share price performing quite well over the last year or so. And then on the Rand hedge side, AB InBev, it's a business that's also gone through quite a significant tough time. It acquired SAB Miller, took on a lot of debt. You can see in the middle chart that they've now been able to bring that debt under control and now have started buying back shares again. And I think importantly, the business is moving from being on the back foot to being on the front foot, generating strong free cash flow, margins are improving, and there's generally quite negative sentiment around the world on alcohol and alcohol-related companies. So you can see the valuation of AB InBev is at the lower end of history despite improving fundamentals. So something we also like in this environment where there's quite a lot of uncertainty. And that's it. Thank you very much.
Great. Good afternoon, everybody. Yeah, look, there's no doubt that South African equities has been a troubled asset class over the past decade. It's, despite the last 5 years being much better, and in particular over the last 2 years, we've seen some decent returns, but we've seen some dramatic structural changes in the market that we would argue would make what has worked over the past 5 years very difficult to work over the next 5 years. So let me explain that. If we look at the top left, just the number of quoted or listed companies on the JSE has gone from 1,300 in 1997 to just above 270 this year. Even for a small asset manager like ourselves, the realistic universe of stocks that we can invest in, once we take into account liquidity considerations and so on, is only probably around 120. The relevance of South African equities in the emerging market space. Just over the past 10 years, we've seen emerging market, the JSE as a percentage of the emerging market index go from 7.5% to 3.5%. And all these factors make it very difficult for managers to implement a pure strategy. And, we think that as an investor or as an advice community, one should not only look at the manager's ability to execute on their mandate or their style, but also to see whether they are able to execute on that, which we think there's a lot of constraint to doing at the moment. This is another interesting chart. If you look at the small and mid-cap index or component of the ALSI as a percentage of the total market, it's interesting that it's remained fairly stable at around 20%, which is telling you that delistings in the market haven't only happened in the mid or the SA-sensitive kind of part of the market. They've also happened in the large cap space. So the opportunity set in the mid-cap space hasn't necessarily got bigger. If we look at the composition of the market, it's changed dramatically over the years. This is just looking at the MSCI SA index overlapped to the world index. And there's two apparent things that come out. The first one, that there's a high concentration in the local market, with 80% of the MSCI SA index being concentrated in 3 sectors. And what is also interesting is that all 3 of those sectors are highly cyclical in nature. So 1, we've had an increase in concentration. 2, the market is becoming increasingly cyclical. And the obvious other point is the fact that it's become very underrepresented in other parts of the market, with very little opportunities in the energy space, utilities, healthcare, and so on. So how does a manager implement a strategy when there's such constraints in the market? As a result, what we've seen is the performance of the market has been polarized. Obviously, it has been underwhelming over the past decade. This is just looking at the sector performance of the all share over the last decade. And what we see is that only 3 sectors have outperformed cash, while 60% of the market, or the remaining 6 sectors, have grossly underperformed the market. So what are the implications for portfolio construction and strategy? Well, we think that it's very difficult to implement a pure style strategy in this environment. And we think that a tactical approach, flexibility is a word that has been thrown around a lot, which we believe in, is a requirement in these kind of markets. And we think that a process that is deeply rooted in valuation, an understanding of forecasting risk, and probabilities becomes extremely important. So let's maybe start off by looking at an example of 2 companies. This is just looking at the share price performance of 2 retailers in the local market. Clicks on the left, Mr. Price on the right. It is quite staggering to see that Clicks has compounded at a rate of 16% per annum over the past decade, while Mr. Price has only generated 1% over the same period in time. Clicks has arguably been one of the best compounders of return that we have in the market. But nonetheless, what is apparent is that 2 retailers are exhibiting very different characteristics, with Mr. Price exhibiting a lot of cyclicality. We would all love to have a portfolio that has only got 5 shares, maybe 10 shares that look like Clicks, or they're exhibiting the compounding characteristics. But if we had to screen the market, or the 120 shares that we can see, we can probably count with one hand companies that exhibit that kind of behavior. And it turns out that over 80% of the market exhibits highly cyclical characteristics like Mr. Price. So how do we deal with this? We think that if we look at this chart, this is the outcome of our buy list. On the y-axis, we're looking at our expected prospective returns for a set of opportunities in the local market. And on the x-axis, we're looking at our ability to forecast risk. Are we able to forecast as efficiently Clicks as we are Mr. Price? Well, clearly not. You can make money off the Mr. Price, but it's very difficult because you have to have knowledge about the business cycle. You have to be able to determine where troughs and peaks are. And thus, the conviction that we're able to exert on Mr. Price is lower, but it doesn't mean that we can't make money off it. And in a market that has 80% of opportunities look like Mr. Price, we can't avoid them. So a clear understanding of valuation and forecasting risk, in our opinion, are essential. The third component is probabilities. As I mentioned, we would love to have a share portfolio that has only got 10 stocks. But it turns out that even though we deny it, fund managers can be wrong, and we are often wrong. If we look at ABSA, these are our own work. We're looking at a base case, a bull case, and a bear case for the stock. And even though the shares performed within the realm of our expectations, it's underdelivered, it's underperformed, and it's been in line with the bear case. So had we had only 10 shares in the portfolio, one of them would have grossly underperformed. At the same time, we've got stocks that have grossly outperformed. You know, the gold stocks have been an amazing part of the market for the past year. And you take companies like Gold Fields, AngloGold, and have all delivered exceptional returns. So why is this important? Because probabilities do matter. And whilst we do a lot of work on the valuation side and we spend a lot of time determining how easy it is to quantify these scenarios, having a diversified portfolio allows us to have wiggle room and generate returns. I just want to finish off the presentation to give some views on the market. And I'm just going to show one slide. And this is just looking at our intrinsic value discount over the past 5 years. What is very apparent is that the green area is areas that have been good entries for the market, where intrinsic value discounts have been very high. And we think that you've had various opportunities over the past 5 years to make a lot of money. We've done a lot of backtesting on these numbers, and we've seen very good outcomes. The chart lands up finishing about 2 weeks ago. So if you had to kind of fast forward up to today, there would be a sharp correction in the intrinsic value, which would be now in the amber zone. So what we're trying to say is that the local market has had incredible opportunities. Where we are now, we still see opportunity, but it's more in a moderate kind of level of intrinsic value. And if we had to decompose the market in more granularly into sectors, we do see a lot more value in the SA Inc. type trade. But we think that even from a global perspective, miners are looking quite interesting at the same time. So let me leave it at that, and I'll be happy to take questions. Thank you.
Thanks, gentlemen. There's a question which starts with the sentence, please tell Shane his hair looks phenomenal today. And then goes on to ask, in terms of Glencore, what is the view at current coal prices? Can the balance sheet survive more years of lower prices?
So Ivan Glassenberg bought a huge chunk of Glencore PA the other day, and he's a smart guy, and I presume he's got the management account. So, you know, I suppose short answer, I think, you know, you'd kind of go, I like companies where management are buying or where the company's doing a share buyback. Glencore's doing both. The company's buying back their own shares, and the previous chief executive and founder is also buying Glencore shares. I think the culture of Glencore is quite entrepreneurial. They're more of a trading organization than a mining company, I think, at their core. The share was 100 Rand 6 or 8 months ago. It's now 64. It's hard to know with mining companies, but I think, you know, you kind of have to buy them when things don't look the greatest, and things don't look the greatest for coal now. But I would say that if you were going to own a mining company, Glencore would be the one to own, and we do own it.
Thank you. You are welcome to send in questions online or ask questions on the floor. Not sure whether there's any immediate question. Ed, thanks.
Hi guys, thank you very much. You're lucky you got here, but anyway. So 2 questions in one. The first would be just simple, your projected 1 to 3 year returns. Where do each of you see your portfolio returns? Secondly, AI has been quite a big part of today's discussion. And we already know what passive has done to change our entire industry over the past 15 years. So how do you actually see AI changing our industry even more? Do you see it as more of a risk or competition, or do you see it something that is actually going to enhance your business? Thank you.
Maybe if I can take the second part first, because I think it's a great question. So we are not IT experts, and I kind of sometimes think I've really got to make a lot of money quickly before I don't understand the world properly anymore, because the world is changing so quickly that it is hard to have a full understanding of what's going on. And so the strategy that we've adopted in our business is to start using artificial intelligence in the back office. In other words, we have a server that has every due diligence document we've ever done saved, and using artificial intelligence, we can then pre-populate a due diligence document that one of you might send us in a matter of minutes rather than taking 3 or 4 hours. And we're hoping that by building the understanding of the AI capability starting at the back office, we will then migrate that into the front office in terms of making investment decisions. The South African market differs a little bit in terms of its, let's say, susceptibility to use AI, because globally there are upwards of 50,000 listed companies. And so your data set globally is huge, but as was pointed out earlier, the data set in South Africa is 270 companies. When you're looking at a global universe, a lot of the work you're doing is a filtering process, where the JSE is still quite, it's easy to do bottom-up of every company. I mean, an energetic team of 10 analysts can have models on every stock on the JSE and just do it on a bottom-up basis. So I don't see AI being a big thing necessarily if you're confined to the JSE. But now, having said that, why should we be confined just to the JSE? Because it's pretty evident that very few of our companies are world-beating companies. Most of our companies are prosecuting a business model that was developed in the 1980s. So, which is the reason why we have so few compounders. So many of our shares are just trading shares. You buy them when it's bad and the price goes up and then you sell them. Very few are kind of bottom left, top right, like Clicks is. So changes to Reg 28 now allow pension funds to take 45% of their money offshore. And to the extent that have money offshore, you have to have an investment approach that can successfully identify opportunities offshore. And I think that really is where we will take the next leg of our AI strategy. I don't think it's going to be something that we're going to use on the JSE because the data sets are so small. But offshore, I think AI can make a huge contribution. And I do think the way the world has changed post-COVID, where companies wherever they are in the world do their results presentations online now. It is that geographical advantage that other fund managers outside of South Africa might have enjoyed. I think it's a very level playing field now, and I think there's no reason why South African fund managers can't compete on an even basis. And I think that's really where it's likely people deploy their AI strategies.
Yeah, can I have a
go
at that
for
question?
it.
Yeah, I think for us, it's quite similar to Shane. I mean, we are starting to utilize it in the investment analysis process to enhance our productivity. So it's very good, the large language models at answering complex questions and explaining complex concepts quite easily. But beyond that, it's still very early stages, I would say. And I think it's something that we will, in time, incorporate more where we can. But at the heart of it, our business is a fundamental bottom-up stock picking with investment analysts taking a view of many years of understanding business cycles and so on. And I think it's going to be hard for the AI to replicate that human intuition and kind of feel for the market that I don't think will be replaced anytime soon.
If I may,
Maybe,
just
go
very
for it.
quickly, I think where you're seeing probably a bit of movement is in the financial sector. I mean, you've got companies like Discovery and perhaps Capitec that are making a bit more noise. Just from a threat perspective, I don't think that it's going to be displacing businesses, over the next 2-3 years. But at the periphery, there's no doubt that businesses that have relied on big data and that are further entrenching themselves in terms of having AI capabilities will probably do a lot better over time, or entrench their competitive advantage even further. Think about OUTsurance, think about some of the good companies in that space. At a manufacturing or industrial level, I think it's quite difficult. You know, we don't have companies that are complex enough like an Amazon, which would clearly benefit from scale and so on. So I think in that space, maybe a bit longer.
Just linking to that, I mean, we are a bit early on time, so I can maybe tell you an interesting story. So on the topic of AI and big data specifically, I did a course at Cambridge a few years ago, and they had a technology guy coming to chat there. And the few interesting examples that he gave was of an international company who places cameras outside hotels at night. And they film it throughout the night, how the lights in the rooms go on and off. And based on that, and using AI, they can estimate what the occupancy rates of the hotels are. So they literally get real-time occupancy information. Now imagine if you're a property manager. I missed Evan's talk earlier today, but he'll probably know more about it. But imagine if you're a property manager and you can get kind of real-time information as opposed to having to wait for weeks or months for that kind of information. Another example of real-life companies, OUTsurance was mentioned. Now, what's also becoming cheaper and cheaper are sensors. So they reckon where we'll end up is a company like OUTsurance will be able to come to your house, stick the whole house full of sensors if you're in a seismic area, and pretty much real-time, on an individual basis, they'll be able to risk rate you based on the seismic activity, you know, on your premises, basically. So I think those are examples of things that we can't almost imagine where technology and AI is going to take us. And I agree that it's going to translate into advantages for some companies across industries. Shane, I want to come back to you. Unfortunately, you skipped over a slide that you had in your pack that showed the intersection of the different capabilities in your business, being hedge funds, emerging markets, SA, and so forth. And my question is really, in Reg 28 products, we obviously have to have a lot of SA exposure. We don't have a choice, but maybe in a discretionary context, in your opinion, how should investors think about their investment in SA equity versus emerging market equity versus maybe even China directly? How do you think investors should think about that?
So, if you look at the companies on the JSE, as I said earlier, let's take, say, a petrochemical business like Sasol, kind of a coal, oil and gas business. Now, is Sasol in the top 10 best oil and gas companies in the world? No. Is it in the top 50? No. I mean, is it in the top 500? I doubt it. So, if you can take money outside of South Africa, why would you invest in Sasol? And you've seen that the Sasol share price has been a slow puncture, and it's because of that dynamic. The only people that will buy it will be people that have to have their money here. If you can have oil and gas exposure, I can think of 10 companies I'd rather own. And so I guess you have to look at the JSE and you need to say, well, the money that I have here, I want it invested in the best companies that are here. Let's say like Clicks, it's a very good business. It's benefited from the consolidation of kind of the mom and pop pharmacy, and then on top of that, it's just extremely well managed. So I would say on the 55% that's trapped here, you've got to identify the best businesses, or you've got to identify businesses that you are good enough to trade in and out when the prices go up or down. And then you can take the 45% offshore and buy companies in the sectors that you like that are truly world-beating. And I think in our business, as I said, I think, what we have is, I come from a hedge fund environment. I think being in hedge funds just gives you a slightly different mentality. I think you're naturally slightly more skeptical, a little bit more abrasive, a little bit more questioning. And I think it's that, it's helpful to have that mentality in a business because, management are often, not honest. Sometimes they have to lie to you. If you speak to a bank CEO and you say to him, do you have solvency issues? He has to say no. Doesn't matter what the reality is. So, I think having a hedge fund mentality helps us in our process. But I think as you divide your portfolio up between local and offshore, you can now go and find the best in the world for 55% of your portfolio. And what you have here is, I would say there are only 10 or 20 companies on the JSE that are truly great businesses. Unfortunately, they're very expensive. You know, I mean, the businesses that I would consider to be great would be kind of Capitec, insanely expensive bank, Outsurance, insanely expensive insurer, Clicks, insanely expensive retailer. But, you know, the truth is, if you go and look from, like, say, the 4th of April to now, which companies have done the best, it's the most expensive. So the learning point for me now, and you're always learning, is next time there's a crisis and everything falls 20%, I'm just going to go buy the best companies. I'm not going to look for cheap stuff that looks like it might recover. That's too hard work.
I want to just add to what Shane said, that I showed a chart there of foreigners selling domestic equities, but that didn't include Capitec, Outsurance, and Clicks, and they've actually been net buyers into this kind of dip. So the foreigners are buying the best companies as well. That's definitely a trend that's in the market this year.
Warren, I want to stay with you, and I want to kind of link to Tian's questions about commodities of earlier. I think it's fair to say there wasn't, that much talk about commodity cycle and resources so far at the conference yesterday. The potential or the idea of the next commodity cycle came up a few times. So the question I really want to ask you is, you showed that interesting slide about Transnet, and how things have deteriorated. So my question is, maybe a bit of a refined one compared to, or feeding off Tian's, is taking everything into account, taking our infrastructure situation into account, but also the companies themselves, quality of management, balance sheets, and so forth. The question is, what is the readiness factor of SA resources companies for the next commodity cycle? Because in previous commodity cycles, we kind of looked back and we realized, we didn't make of it what we should have. Yeah. The Aussies maybe did better or whatever. So the question is, how ready are we for that? Are investors going to really capitalize?
I think I'll make 2 points on that. So if you look at the South African companies who are exposed to commodities, they really are iron ore and coal. There's no copper production in South Africa, and then PGMs and obviously some gold. So in terms of, if you think about commodity super cycles, where the next cycle is going to come from, I'm very doubtful it's going to be iron ore or coal, but it's most likely going to be copper, and there's most likely also some sort of upswing coming in PGMs at some point in time. And then you look to the company's ability to benefit from that. So our recent meetings with the iron ore producers, the iron ore line can only shut for 10 days per year, 11 days per year, and they can fix 500 kilometers in that time period, and the entire line needs to be replaced. So that's why structurally we can't do it in a short space of time. They're taking 2 shuts this year, which will accelerate it, but ultimately Kumba took job cuts, Section 189, they had to fire employees, but they actually couldn't produce the material. And it's an interesting exercise if we go back 10 years and look at the production plans, or what the companies were saying their long-term plans were for production. They were a lot higher than they are today. So we've certainly missed out because of our infrastructure not being able to handle those volumes. But I guess the good news is there's things happening, and the companies are expecting to improve their kind of shipments from 2027. It's taking time, but it's going to happen. But ultimately, our companies are not probably exposed to the kind of commodities that you are going to be up in the next big cycle.
Thank you. Marco, last question for you. You showed a few slides about the market structure of South Africa, and you spoke about liquidity. And the question is really, how big an issue is it? How big an impediment is market structure and the liquidity situation in terms of extracting value from SA Inc.? And maybe a second part to that question, do you feel as a smaller boutique asset manager you are advantaged because of size to a degree that offsets those negative factors?
Yeah, I mean, it's complicated in the sense that if we look at the mid-cap space, we clearly can take more of an advantage in that space as a smaller manager than one of the bigger guys. Quite often, I think that offshore gets talked up because of the lack of ability in investing in that space. So, one has to kind of be careful in, extrapolating a portfolio that is very offshore exposed with a preference towards that. But even for us, it's become a bit more tricky to do that. So And to the point that the market has become more concentrated and returns are very polarized, we find ourselves being a lot more in and out of positions and focusing our skills a lot on valuation type work. So, there is more of an opportunity for us, but I think that the good old days where you could buy 10 shares and just sit back and go on holiday, I think are over. I think managers that are working hard are going to probably get rewarded the most.
Thank you. Any more questions from the audience? Sorry, I went kind of rambling on. There's one at the front. Sean, please.
Good afternoon, everyone. I think those slides on the JSE really paint a damning picture. Associated with Reg 28 and all the other governance challenges we've got in the country, what is the forecast with the Reg 28 regulations going forward, and what work is the industry doing to try and get government to relax those criteria that are set?
Maybe if I can start with that one. I think, having engaged personally with the finance minister about this, I think there's a general acceptance that they might have made a mistake and they could have gone, in a series of steps rather than one step all at once, because it has prejudiced the JSE, and as I said, it's turned some companies into kind of stranded assets. There's just no obvious buyer for them. But having said that, it's hard to see how they kind of unring that bell, but I don't think that it's likely that you will see further relaxation in terms of taking more money offshore, because I think if they could, they would walk it back. They just can't think exactly how they would do it.
Thanks, Shane. I'm going to call time there. I know we're a bit over time. Eugene will be happy. Thank you very much for joining us and for the insights. Greatly appreciate it. Thank you.
Thank you.
Thanks.
Thanks, Pierre. Thank you, gentlemen. Very insightful indeed. We're nearing the end of the day, and two good sessions coming up. The last one, or the second last one, on global equity. And here, all the way from the UK, that came through, Jared Khan, Head of Equities at Credo. Jared, thank you so much for coming through.
Thank you, Eugene. Thanks. Click. Good afternoon. I know it's a long and difficult session, so just bear with me. I'll try and make it interesting, and it should go quite quickly. So just to introduce myself, I'm Jared Khan. I'm Head of Equities at Credo in London, and I run the Credo Global Equity Fund. We don't really get much of a chance to punt our funds in this forum, but I thought this was a good opportunity to do so, because if you just look at the 1-year, 3-year, and 5-year chart, what you'll see there is that we are first quartile over that period. And I think that's quite interesting, because if you know our fund and you know our investment philosophy, we play somewhere more in the space of value. We're not deep value, but we like to call ourselves a fund that trades at the intersection of value and quality. And so if you're looking for some fund which could be quite interesting at this stage in the market, I think it could be a good place to go. So about a month ago, when we were asked to put forward our presentations, you need to come up with a theme, and you need to come up with something to talk about. And what better to talk about than Liberation Day? And so we have Donald Trump there in the middle of the graphic, dangling on a rope, basically putting out fires or creating fires and creating discord and turmoil across the world. And that's become quite difficult for market participants. And as we saw from not only from April, we actually started with Mexico and Canada originally within the first week or two of him coming into power, but certainly from April onwards, just massive discourse in the market. And so we've had a lot of incoming from our clients, panic, do we sell, what do we do? And to be honest, I think the best way to explain what we have been doing and what we continue to do basically at Credo is is we kind of just assess the situation. And if anyone follows Howard Marks, he runs Oak Tree Capital. He's a behavioral finance guy. He runs billions and billions. He came up with his memo at the beginning of April, and he said, nobody knows yet again. And really what he's pointing at is that if you try and get ahead, try and step ahead of what's going on in the market, inevitably no one can forecast. It's the folly of forecasting, and you may come very unstuck. And by doing nothing doesn't mean that you're actually doing nothing. It just means that it may at times be the most sensible thing to do. But quite importantly, in his memo, he talks about what Trump's trying to actually get through in terms of these tariffs, and he draws a lot of positives out of them. So effectively what he's trying to do is bring down the deficit. He's trying to bring manufacturing from offshore back into the US. He's trying to increase US exports. He's trying to decrease US imports. And he's trying to level the playing fields with partners and people that for the last 20 years have massively benefited from this kind of relationship. So, the dollar's been strong, and so what's been happening is with those strong dollars, they've been buying exported goods with the money that people like China and the like have taken. They just grow the economy and they grow their trading capability more and more to the point where it's become so dislocated. And so what he's really trying to do is reverse that and bring people really back to the table, which is difficult. And clearly the market has had to deal with those issues. So at the end of January, I was lucky enough to present on a platform with BCI in a presentation. And at the time, I really said these are the risks that we're monitoring through 2025. And at the time, I spoke about the market being expensive, which it really still is. The concentration risk in the Mag 7, which I'll get to a little bit later, this whole AI indigestion, the fact that NVIDIA has been pushing the market, Trump 2.0, inflation and geopolitical risks. And so where are we? And just bear in mind that I had to submit these graphics about 2.5 weeks ago, so it is outdated. But what we have here in the orange line is the MSCI Growth Index, the black line, the MSCI World Index, the MSCI Value, and the Credo Global Equity Fund, PEs over the last 7 or 8 years. And what you can see quite clearly, the orange line, is that the MSCI growth obviously has derated quite significantly, or had derated quite significantly over the last 4 months. And that was quite anticipated. These stocks were trading on 33 times forward, and then we had this kind of, call it AI indigestion or trouble in the markets, and we saw significant derating down to levels of about 22 times. At the time we took this snapshot, it was at 24. But as we sit today, the MSCI Growth Index is trading at about 26 times. It's still trading at a significant premium to where it has historically. And more importantly, if you look at the jaws or the gap between the value index and the growth index, it still remains very elevated. I would say that because I'm a value investor and I'm trying to punt my book a bit. But essentially for the last 15 years, what we've seen is a decoupling between growth and value. We've seen significant multiple expansion in the growth index to the extent where, yes, you could expect earnings to go up because these growth companies do earn more and they arguably do have better business models. But the question is, what price you pay for those companies, what PE multiple you prepared to pay. So I just add a bit of caution here by saying, yes, we've had a derating and we've had a bounce, but parts of the market remain expensive, and that is something that hasn't really gone away. This was something else I highlighted, was the concentration risk in the Mag 7. It's outdated, but what you can see there is in 2024, the Mag 7 basically blew the market away, and if you weren't in stocks like NVIDIA, you didn't perform. Come the beginning of 2025 onwards, these stocks have had all performed quite poorly. And then you had the S&P equal weighted, which is more of a kind of a value-orientated benchmark, performed very well. But again, a lot's changed in the last 2 weeks with tariffs, and you've seen quite a nice recovery in the Mag 7 to the degree where I'd say this concentration risk hasn't really gone away. It still kind of sits around, and it's a problem. I spoke in January of this year about AI indigestion, and I said there I had a big picture of NVIDIA holding up the US economy. And the problem is that everything and markets are pricing so much on this AI trend, and you can see how it's worked through with the Mag 7. And then we started seeing a few cracks appear. First of all, we saw Amazon saying, whoa, we're going to actually slow down on our data center investments. Microsoft, there was talk about Microsoft actually stepping back, which they did, but in the most recent results, actually, they put forward a very positive foot in terms of market spend and the like. So the market's kind of settled down a little bit more like that. But the point again being, when you're buying these stocks that are priced to perfection, you can't have any of these blips in the market, albeit just a step back from some of the big players, or tariffs, or anything else. And it's something just to keep your eye on, and it's something to look at going forward. This is the same graphic that I used in my presentation at the end of January, where I said, expect the unexpected. And there I basically listed 6 or 7 kind of things that would be good and bad during the Trump regime: deregulation, tax reform, and in there I put tariffs, and it was just a kind of a nothing, and then Doge and the like. And who would know that as we stand here in May, the whole tariff regime has basically kicked off a hornet's nest and caused so much dislocation and concern in world markets. And so this is where it kind of begins. 2nd of April was a Thursday, and big Donald Trump stands up there and with his big tablets, and he says, right, we're going after China, we're going after Vietnam, we're going after all of these trading partners, and the world goes into a bit of a spin. But interestingly, everyone thought that the tariffs would be set at about 10%. If you actually read Stanley Druckenmiller, even Scott Bessent, their view was 10% tariffs across the board was the starting point, and that was going to be very healthy for the US. And when the market on the Thursday night heard about the 10% tariffs, it actually rallied. On the Friday morning, when they started reading the fine detail, they realized, hold on, that's not what's happening. We're now getting China, getting hit at 45%, and this is a problem. And it's quite deliberate. I mean, yes, one can argue, one can say whatever you want about Trump, but I think he has a plan, and he certainly had a plan, and his plan is really all about the threat of China. And so, again, you look at this little meme here. You've got Chinese premier talking about the art of war, and Donald Trump there, the art of the deal. Shoot high and then anchor yourself and then trade down. And he doesn't realize he's playing against the Chinese, who can play the long game. I'm a little bit surprised that the Chinese have actually capitulated so quickly and so soon. But it's early days, and that's what I would stress. A 90-day pause and bringing down tariffs to 30 and 10 is great, and the markets have been relieved, although the Hang Seng was down today, because when you start thinking about it, it's still pretty bad news. But interestingly, again, if you look at the trade balance between China and the US, and you look at the red blocks and the blue blocks, you can see that the US imports massive amounts of stuff from China: computer, electronics, electrical equipment, etc., and exports a very small amount. So it's no fine feat that Tim Cook on Friday night phones up Donald Trump and says, Donald, I've got a real problem here. My Apple phones are going to land at $2,000 now, and I'm going to sell them at $2,500, $3,000. No one's going to buy them from $1,000 to $3,000. And what's even worse, Samsung, my biggest competitor, can land them in America now at, I don't know, $1,300 or $1,400. So one, I'm going to lose massive sales, and 2, I'm going to lose market share. They are facing an existential risk. And comes Sunday, and he says, hold on, we're going to now drop certain electronic goods from these tariffs. So there's so much politicking going on that it's very hard to know what's happening. And again, you look at Howard Marks, nobody really knows. But what we do know is that based on present tariffs, there is inflation. So MAGA caps are not going to cost $5 landed, they're going to cost a lot more. And if Apple honestly think that they can reorganize their business in America and try and build Apple phones in America, you're dreaming. And this is what an Apple phone would look like if they made it in America today. Little tongue-in-cheek, but it's just not a reality. But what is a reality is people are moving away from China, and they're moving to places like India and Japan and other non-threatening nations. And so why do I say that Trump knows what he's doing? Because I think he realized that China now is one of the biggest threats to America, not from an economic point of view only, but from a technical point of view. If you look at their IT, DeepSeek, Alibaba, Baidu, ByteDance, they have some of the best learning models out there that can easily equal those of what the US has. They have defense. They have now their J-35, which is as good as the F-35. They have the fastest speed train in the world, 450 kilometers an hour. They're building the biggest dam. They have the best EVs. They have the best batteries. They have the best solar. This is a world power that is only getting bigger and better. And I think Trump realizes that, and in a way he's trying to isolate China. And it's just something to keep your eyes on. So this is a problem. But what's happened while he's going after all these tariffs and trying to do good things for America, he's hurting the American economy. And he'll say, we're good, we're healthy, everything's going to be all right. But then you see the news starting to come out. JP Morgan, all of a sudden we're expecting a recession, and BlackRock says maybe there's a recession. April survey, 45% from like nothing. And S&P, there's Goldman Sachs today. There's a recession, there isn't a recession. All of a sudden, the chance of a recession based on tariffs is they don't know. All I know is that there is going to be a downward revision of earnings. And the market has, in a way, kind of reacted to that and has repriced itself, but we still don't know. The other thing to have watched and continue watching is the 10-year. There's also this kind of theory that there's so much refinancing going on next year in America that the US Treasury, Besant in particular, needs to push the 10-year and the 30-year down, and they need to reprice it. So when these tariff wars kicked off, unexpected things happened. The 10-year spiked from like the low 4s back to 440, and interestingly, we saw massive selling of their gilts. And this is something we hadn't seen before. Some would have argued this was hedge funds unwinding positions because they were taking big losses. But when you read deeper, it's kind of a sign possibly that Japan and China were selling some of this debt. What it also did is actually weaken the dollar by about 10% over that period. And again, everyone panics about that. The dollar over the last 20 years has been, it's doubled against most currencies. And CEOs stand up there and go, our dollar's too strong, our dollar's too strong. And yet it drops 10% and it's the end of the world. It's really not. It's actually quite good for American companies. So don't get sucked into this problem. But just going back to the interest rate play, you can understand now why Trump is so involved in terms of getting yields down. And he's putting more and more pressure on Powell. Calls Powell an idiot because he's behind the curve and he won't play ball. So this kind of Fed put that's always been around in the market is not there. And he wants to fire him. He can't fire him. And so, the Fed met last week, and they said, we're not cutting rates. There's no reason to cut rates. And it's, again, something to watch. But you've got to look at inflation. You've got to look at where the economy is. You've got to look where recession is. So what am I saying in real conclusion here? Tariffs are problematic. We're not through the woods yet. We're a long way through the woods in terms of China. Great progress being made over the weekend. But it's only a 90-day pause. The real negotiations start now. We still have to negotiate the US has to negotiate with Europe. Europe's not one place. It's a place full of just everybody, and they all have different agendas, and it's very difficult. I don't think a trade deal with the EU is going to be made so quickly, and they're a big trading partner with the US. Japan, it suits them. England or the UK was a nothing. I mean, that deal was a real nothing. It was a wash. So I'm not quite sure where we are with tariffs, but what I do know, markets bounce, everyone's feeling a little bit more bullish. I think the market's going to be difficult over the next 12 months. I think we are going, maybe not into recession, I don't know what you want to call it, but through tough times. And with that, there will be downward revisions, and you need to be careful of stocks that are priced to perfection. And therefore, again, I would play a little bit more in the cheaper end of the market. If you know my presentations, I always have this graph. It's the graph, the relationship between growth and value. And for those who haven't seen it before, if you look at the blue line, that's when value outperforms. So from like the 1970s to 2000, great outperformance of value, and then you had the tech boom in 99 and the tech bust. And then again, the trend continues from 2001 to 2007, and value is the only game in town. And then something changes. From 2007 onwards, growth basically becomes the dominant style and has been for 15 years. So as value investors, we've really been fighting against quite a difficult trend. But it then escalates. During COVID, everyone realizes they want to be in asset-light businesses. They don't want to be in old, boring stocks. And you have this huge re-rating and outperformance of growth. And then in 2022, you have a capitulation of growth and value comes back. Our fund wins like a great award that year because we perform well in those environments. And then again, you have this AI revolution over the last 18 months that has pushed growth back up. And now dislocations in the market, rotation back into value, which we started seeing, although if you take it forward to where we are now, there's been an upward blip in growth again. But really what I want to articulate from this graph is even if we go back to the trend line, if we look at the little black dotted lines, that 45-degree, even if growth outperforms value, which arguably it should, there is so much upside in value stocks versus growth based on valuations that you should maybe start considering, if you don't already, having more of them in your portfolio. So what do? We drink a cup of tea, we keep calm, and we carry on. And that's really what we always do. We are boring, old kind of investors who have an investment philosophy of the type of stocks which we hope are well insulated during recessions. We know what the key performing indicators and the drivers of our companies are, and hopefully they perform well in good times and in bad times. Maybe when the markets are frothy and there's cheap money around, we won't perform as well as others. But when you've got to perform in tough times, that's when the fund really does very well. Quick snapshot of where we were on the 31st of March. It's changed a little bit. But again, if you know my fund, overweight financials, a lot of insurance companies in there, but very well diversified. So our top 3 holdings, actually Progressive Group, US Auto Insurer, Admiral Group in the UK. Tariffs or no tariffs, you have to insure your car, and that's unaffected. Our second biggest holding today is actually Ryanair, which is an Irish company, cheap aeroplane flyer. The other things you'll realize, we underweight IT. You would expect that. We don't have a lot tech exposure, but we do own Microsoft, we do own Alphabet, which is in our top 10, and we do own Meta. And just from a geographic point of view, you'll also notice that we're quite underweight the US. So 20% in the UK and 20% in Europe. Now again, I've got to put my hands up here and say these are not UK or European-centric companies. These are global equities that happen to be listed in those environments. But we've benefited from it because as these currencies have gone up 10-odd%, we've actually enjoyed that. We have a company called MTU Aerospace, which is a great civil aviation company in Germany. Fantastic business, very cheap. So all in all, our fund continues to be well-balanced. We're quite diversified, and we're very comfortable with where things are going over the next few months and think that we are likely to outperform. So thank you very much for your time.
Cool. Jared, thank you very much for that. Very insightful indeed and to the point, crystal clear. As you know, Credo always willing to engage. If you want to get more information on Credo and the Global Equity Fund, please let us know. I see Louise Usher, their colleague, also in the audience. Sticking to Credo, and thanks for the water on the tables, really appreciate it. It's my absolute privilege to welcome our guest speaker for the day. We thought we'll do that the last session and not the first session because we keep the good or the best for last. South African expat and known to, I think, a lot of the audience. A kind of person that's always more glass half full, I think. Also well-published, Chief Investment Officer at Credo Wealth. Dion Gous, thank you very much for coming through.
Thanks, Eugene. You can see that this podium was not designed by an Afrikaner because there's no place to put your brandy and Coke. Now, if you're wondering why I've got 2 bottles of water here, it's not because it's so long. I should be done in about 20 minutes. But I've been fighting a bit of a allergy-induced asthmatic cough, as my doctor told me this morning. So I'm on 3 sets of cortisone tablets, as well as an inhaler, as well as some nose spray. So the good news is that every time I do cough, I will actually cure somebody. You don't need to worry about that too much. Now, as the last speaker of the day, it's compulsory to make a joke about the graveyard session and to say that I'm the only person that's standing between you and your samosa and your castle light. And my analogy, ladies and gentlemen, is in exactly 4 weeks tomorrow, as I'm sure you know, South Africa is going to be playing Australia at Lords in the final of the World Test Championship. And I can tell you exactly what's going to happen that day. It's going to be cold and overcast. I mean, we had our summer in London. It was last week. It was Friday. So it's going to be cold and overcast. Tema Bavuma will win the toss. We're going to bowl them out by about 250 for about 250 by tea time. Aidan Markram and Dave Beddingham will walk to the wicket. Aidan Markram will do what he always does. He'll make 28 runs from 28 balls and then go out spectacularly. And then when the second wicket falls at 5:15, in comes Kagiso Rabada as the night watchman. Now, nobody at the crowd, because they'll be well oiled at that time, came to Lords to watch Kagiso Rabada bat. They may be more interested in some of his other activities. But that's my job today. I'm the night watchman. I'm here to sort of just kill the last 20 minutes, and then you can go and have your samosa. Anyway, I'm not going to talk about markets at all. It's really just my intention to have a general talk and to remind you how lucky you are to be part of the investment industry. And to start off with, I'd like to tell a story about my brother Gert. Some of you may know him. In fact, the story is more about Gert's first and only grandchild, little Benjamin, who was born in November 2023. Now, like any new grandparents, my brother and his wife Elsabie dote over this little boy, and they can never have enough of him, especially as Benjamin lives with his parents, my niece and husband, on the other side of the world in Denver, Colorado. So it's therefore quite a journey for my brother and his wife to go and visit the grandkids in America. And a few months ago, I was with Gert and Elsabie at their home in Randburg, and they were scheduled to go and travel to the kids a few weeks later, but my sister-in-law was not looking forward to the trip at all. And who can blame her? In round numbers, they were going to face a 30-hour journey. First, an overnight flight to Heathrow, then spending the better part of 8 hours in the glorious confines of Terminal 5, followed by another long daylight flight later that afternoon. And of course, my brother, like a lot of people in the audience, and like myself, frankly, is the prudent accountant. So he refuses to stump up the extra cash that it would take to have a flat bed in business class, or even that little bit of additional legroom that one might get in premium economy. Please won't you talk to your Obert? Elsabie said to me. He has worked so hard all his life, and surely now is the time for the two of us to spend a bit more money and to enjoy a bit more luxury. And to be fair, ladies and gentlemen, I thought she had a point. They are both in their mid-60s, and without me having full insight into their financial affairs, I would suggest that they are relatively comfortably retired with no debts or dependents. But my brother would have none of it. He had done the maths. He said to me, for a single person, the return flight from London to Denver and back on British Airways cost about 25,000 rand. He says, compare that to the business class fare at about 85,000, a differential of nearly 60,000 rand per person. He says, if you then divide the 60,000 rand by the actual time that you'll be spending in the air, which adds up to 41.5 hours in total, you get to an amount of 1,436 rand per hour after tax, which Elsabie would be saving for sitting upright for the duration of the journey rather than lying flat for any part of it, enjoying free chicken and beef, even if she dozes off for some of it. He then turned to me and he said, Dion, he said, have you ever made 1,500 rand per hour while you sleep? To which I responded without any hesitation, yes, Gert, I do that every night of my life. I work in investments after all. We charge basis points. And that, now, ladies and gentlemen, I know we're all investment professionals in the room. I don't suggest you take that line to your underlying clients, okay? The rest of the presentation, perhaps. But this is essentially the premise of what I want to share with you today. We are all extremely lucky because we are in this industry, because we have a livelihood that is tied to the overall value of the book that we manage, and the fact that we can earn an income from that every day and night of our lives, regardless of how hard you may or may not work today and whether or not you attend the BCI Global Investment Conference in the morning or go home early in the afternoon to watch the boy play rugby. Now, if you look at this book by Dr. Seuss, and I have to just be mindful of the fact that from a woke point of view, this doesn't quite make the cut anymore. Dr. Seuss has been cancelled for a number of the books that he published. There's about 6 of his that have been withdrawn from publishing. But fortunately, this one still makes the cut. And essentially, the premise is that for those who read the book, we should all count our lucky stars that we do not have to climb the Bungle Bridge or any other number of interesting and colorful yet perilous locations on a daily basis. To the examples in the book, I would add the fact that as investment professionals, we also don't have to get up at 3 o'clock in the morning to go down a coal mine or risk our lives high up in the sky on a construction site or run into fires or stick our hands into the backside of an animal just to keep a roof over our heads. But I urge you, ladies and gentlemen, please have respect for all these people because they do real jobs that make a real difference to the world, probably much more than the typical person in investments, if you don't mind me saying so. And to illustrate an anecdote, I started my investment career about 30 years ago in Cape Town. And at the time, I had a friend who was involved at one of the large international consulting firms, and he and his team were responsible for a re-engineering exercise at one of the competing firms. It was the asset management division of a now defunct life company. If you buy me a beer afterwards, I'll tell you which one it was. Now, Moore's Law was only warming up in those days, which means that computing power wasn't as strong as we used to today, and therefore most things in the corporate world used to take a little bit longer. And what that meant was when this very high-powered consulting team were basically nearing the end of their project and they were getting ready to pull the trigger and implement this newly engineered investment system, it meant that there could not actually be any trading in the portfolios for a good couple of weeks. And as my friend the consultant pointed out to me with some glee afterwards, those 2 weeks of inactivity happened to be the strongest relative performance that this particular firm enjoyed in years. That's a true story. Now, against that background, I have a serious question for all of you. Have you ever heard of investment professionals going on strike? Well, neither have I. They wouldn't dare to. First, I'm not sure anybody would notice. And secondly, there's the very real danger that the portfolios will outperform while they're striking. And how embarrassing would that be? This brings me to something else that we should all be extremely thankful for, and that is the fact that there are multiple strong forces that help us being successful in our business models on a day-to-day basis. And to introduce the topic, I want to tell you about the day that I met the asset capitalist. Now, I've got no doubt that there are people in the room that will recognize this gentleman on the picture. His name is Hugh Henry. You may have seen him on several occasions on CNBC or Bloomberg TV, pontificating about the world going to hell in a handbasket, always with his outrageously strong opinions and his hippie looks. He is mostly wrong, but never uncertain. Now, Hugh Henry originally made his name as the wingman for hedge fund manager Crispin Odey in London in the early 2000s. Now, if you know anything about Odey, except for the fact that he lost his old business a few years ago after multiple allegations of sexual harassment, it would be the fact that he's always been the uber bear. And all that bearishness certainly rubbed off on Henry as well. And this is something that soon stood him in very good stead. He broke away from Odey in 2005, started his own business called Eclectica, and he went into the global financial crisis a couple of years later largely short, which meant that he ended up having a month in October 2008 when practically every other investor lost their shirt, and no doubt a lot of people in this room will remember the stress that you experienced in that month. In his fund, he made nearly 50% return in the worst month in living memory. So that was great. The problem was that Hugh Henry never really thought that we came out of the financial crisis. So he remained largely short. And that meant that in the 8 years that followed, the total return on his fund added up to 5%. Not 5% compound, ladies and gentlemen, 5% per annum. No, 5% in total over 8 years. This is while the S&P 500 went up about 150%. Needless to say then that his clients eventually got a bit disillusioned and impatient and asked for their money back. And he ended up closing his whole fund and, in fact, his business towards the end of 2017. Now, I met Hugh Henry in 2012 when his reputation was still largely intact. I was taken to his very sexy offices in Notting Hill by a colleague of mine who was responsible for our multi-asset portfolios. We were actually considering an investment into his flagship fund in one of those portfolios. And I have to say that Hugh Henry that day came across as charismatic and very smart, self-deprecating, and certainly quite funny. And of course, the bearishness shone through. He was explaining in tremendous detail to us exactly why the next great crash was around the corner, and his highest conviction position was a massive short on China, which may sound like a pretty good call in hindsight, except that he was about 8 years early, and the Chinese market would first go up 200% before it started to pull back. And I remember leaving his offices after that day because he sounded so utterly convincing, and I didn't really have the wherewithal. I certainly didn't have the confidence, or I wasn't articulate enough. This accent of mine may work well in Pretoria, but it doesn't work that well in Notting Hill. So I didn't have the confidence to debate matters with him, but I remember leaving and chatting to my younger colleague and telling him that there were at least two things which I'd learned in my decade and a half or so in investments which had preceded that. First, there's usually another side to the story. And secondly, there are these strong forces that over time conspire to help markets go up, most of the time. And for those reasons, especially the latter, I wasn't quite ready to just sell everything and to start shorting the market and slash my risks, even though you, Henry, had sounded so utterly convincing that day. I forgot to show you this slide, ladies and gentlemen. Hugh Henry, when he closed his fund in 2017, you don't need to feel too sorry for him because he made enough money to move to the tropical island of St. Bart's, where he now owns and manages a luxury guest house. This is him hard at work a week ago. But to come back to those strong forces that I referred to when I was chatting to my colleague on the way out from Henry's offices. What are they? Well, first and foremost, we've got the principle of free markets to thank, leading to compound economic growth over time. It's nearly 100 years ago that John Maynard Keynes wrote this book, where he spoke about the animal spirits that drive us all forward, even in the face of adversity, regardless of the fact that there may be a pandemic that hits or a fool that gets elected to high office, or one of the largest cities in the US burns down. We see it every time that an entrepreneur invents something and brings it to the market, something that makes our lives so much better than what we could have imagined before. And by investing in a portfolio of high-quality companies, like we've heard of multiple times today, I was sitting at the back of the audience, we get all these super smart, ever-optimistic, single-mindedly focused individuals with their ideas and their energy and their management skills working for us while we sleep. You need to be pretty brave to bet against all these people for any extended period of time. Related to that, ladies and gentlemen, is the principle of compounding, and there is no graph that illustrates this better as this one which Morgan Housel tweets every few months. Now, no doubt half the people in the audience, perhaps more, have read some of his books, specifically The Psychology of Money. In a few months' time, his next book comes out, and if you haven't read it yet, that's your homework. Please go and buy that book and read it as soon as possible. But he's been tweeting this since before Psychology of Money has appeared. And he says one day he will produce a book, and every graph, every page will just be this graph. And it's essentially just the S&P 500 over 150 years. And as I always say when I flash this graph, ladies and gentlemen, over 150 years, it's clear that every all-time high in history was, in fact, a great buying opportunity, and every crash and every correction turned out to be merely a blip. That's the power of compounding for you. And one more thing to note. Please look at the scale. This is a log scale, for those of you who are mathematically inclined. This is not a simple linear scale. If that was a log scale, this graph would go to the 15th floor of this hotel. Okay? No doubt. I promise you, I've done the work. And then, ladies and gentlemen, the final thing to add is the fact that we've got the vested interests of the vast majority of market participants to thank, because they also help us in our business models. And the first one to focus on, of course, is Trump. And as my colleague Gerald Khan just said before me, when we had to finalize this presentation, there was a little bit of doubt about how things would play out in terms of tariffs in the weeks that followed. So when I was going to say that Donald Trump ultimately sees the market, the stock market specifically, as a scorecard of all his personal brilliance, it's something that I've been saying for months and years, and it's something I always plan to say today. But yes, this was severely tested in the last few weeks. And I think if anybody asks you to sum up what we've been through with tariffs, there's only one slide that I think you need to show them, and it's this New Yorker cartoon. That blue line is basically the first 8 days of April. And then when the bond market started, showing a hiccup around the 8th or 9th of April, it was at that point that the president, in all his wisdom, decided that it was always his plan to reverse course. But thankfully he did, and we can count him amongst some of our friends again when it comes to helping us in the stock market. But to this we can add every governor of the Federal Reserve. As you know, it's seldom a good idea to fight the Fed. And then there's also the vested interests of every insurance company and hedge fund manager and sovereign wealth fund, other institutional investors and market participants, essentially pulling in the same direction. Except, of course, perhaps for those few souls, those few brave souls who actually specialize in shorting the market. They say you get old mushroom hunters, and you also get bold mushroom hunters, but you don't get too many old, bold mushroom hunters. I'll explain that afterwards. Not everybody understands that analogy for some reason. And I suspect the same principle, ladies and gentlemen, from a market point of view, is true for those who choose to short the stock market. But perhaps the biggest tailwind that all of us as investors have is the fact that we're playing a positive-sum game. And to illustrate, let me tell you about Gambledore, which is the nickname that stuck to this gentleman. His name is Vladimir Korzinin, 69-year-old amateur poker player who took the poker world by storm in November last year when he won nearly $8 million playing back-to-back tournaments against a field of mostly professionals in Monte Carlo. Now, if you've ever played tournament poker, you would know that you can only win the tournament once you end up with all the chips at the table. Everyone else's chips is in front of you. And in any given hand, you can only win those chips that other players have staked and lost. It's the ultimate zero-sum game. Investing is quite the opposite. In investing, over time, most of us can and actually do win, although some investors will obviously do better than others. And that's thanks to animal spirits and compound economic growth over time that I referred to earlier. Having said that, there are also some important similarities between poker and investing. And I'm not only referring to what it takes to be successful at both, which is essentially a combination of skill and patience and psychology, and yes, a little bit of luck. It's also the fact that in investing, as is the case of poker, there's no real reason why old age is an impediment to success. I mean, Gambledore illustrated that for us just the other day. As somebody who recently turned 60 myself, ladies and gentlemen, I feel entitled to say that. And it reminds me of the fact that in my previous life, I used to be a multi-manager, and I was lucky enough to fly around the world, not always saving my company 1,500 rand per hour, I should add. And I was lucky enough to meet a gentleman by the name of Dave Marvin, the founder and chairman and chief investment officer to this day of a firm called Marvin & Palmer, based in Wilmington, Delaware, a brilliant man. I met Dave in the early 2000s when he was already in his 60s. And I remember asking him the obvious questions about succession planning and prospective retirement and key man risk. And he said to me, Dion, you've got nothing to worry about. He says, let me tell you, he says, there's only two things that I really enjoy. One is investing, and the other one is tennis. And let me tell you, he says, as I get older, investing is a lot easier on my knees than tennis. Now, he didn't lie to me. I haven't spoken to Dave for some time, but his firm's website tells me that he's still there offering clients the benefit of a full 60 years of experience. It doesn't mention whether or not he still plays tennis. Now, at the age of mid-80s today, ladies and gentlemen, you may argue that Dave Marvin is in the twilight of his investment career. But of course, we all know that compared to the most famous investment duo of all time, he is positively a spring chicken. We all know that Charlie Munger, passed away towards the end of 2023, 1 month short of his 100th birthday, and he essentially worked up until his dying day. And his partner, Warren Buffett, will turn 95 in August, and to this day, he's still buying shares and selling shares and drinking Coke and eating McDonald's every single day of his life. I am very thankful on his behalf, ladies and gentlemen, that with a mere pension pot of 162 billion, he's now made enough money for the rest of his life, and he will soon stop working. So that has affected my presentation somewhat. Now I was lucky enough to meet Charlie and Warren in 2004, long before Steve Jobs had invented the iPhone and managed to fit it with a 12-megapixel camera, which explains why this picture is a little bit blurry. But if you look closely enough, you may spot some other renegades from the South African investment industry over there, people like Walter Eilert, Piet Viljoen, Thijs de Tooy, and Kokkie Kooijman. Speaking of Kokkie Kooijman, this is in fact a picture of Kokkie's 70th birthday party after a walk through Newlands Forest in January last year. I'm not on the picture, I was in London at the time, sadly, I was invited, so I'm sad to have missed it. But the point being that Dave Marvin might always have preferred tennis. Kokkie is somebody who's always enjoyed running, and with somebody who used to run the marathon under 3 hours, he's got a personal best of 2 hours and 48 minutes, he's certainly, that's for the full marathon, for 42 Ks. He's certainly no slouch. Having said that, ladies and gentlemen, I think the years catch up with all of us, and I would guess that in his 70s today, that investing is easier on Kokkie's knees than running, which probably explains why he's still happy to manage a global financial fund into his 8th decade. But there's another point that I'd like to make about this picture, and that relates to the friendly ecosystem within which all of us as investment professionals are lucky enough to operate. I've just highlighted 7 people there that all represent different firms within financial services in South Africa today. If you add the gentleman who took the picture as well as myself, who could have been there, but sadly had to miss it, there'd be 9 competing firms represented here today. And the reason that this is possible, the fact that we as competitors can all, have fun together and be friends, you may argue it's because Kokkie is such a nice guy and he's got so many friends, and of course that's also true. But I would add to that, it's a function of the industry that we do have. We can all coexist in harmony, and we can all make a living, because the fact that we're not playing a zero-sum game allows that, even if we have to compete vigorously from time to time. Of course, it's also an industry, ladies and gentlemen, that's filled with a lot of people that are not only very smart, but also rather nice. I mean, just look around you in the room today. This brings me to my very last point, and that is the fact that no 2 days are the same when it comes to the world of investing. I'm not going to talk about all the pictures on the slide, but whether it's September 11, or Donald Trump telling another lie, or Jim Cramer being the perfect counter indicator that you want, or a banana against the wall that trades for $6.2 million, to a greater or lesser extent, you can argue that all of them have investment relevance from time to time. In the 1980s, I was studying tax as part of my CA training, and I had a lecturer who used to tell me that she was very lucky because she had a partner in government. And what she meant by that is that every year the Tax Act changes, and there's lots of confusion about how implementation will work, which gave her lots of consulting work. That's valuable if you're an underpaid lecturer, is to have this consulting gig. And she had a partner in government that gave her work every year. We have partners as investment professionals at all levels of government, in all industries, in every country of the world, that makes our days interesting and meaningful. And I think that's something to be thankful for. It's allowed me to write a column for the Financial Mail for the last 5.5 years, and it's given me material on a monthly basis, even though I will often not know what to write about next. So, to summarize, ladies and gentlemen, the reason that we should all be thankful for and realize how lucky we are. First and foremost, we're doing a job where we can make money while we sleep. Secondly, we do not need to go up the Bungle Bridge or any other dangerous places of work on a daily basis. 3, there are all these strong forces that help us being successful with our business model. 4, it's a fantastically friendly ecosystem. 5, it's the greatest show in the world. And finally, ladies and gentlemen, and now I'm going to paraphrase what is my favorite scene in that great movie, Love Actually. You can do this job if you are that way inclined until you look like this. I thank you, and I wish you all the best, and enjoy that samosa. Thank you.
Dion, thank you so much. We are really grateful for your time here today, and thank you for coming through. The same to Jared as well. We're all wrapping up. We're going to have drinks and snacks as you exit to the right. A lot of the fund managers that presented here today are still here. So if you want to have conversations with them and get all those burning issues off your chest, please do so. Thank you all for attending here today, and to our live audience. We'll be back here tomorrow for day 3 at 9 o'clock sharp. Thank you very much.